yet, right? That there is more of an impact to come.
Well, I would have thought so. I mean, if you think of that logic, central bankers call it the forecast horizon. I mean, in a sense, that's what we have to think about. I would like to just focus back on some worrying signs. The question, in a sense, is always the two sets of worrying signs. Consumer confidence predicts recession. The other thing that tells you you're in recession, particularly, is in the labor market. And I think very worrying has been the big employment drops that you've seen on the household account in the last 4 or 5 months. Even bigger, the last 6 months, the declining in employment on that account is even bigger than it was in the last 6 months in 2007 as recession started. So maybe, the dream world we're in, the positive environment we're in will continue. But there are worrying signs that, because that in a sense is the thing that picks up recession. So in a sense, the Fed must always think, well, okay, there are worrying signs here. To err on the side of actually cutting rates would probably be the right thing to do. I probably would, as always known as a dove, I would certainly be considering a rate cut. I certainly would rule out, as others have suggested, anything about a rate.
So the EIA raises forecast for this year's world oil demand growth by just 10,000 barrels per day, and now seeing 1.43 million barrels per day year-over-year increase. For 2025, world oil demand growth by 90,000 barrels per day has been raised, so now seeing 1.38 million barrels per day year-over-year increase. In terms of WTI crude, EIA lifts the 2024 WTI crude price forecast to $82.15 a barrel, which is up markedly from the $77.68 a barrel seen previously.
In 10 minutes' time at 2 p.m. Eastern, we have the US federal budget balance with a forecast of minus 298.5 billion and a previous of minus 22 billion. In 5 minutes' time at 2 p.m. Eastern, we have the US federal budget balance with a forecast of minus 298.5 billion and a previous of minus 22 billion. One minute remaining.
Ten seconds.
minus 296 billion, minus 296 billion. That's higher than expected, minus 298.5 billion.
Their highs. Let's talk about the trading environment. We'll get to Mike McKee in just a moment, but right now let's get to Bloomberg News Markets reporter Abigail Doolittle. Talk to us about the trade off this morning's CPI report to where we are now, Abigail.
Well, it was a little bumpy initially. We did go higher, but then we actually on the equal weighted S&P 500 index went lower. The Russell 2000 went lower. That index, that small cap index, is still down, but the S&P 500 up 0.9%, the NASDAQ up more than 1%. So I would say it's a bit of a relief rally that CPI report, while it did come in a little bit warmer than expected, it wasn't hot. So I think that at the end of the day, investors are looking at it in terms of now that there's market voices out there saying that the Fed might not cut at all this year. The fact that last week Fed Chair Jay Powell said, yes, they are cutting this year, and that this CPI report gives them the room to most likely be able to cut this year if other data doesn't come in. So long as they're cutting this year, whether it's the 3 that they're anticipated to cut, or if it turns out to be 4 or 2, I think that's less important.
Details, right?
Yeah,
but
just so long as they do. Because when you have somebody like Torsten Slot come out saying that they're not going to cut at all, and I personally could make a case for that as well. Mike McKee here might take exception to that, but I could see how they could make that case given inflation in the 70s, that it is staying stickier. I mean, David Kelly, is it David Kelly from JP Morgan this morning?
Yeah.
The hot cookie analogy, that taking the hot cookies out of the oven.
Yeah, that was great.
It takes longer. It takes them longer to cool. So and that's the setup for Mike McKee.
Well, Mike, is that true? It does take the hot cookies longer to cool when it comes to inflation? Michael McKee,
You're the baker here. You can tell us.
It does sometimes.
She does. Christmas time, she's crazy with the cookie.
So I've heard.
I'll get back there. It's been really high.
I keep hearing this.
You're wearing left-out from Christmas
just so
cookies.
you know, I've heard this. Carol and I have, been doing
Give
this show
Carol a
together
break.
for
It's been the
4
pandemic.
years at this point, and all I hear from you is she makes the best Christmas cookies.
Since we're talking about inflation, input costs have been really
there we
high.
go.
And labor costs, don't even get me started.
Those sprinkles are ridiculously expensive. It was a good analogy because you can debate. The number came in a little bit higher on the headline rate on a month-over-month basis, and it really didn't make a whole lot of difference. But what people are saying is, would that make it hot? And I think David said, no, it makes it warm, and the cookies have to cool down when they come right out of the oven. Yeah, the bottom line kind of is this. When you look at what happened, the headline CPI went from 0.305% to 0.442. So you're not talking about even a percentage point change. It looks that way on the Bloomberg, or it comes out as a 0.4 instead of 0.3, but it's a rounding question. So it's not a huge change there that we're seeing. That was largely gasoline, and people knew that, but everybody's been complaining about gas and food. Food was flat. There was no food inflation. So basically, we're not anywhere that tells you we have a real problem. It is a little sticky, as Abigail said, but the Fed expected that, and I think this doesn't change their view one way or another.
But Mike, does it give any credence to the folks who say that last mile, getting inflation down to 2%? Again, I know.
Didn't we debunk this? Or is it true?
I know this is CPI, not PCE.
Yeah.
So it's not the Fed's preferred method, but this is an input for PCE.
It is.
But does it add credence to the idea that the last mile is going to be really tough?
I don't know. The last mile is going to take a while, and it's going to be bumpy. How tough it is, we aren't exactly sure yet, because we're just kind of getting to that last mile now, and the issue is, what is it that goes up in price that stays sticky? And this time we saw a number of things that had stuck in the past didn't, and then something like used cars, which had been going down for several months in a row, went up a little bit this month, 0.5%. So is it just going to be bumpy like that, or is there something that the Fed and its high interest rates can't attack, and it'll take a while for that to come down?
All right, we're going to roll one more name into this conversation. Ari Jersey is also with us, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence out there in our BI headquarters in New Jersey. You're on surveillance this morning, breaking it down. So what's of note of your end, and as you listen to this discussion with Abigail and Mike?
Yeah, I think it was interesting just watching what happened with the knee-jerk reaction right after the number, right? Like Mike said, we saw that small beat, we sold off a little bit, and then most of us looked at the data and we're like, yeah, it's kind of like as expected pretty much, and then the market rallied back, and then finally we then sold off again as people kind of, I think, settled into the idea that, look, the numbers came in pretty much as expected, but when you look at what's been turning around, things like used autos and like a lot of actually the goods sector, which had been a drag on CPI for a while, then market participants started to say, like, well, yeah, maybe the Fed's not going to be able to go quite as quickly as we thought, and certainly the market, selling off a little bit today is a reflection of that. And you see 10-year auction didn't go particularly well about an hour ago. It wasn't bad, but it wasn't a good auction either. So I think market participants are like, okay, let's wait and see now. We have retail sales coming up, and then the Fed next week. Let's wait until we hear what Jay Powell has to say before we majorly switch our positions and thinking.
I was going to say, go ahead, Mike.
Here's why it matters to the Fed coming up, because they have the meeting on March 20th. They've already told us they're not going to do anything, but we do get a new set of economic projections and a new dot plot. So the market's trying to game out whether they're going to change that or not.
Right.
And my guess is this isn't definitive enough one way or another to lead them to change their forecasts.
I was going to say to Abigail, one group of investors certainly not waiting today is NVIDIA. We promised that we'd get to it. Shares
Every
higher
day we
by
come in, it feels
5% now, so it's over $900 a share. It's not at all-time highs. That would be in the 970s, but still, I mean, it's been an incredible run. Is there anything fundamental about this, or is this all sort of part of the relief rally?
I mean, I think that today it's a little bit of both. I think that it's the relief that the market darling stock can continue to go higher, that the Fed is not going to get in the way of technology overall in terms of the idea that liquidity could stay as tight as it is all year or even tighten more. And this is the favored stock because of AI. Now, one thing I'll point out is as I'm looking at this stock, out of the 2022 lows, any guesses on how much this stock is up?
2022 lows, 400%?
800. Up 800%. And I can make
I had to venture a guess.
I can make the case, the technical case, very easily that all of this year's rally from about, let's call it 463 to current levels could go away like that, just because it's a parabolic uptrend, a 90-degree angle can't hold, and the RSI, which we talk about sometimes, it is actually just on the line of being overbought or oversold, which means that the momentum is not as good. So people are a little bit nervous here, but they don't want to stop buying.
We're going to talk about NVIDIA versus kind of Cisco, kind of do a little bit of a history lesson with John Authors in a moment. But Ira, I want to go back to you for a moment. In terms of how rates traded off of this morning's report, anything of note there? Because it does seem like we're a little bit higher along the curve.
Yeah, so just about everything, and it's a mix right now between inflation expectations and real yield. So the real yield piece is going to be driven pretty significantly by Federal Reserve expectations, but the fact that you had, I think, the slightly better or higher than expected CPI report is one of the reasons why you have break-even rates. So the amount of inflation that the market's expecting has also gone up a couple of 3 basis points, basically across the curve. So in the rates market, you know, we haven't really changed the pricing for the Fed. We're still kind of saying June at July, kind of as a first cut, and then a couple more cuts before year end, actually almost 4. I still think that might be too many, and I think that's one of the big risks that still needs to get priced out of the market is what happens, to Mike McKee's point, what happens if you just have 2 members of the Federal Reserve move from the median of the dots up just one, taking out one more cut, and in doing so, you can wind up seeing a pretty big sell-off in the front end of the curve because that could change some of the dynamics. It's hard to say that one cut is going to move the market a lot, but the fact is that these days it really is moving the market, 25 basis points every time you get, 1 or 2 dots moving significantly.
All right, Mike, the ball's in your court.
Well, it's funny because we've talked about this quite a bit, that the market is always adjusting, minute by minute, day by day.
And does some of the Fed's work for it, right? Sometimes?
Yeah, to a certain extent, yes. I mean, that's the idea.
Yeah.
If monetary policy feeds through the financial markets. But the Fed only updates once every quarter. And so the Fed is always going to be, quote unquote, behind where the market is. But the question that the market has to divine is what they're looking at right now, the bright, shiny object in front of them right now, enough for the Fed to make a forecast that will last out a quarter. And that's the harder thing for them, which is why I think they don't change significantly unless somebody had already changed. I don't think this number makes a difference.
I think what's still fascinating to me, Carol, is that even after the summary of economic projections in December, which called for a median of 3, you had people pricing in 6 rate cuts.
It was so aggressive at the end of last year.
It took weeks for that to get down to even close to 3.
Yeah, a real reset.
To match what the Fed is seeing.
One thing, I want to roll into this, because we were talking about this in the newsroom, and this comes from you, Ira. You were on surveillance this morning, and you talked about, it's something we've talked about certainly with Abigail and others and market guests about kind of all of the money on the sidelines when it comes to the markets. And I feel like we've got the perfect roundtable to kind of address that. What are you actually seeing and what that means? Do we have it all wrong that this money is just going to kind of at some point come into either stocks or bonds?
So if you look at cash on the sidelines, meaning both bank deposits, retail bank deposits, as well as retail money market fund balances, it's basically at the average of what it has been for the last 30 years in terms of a share of financial net worth. So it's not obvious to us that that is cash on the sidelines that needs to go into other financial markets. In fact, we think that it probably is not. And when you look at a bulk of the change, so two things have been moving the money market mutual fund inflows. Number one was out of bank deposits starting last March when you had the SVB blow up. A lot of deposits left to go to money funds, and in particular because money market funds yield 3 times what the average bank deposit does. So why not move into there? And then you've seen new money. So the new savings that is going on, and just from the personal income and spending report that Mike McKee talks about at the end of every month when we get the PC data, as that money comes in, instead of going into bank deposits, it's now going into money funds for the same reason. Money funds yield 5%. Bank deposits yield 1%. It's a no-brainer. That's just where savings is going. Not necessarily going to find its way into the stock market or the bond market or anywhere else.
I see Abigail nodding here because this is a question we've been asking for months at this point. What happens to this $5-6 trillion that is in money market funds when rates do start to go down? Where does it go? And Ira writes in a great note that, hey, it might not actually go into the market.
Yeah, I think it's a really compelling case that it may not indeed go into the market for the very reason that if you can get 4 or 5% by just putting it in money markets, why is it going to come out? Now, when rates go down, there will be some savvy, smart investors that will quickly redeploy it in other ways. Will it necessarily go into stocks? We don't know that. Maybe it goes into fixed income of some sort as rates come in. But a lot of people, they won't adjust it for a while, just creatures of habit. The difference between 5% and 3%, I think it would take a significant drop for people to take the money out. And then if rates are coming in that much, at that point, is there a haven bid to bonds? Is there a reason that folks would even want to put it into stocks? I don't know. I think that Ira makes a very compelling case around that.
Well, and this whole idea that household cash is not above typical levels. As he says, the cash holdings as a share of financial assets are right in the range that's persisted for the past 2 generations. Mike, so the Fed component to this, I'm sure the Fed is looking at all of these kinds of data points.
Yeah, the Fed obviously looks at asset prices as part of their guesstimation of where inflation is. It's not an official part of it, but they try to figure out if we're seeing inflation there that could be a problem, and then they're always watching for bubbles. They won't step in front of them, but they want to know what's happening with the markets. But at this point, the idea of whether you're buying Treasury bills or whether you're buying stocks, it's no concern of theirs.
And something interesting, just to jump in here for a moment, if you were to compare the yield on the S&P 500 when adjusted for inflation, it's 0.89%, so it's not even 1%. So there's a big spread there. I think it really helps.
Well, of course,
make
if I have
case.
only the S&P Nvidia.
Yes, that's true. Then you want enough stocks.
All right, round robin. Ira, next focal point for you, really quickly, 2 seconds.
Well, it's tomorrow's retail sales report because if the consumer is still very robust, it's hard to see the Fed needing to cut very early.
Mike, a second.
Well, I'm going to go with the retail sales report and the PPI that's coming because then we get the PCE. We can derive the PCE.
I'm looking a little bit further out to next week in the Fed.
Got it. You guys rock. This is Bloomberg.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays only on Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got the S&P 500 index trading very close to session highs right now, up 49 points. That is a gain right now of 1%. The Dow up 245, up 0.6%, while the NASDAQ Composite Index is advancing 207 now, up by 1.3%. The 10-year yield, 4.15%, with a 2-year at 4.58%. Spot gold down 1.2%, 21.55 the ounce. West Texas Intermediate crude down 0.6%, 77.48 a barrel, while Bitcoin now just about 71,000, down 1.5%. The stock market is managing to rebound after the latest inflation numbers did little to alter bets that the Fed will cut rates this year, even if it keeps a more cautious stance for now. Lots of news in the airline industry today. United has told Boeing to stop building 737 MAX 10 jets for the carrier, opting to switch to a smaller variant on the rival Airbus A321 until the plane maker can pull the stretched single aisle through its long-delayed certification. United down 2.4%. Boeing shares down by 4.4%. Again, recapping here, S&P up 51, a gain of 1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, another day and another batch of Boeing stories and headlines, and another day with Boeing shares trading lower. They are down about 4.4%. They lost 3% on Monday, and they lost about 2.25% on Friday. Today's stories, Tim, let's just go through them. There's an FAA audit of the production of Boeing 737 MAX. It found dozens of failures in the manufacturing process. This is a story out from the New York Times.
Also today, a Boeing whistleblower who raised safety concerns was found dead. And Carol, meantime, Boeing deliveries trail Airbus as the 737 MAX crisis slows factories.
And then there's fallout that kind of spreads. You've got Southwest falling the most in 4 years on those Boeing woes. There's more. So let's get to it. The latest on Boeing and its impact. Let's get to our interview. Back with us is Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson in our BI headquarters in Princeton. George, I'm not quite sure where to start, although I do feel like the New York Times story is front and center, but you're the expert. What is top of mind when you're thinking about the Boeing story again on this Tuesday, March 12th?
So I think the New York Times story was
probably the most interesting piece of new news that came out in the last couple of days. I think we knew Boeing was going to have problems with the manufacturing process. We knew they probably weren't going to pass this. But I think where they honed in on Spirit Aerosystems, what we saw is that more of those inspections came up bad than came up good at Spirit. And I think that kind of dovetails with the news we saw, I think it was about a week and a half ago, about Boeing exploring the purchase and reintegration of Spirit Aerosystems. My guess is that Boeing probably saw the early version of this report. They've been looking at potentially bringing Spirit in-house anyways. This probably just cemented it. It does reinforce in my mind as an analyst that the path to higher quality and higher builds on the Boeing MAX really flows through Spirit Aerosystems, and Boeing buying it and integrating it is probably going to be the only way they can really control things well enough to feel really happy about, again, about the quality and about the number of airplanes they can get out the door.
I also want to bring in with us Sheila Kayaglu, Equity Research Managing Director and Aerospace and Defense and Airlines Analyst at Jefferies. She joins us on the phone from New York City. Sheila, given all the problems that Boeing has had just in the last few months, and even though management is now going to look to tie compensation more towards safety than it has in the past, is this a company you're confident in that can recover fully from its past?
Sure. Thank you for having me. So I think Boeing, obviously deliveries have been disappointing in January, as well as the February report that was just released at 11 a.m. today. However, I do think Boeing is one of the greatest manufacturers globally and obviously one of the largest in the U.S. So super critical to the U.S. economy, the airline industry, as well as all the employees and suppliers it touches. But clearly they're going through a tough time, and the headlines over the past week read pretty negatively and like a drama. So I do think that there has to be some changes made. Clearly not in the compensation, because safety is a part of every culture and should be, but maybe what the NTSB asked for last week was potentially more documentation, more oversight on these processes. But you would think the MAX line was one of the most scrutinized production lines in the world, manufacturing lines, just given the incidents it had over the past 5 years.
Sheila, so critical that you think the U.S. government could come in and offer some sort of bailout or fix for the company? Oversight?
Lawmaker says bill would reduce China's hold on critical minerals, according to WSJ.
$4 billion in cash flow on the low end this year. Deliveries on the MAX are coming in lower, but to put it in perspective,
U.S. lawmakers to introduce bill in support of deep-sea mining, according to Wall Street Journal.
So it's not necessarily like, it's not, in any point of view, a bailout. But things are 20% lower than expected, and we continue to hear delays. And that's resulting in certification process delays with their new aircraft, like the MAX 7, like the MAX 10. So I don't think Boeing's in a position of a bailout. However, it does need to fix its manufacturing processes to get the deliveries to the 38 a month that they should be at in the first half of this year.
George, I want to bring you back in. We've talked with you, Tim and I, a lot over the last few weeks when it comes to Boeing. And I'm hearing there's tough times and then there's tough times. When I hear bailout and I hear Sheila saying, no, that this is not likely. How do you describe the situation at Boeing right now? Is it just a tough time or something more serious in terms of figuring out, what's going on internally at this company and getting it under control?
Yeah, I mean, I think this is it's a function of decades of focusing on trying to outsource more of the build of an airplane and not focusing on the fundamentals. And so, unfortunately, I think, David Calhoun becomes the caretaker of putting it back together. But I think, this is sort of Boeing's time where they have to focus more on engineering, focus more on manufacturing, focus less on getting the last penny out of every supplier, and squeezing the process. This is a time where they've got to drop back to fundamentals. And so I think, again, it makes it a particularly difficult time. But I do think they'll turn it around here, and hopefully there'll be a stronger company for it that focuses on again, the fundamentals of engineering and manufacturing.
George, do they turn it around soon enough? I mean, there's another story by Mary Schlangenstein today about United telling Boeing to stop building the 737 MAX 10 jets for the carrier, opting to switch to a smaller variant and the rival Airbus SE A321 until Boeing can pull the stretched single aisle through its long-delayed certification. I do feel like there's stuff coming from the airline space, and I wonder how much pressure that's putting on Boeing, and is Boeing really at risk at losing some of these guys as future customers?
Well, I mean, United is a case in point where Boeing would really not want to lose that customer. And even despite the fact that there's only 2 manufacturers and the backlog is even much larger at Airbus, right, where I think he probably couldn't get airplanes until late this decade, early next. Kirby's looking for a way to get those longer airplanes sooner rather than later, sort of given up on Boeing's ability to get the Dash 10 certified in the near term. He's probably very, very frustrated because all the airlines, especially in the U.S. but around the globe, are moving to larger aircraft because of those higher pilot salaries they gave away. Those larger aircraft drop the cost per seat mile, and that's what's going to keep him competitive. So you can sense his frustration that he can't get his hands on that really important airplane to his business, and that's where you start to run the risk of losing customers. They haven't yet, but it's a real risk.
Sheila, what about when it comes to Southwest? Shares of Southwest down almost 15% as we speak because the company's planning to cut capacity this year, halt most of its hiring, review its spending plans in response to reduced aircraft deliveries from Boeing. This is a company that's exclusively reliant on 737s and Boeing aircraft. Does it make these companies think differently about perhaps changing up their fleets? I know that's a very, very big deal because it involves pilots, it involves maintenance, and it's a huge deal. But does it make them think differently?
NYMEX diesel April futures settle at $2.61 a gallon. NYMEX gasoline April futures settle at $2.58 a barrel.
They're cutting their MAX guidance, which was somewhat expected given where what they anticipated for the year was quite high. So they're trimming from 79 MAX deliveries in 2024 to 46.
NYMEX WTI crude April futures settle at $77.56 a barrel. That's down 37 cents or 0.47%.
Which is why Love is down, is they had an overzealous expectation for pricing. They were one of the only airlines that expected pricing up about mid-single digits year over year, versus American R&B ratings that had expected domestic pricing down low single digits year over year for 2024. So it cut back its Q1 pricing guide, and it expects it now to be flat to up 2% from, it cut it to be down low single digits now. So that's why I think Southwest is underperforming, not only because of its Boeing woes, but because of its pricing expectations that it set out there, which were over-aggressive.
Hey, one last question, if we can get a response from both of you. I don't want to sound like a tabloid, but it's on the Bloomberg. We wrote about it.
NYMEX natural gas April futures settle at $1.71.
Plane makers Boeing's production standards at the North Charleston 787 Dreamliner factory has been found dead. He's given evidence in a lawsuit against Boeing. He was supposed to go some further questioning on Saturday, and then he didn't appear, and they found him. George, I don't know. Is it just another headline in kind of a rough year for Boeing? How do you read this? Just got about 30 seconds.
Yeah, I don't know that I can't read much into that. I don't think there's any foul play, and I'm an analyst, more than a criminal investigator.
Fair enough. Sheila, any thoughts on that? 20 seconds for you.
I mean, you can't make it up with the New York Times audit saying that Spirit workers used hotel keys to check door seals, liquid soap as lubricants. It seems like the headlines are just not pleasant. So I can't comment on that criminal item, but or that investigation, but it seems like, the headlines are not great.
Just a bad year, to say the least. All right, Boeing shares down about 4.5%. Hey, guys, thank you so much. So appreciate it. Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst George Ferguson on our BI offices in Princeton, and Sheila Kayelaglu, Equity Research Managing Director, Aerospace and Defense and Airlines Analyst at Jefferies, joining us on the phone in New York City. Guys, thank you so much.
Hey, let's get a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom in Washington, D.C. Hey, Amy.
Hey, Tim, there's a new plan now in place to provide hundreds of millions of dollars in military assistance to Ukraine. The Defense Department put the $300 million package together. National Security Advisor Jake Sullivan.
This ammunition will keep Ukraine's guns firing for a period, but only a short period. It is nowhere near enough to meet Ukraine's battlefield needs, and it will not prevent Ukraine from running out of ammunition in the weeks to come.
National Security Advisor Jake Sullivan there. The House has failed to act on an aid bill that's allowed the momentum in the war to shift to Russia's favor. Special Counsel Robert Hur, who investigated President Biden's handling of classified documents, still testifying before the House Judiciary Committee, which is chaired by Republican Jim Jordan of Ohio, who says Biden should have been prosecuted.
Joe Biden said he took his notebooks with him after his vice presidency because, quote, they're mine. And every president before me has done the same exact thing. Never mind the fact that he had never been president when he took this information. But what comes through is Joe Biden felt he was entitled.
A transcript of Biden's interview with Special Counsel Hur painted a mixed picture of his mental acuity. That's something Republicans have tried to exploit for the 2024 election. Global news, 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ. They're all pushing higher right now. CPI Tuesday with the S&P 500 index up 53 right now, up by 1%. Dow Industrials up 280. That is a gain of 0.7%. While the NASDAQ Composite Index is up 220. For NASDAQ, that is a gain right now of 1.4%. The 10-year is yielding 4.14%. The 2-year, 4.58%. Spot gold lower now by just about 1.2%. $21.55 the ounce on gold. WTI West Texas Intermediate crude down 0.4%, 77.64. And Bitcoin now down by 1.2%, 71,269 on Bitcoin. Bottom line here, an update: the Dow, the S&P, NASDAQ all advancing as the stock market manages to rebound after the latest inflation numbers did little to alter bets that the Fed will cut rates this year. New York Community Bancorp has completed a deal to raise more than $1 billion of capital through an equity investment by backers led by former Treasury Secretary Steven Mnuchin. NYCB up now by 4.3%. Recapping stocks higher among tech names: NVIDIA up 5.3%, Cisco down 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Well, folks, to be or not to be a bubble.
I think Shakespeare said that.
Think he was talking about this?
Yeah, I think so.
Not so sure. All right, well, we spend a lot of time talking about the markets and whether or not it's a bubble. We have guests on who talk about it, address it, including just this past Friday with ARK Invest Kathy Wood, who has seen quite a few market cycles and addressed the recent run-up in stocks. Here's what she had to say.
We do not believe we are in a bubble anything like we were in the late 90s. I was there, and the technologies weren't ready. The costs were too high, too much capital, chased too few opportunities too soon. The seeds for what is happening now were planted during the 20 years that ended in the tech and telecom bubble, and they've been germinating for 25 or 30 years.
All right, that, of course, is ARK Invest Kathy Wood. Everyone, Tim, is talking about bubbles.
Including Bloomberg opinion columnist and Bloomberg Market senior editor John Authers, who's here with us in our Bloomberg studio. John, good to have you. You've got a great column out, among the most read on the Bloomberg terminal, all about whether or not this has similarities to not only what happened with Cisco in the early 2000s, but also what happened in the run-up to the financial crisis. So answer the question, please. Are we in a bubble or not?
I'm not sure we're in an overall market bubble. I do think we are probably in some kind of a bubble in AI and big tech. And I can take you through why that is. If you want to look at, I was also there in the 1990s. I followed Cisco up to its 250 PE multiple. At the top, biggest company in the world. NVIDIA still isn't quite.
Kathy, and I have to tell you, you're in good company, because Kathy was also doing some writing about this as well.
Exactly. I think to some extent it's a little cheap, not that I haven't done it myself, to compare it to 99-2000, because that was by most measures the most extreme piece of over-speculation anybody has ever seen.
Not the only bubble we've ever seen.
Not the only bubble, but the biggest one.
Right.
It's a bit like, you know, in politics, it's like comparing to Hitler or something. It's just, well, yes, they're better than Hitler, but that's not the point.
An outlier, if you will.
Yes.
Okay.
Yes. So yes, it's certainly, in terms of how does it feel, no, this is nowhere near as overblown as it was in 1999, 2000. At that point, people just thought the world was inviolable. Nothing could go wrong. I mean, it was extraordinary. It was very good looking back on it now. But this is plainly something very different. I think where you get into the question about whether this is really a bubble is it's not totally about the valuation that's being put on Nvidia. It's if you look at their earnings, if you look at their actual fundamentals, where there might well be a bubble is in those fundamentals. Now, I'm certainly not saying there's any fraud, any deception going on, but if you look at quite how fast their sales have increased, and at how much their profit margins have increased as their sales have increased, obviously they've done something spectacularly well over the last year or two. Right. That ain't happening for much longer. Because you can't just keep selling more stuff and charging even more of a markup for it indefinitely. You displace the rest of the world if you do that. I can remember. And sorry, yes.
Well, I was going to go ahead, Carol.
No, it's kind of similar to some of what we talked about with Kathy Wood in terms of NVIDIA can't kind of keep doing this over and over. Why can't it? Like, let's just go there.
Well, okay.
Is it competition? Is it just...
Doesn't it have a moat?
Intel used to have a moat. Compare Intel in 2000 absolutely had a moat. It was an extremely safe, well defended company to buy. And I think from off the top of my head, I think with the increase in Nvidia's market cap so far this year, you could buy 5 Intels.
Wow.
So something along those lines. Don't hold me to it, but it's certainly a multiple number of Intels worth that the market cap of Nvidia has increased by just this year, and we're only in the middle of March.
It's staggering. So NVIDIA and Cisco, go back there.
Yes.
In terms of why that's an important comparison and maybe what it tells you about bubble, no bubble.
Okay, now Cisco is the best comparison, I think, because this was a real company that had been making real money, had been around for more than a decade. It was the obvious picks and shovels play. If the internet's going to grow, you're going to need routers. If AI is going to grow, you're going to need some seriously good chips. And on that basis, Cisco went to a point where it was the biggest company in the world briefly. It's had about 2 weeks in the last 24 years when it's managed to exceed its peak from 2000. Most of the time you were sitting on 70 or 80% losses. Right. That's even though Cisco actually did pretty much as well as people expected it to, and the internet, it's still the dominant router company.
Right.
This has nothing to do with anything done wrong by Cisco. It has a lot to do with how badly the market misjudged what it was fair to expect of it.
So it's just expectations, right? And then the valuation to meet those expectations.
But it's expectations, but it's also trying to extrapolate when you have an uncertain technology that nobody doubts AI could be amazing, just as it was obvious in 99 that the internet really was going to change things. It's not so obvious exactly how much money you're going to make out of it, who is going to come along to compete. AOL appeared to be have a really good moat in 98, 99, for example. Alta Vista was my homepage, as we used to call those things, on my Netscape browser for several years. Google didn't even exist until 99.
This is internet shaming.
So, it is possible to get into a very strong position in a technology that is emerging fast. MySpace would be another one, and lose it. It can happen.
What would you say would be your takeaway for NVIDIA investors, that if they need a lesson from history?
If you need a lesson from history, it's that you need to be very careful about extrapolating growth on the scale they've had into the future. And again, something remarkable has happened, no question. It's fair for NVIDIA to be worth much more than it was, but if you the normal multiples this comes
Brent
time
crude
again,
futures settle at
fair,
$81.92 a barrel, down 29 cents or 0.35%.
not much more than a year, and margins have increased while you've done that. That is because there is some kind of a bubble going on in people desperately buying lots of chips from NVIDIA because they've desperately got to get into AI
just in
before
case.
They lose. And that is the bubble. If there is one, it's in people arming themselves, generally with NVIDIA products, to get into AI. I'm not saying NVIDIA crashes or that it's a fraud or that it's in a bubble in the ways we normally expect. Do I think it could be like Cisco and go nowhere as an investment for 20 years? Yes, I think that's possible.
We got to run. Great thought piece. John Author, senior editor at Bloomberg Markets, Bloomberg Opinion columnist here in studio. Shares of NVIDIA, though, up more than 80%.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Apple will allow European users to download iPhone applications from web platforms for the first time as it moves to step into line with European Union rules targeting big tech dominance.
Citi and YouGov say 1 year ahead UK inflation expectations fell to 3.6% in February.
And will permit third-party marketplaces to offer their own developed apps. Apple shares today, they are up by about 0.7%. 0.2%. Archer Daniels Midland investors appear to be breathing a
Citi
sigh
and
of relief
YouGov
today,
also say
driving the
5 to
commodity
10 year
giant shares
ahead
higher
UK inflation
after its delayed
expectations fell to
annual report
3.5%
didn't
in
deliver the kind of
February.
bombshell financial revelations that some had feared. ADM up now by 4.4%. Oracle after earnings up now by 12%. Oracle posting its biggest intraday gain in almost 2 years after reporting a spike in bookings in its cloud computing business, showing progress in its bid to capture more of the competitive market. The Austin-based company, known for its database software, is focused on expanding its cloud infrastructure business to compete with Amazon, Microsoft, and Alphabet's Google. Right now, Oracle up by 12%. Home Depot is expanding its marketing efforts with a 3-year NCAA deal that will be timed to begin this year's March Madness tournament. The home improvement retailer, which has sponsored college games on CBS for more than 25 years, now adds basketball and about a dozen other college sports for each gender to its advertising repertoire. Spring, by the way, the most crucial selling season for Home Depot. Shares of Home Depot today, they are advancing. Those are some of the top company stories at this hour. I'm Charlie Pellett, and this is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio and Television.
It is Bloomberg Business Week. That's Carol Massar. I'm Tim Stenivek. Let's get a check of the latest world and national news. We got Amy Morris in the 991 newsroom. Hey, Amy.
Hey, Tim, the special counsel who investigated President Biden's handling of classified documents still testifying before a Republican-led House panel. Robert Hur ultimately declined to bring criminal charges against the president and says the facts stop short of finding that he willfully retained classified material. His public testimony will be held before the House Judiciary Committee. It's led by Republican Jim Jordan of Ohio. In what may be a major step toward the end of violence in Haiti, the nation's acting prime minister is set to resign. The Caribbean Community Organization, or CARICOM, announced that Haiti's Prime Minister Ariel Henry will step down. Guyanese President Aaron Ali made that announcement at the conference in Jamaica.
We acknowledge the resignation of Prime Minister Ariel Henry upon the establishment of a transitional presidential council and a naming of an interim prime minister.
So Henry's resignation will be effective upon the creation of that transitional council. Then they will appoint an interim prime minister and then prepare for elections. Looks like Donald Trump was looking to sell off Truth Social last summer. Sources tell the Washington Post Trump approached Elon Musk asking whether he would be interested in buying the social media network. The overture did not lead to a deal. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Carol and Tim.
All right, Amy Morris, thank you so much. I don't know if Amy's thinking about where she might go for this summer, or Charlie Pellett, or you, for instance, Tim.
Oh, totally, yeah. You know, we're talking about this because there's a great article in the Bloomberg Terminal. It's one of the most read. It's about how the Hamptons market is already heating up despite the fact that we are months away from the summer. And it comes as recession fears have ebbed. So if you have a spare, I don't know, $21 million lying around, Carol, there's some pretty good stuff on the market right now.
What's kind of cool, too, is homeowners are listing their properties for sale in greater numbers than they were a year ago, and would-be buyers are pouncing. So in other words...
So that inventory supply and demand problem, right?
Well, homeowners are willing to list at this point, and then you've got would-be buyers who are ready to. What's interesting is if you go back, about a year ago, it was a lack of inventory and rising mortgage rates and worries about the economy really froze purchases if you take ourselves back about 12 months ago.
Yeah, our own Jennifer Epstein writing about this, and she interviewed Tal Alexander over at the Brokerage Official, who said in 2023 there was a lot of talk about a looming recession. It never came, and I think a lot of that fear is gone. So if people are feeling better about the economy, of course, they're willing to shell out the big bucks for some of these homes.
Here's a listing actually that hit last month, 171 Great Hill Road. It's in Southampton. It's about 5,200 square feet. It's on almost 2.4 acres.
5,200 square feet.
Sorry, like 5,200 square feet, almost, or more than. The Corcoran Group is marketing the property. It's got a swimming pool, a tennis court, and it abuts a nature preserve.
And how much? $7 million?
Yeah. Okay. Priced at almost $7 million.
Okay.
Yeah. 6.9995 if you want to be exact.
Okay. There's also one at 134 Herrick Road in Southampton. That one's listed just shy of $22 million at 21.95, 7,500 square feet.
And it says inventory still scarce. There's definitely more buyers out there than there are real sellers. So if you're interested, you better get moving because those open houses apparently are packed already.
It turns out it's also a good market for cash buyers.
It's always a good market for cash buyers.
You know?
Stop the presses.
Turns out.
It's a good market for cash buyers. All right, everybody. That's our one more thing on this Tuesday. For those watching on TV, the close is up next. Check that out. Bloomberg Business Week, though, continuing on radio, YouTube, and Bloomberg Originals. We're going to continue talking about that CPI report.
Yeah, also speaking of economies, how's the economy doing in Ireland, home to many multinationals? Is it still attracting them? We're going to talk to the man whose job it is to get CEOs to invest in the country.
And get ready, everybody. Vulture capitalism. What is it and why you should care? That's coming up.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
When it comes to inflation, sticky doesn't always mean overheated. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Alex Steele. Welcome back.
Thank you.
Good to see you.
It's great to be back.
Were you in a Boeing? Are you good or?
No, I definitely chose an Airbus.
Oh, yeah. Okay. We'll talk about that throughout the hour as well. We're kicking you off right here to the closing bell in the U.S. I got to say, for a warm CPI number, I'm very surprised by the amount of buying that we're seeing within the equity market. And I wonder if it was a little bit of sell the rumor, buy the news, or if we're seeing some stops triggered or something, because the S&P is up over 1%, NASDAQ 100 up 1.3%, tech really outperforming. 10-year yield, we'll get into this later on in the show, down 5 basis points. The 10-year auction was kind of meh, and we get $30 billion worth of 30-year notes tomorrow as well. And Bloomberg Dollar Index reviving a little bit here, up 0.1% once we got the sticky/warmer CPI numbers, Romaine.
Yeah, Alex, I think my mission right here on this show is to finally make you a believer in this equity market rally. Of course, how much is left in the tank for this bull market? That continues to be the parlor discussion from Wall Street to LaSalle Street, from Coconut Grove down to Tampa, St. Pete. Bank of America strategists, that includes Savita Subramanian, seeing little evidence to support all those worrywarts out there who say the stock market has risen too far too fast. She has actually raised her earnings per share estimate for the S&P 500 to $250, up from about $235. That doesn't seem like much, but that ties with BMO as well as Deutsche Bank for the most optimistic among strategists tracked by Bloomberg. Subramanian just last week also raised her S&P 500 price target to 5,400. That's a 5% increase from current levels to reflect that stronger earnings growth. Meanwhile, Mike Wilson at Morgan Stanley is tilting to the opposite direction, telling Bloomberg Surveillance Radio he's sticking to his year-end S&P forecast of 4,500, which is about a 12% drop from yesterday's closing price.
Exuberance is pretty high. Now, that doesn't have to end in tears, okay? Leverage isn't always bad. But, we have a situation where people are reaching for risk because, there's FOMO. We're probably a little bit more cautious than some of our peers. I think a lot of folks, all they've done is raise their price targets based on higher multiples, and we're not willing to do that.
Mike Wilson speaking a little bit earlier to this, but we want to start off the show with that monthly update on the Consumer Price Index and inflation report for February, that when you combine that with the blowout January reading, more evidence that stubborn inflation is going to keep the Fed wary of easing policy too soon. Alex, you were just staring at this chart behind you so intently here. What is it telling you?
Well, they were trying to fix the date, but guys, the date's actually okay, so that was my bad. But this chart is why I'm still skeptical of the rally. So you're looking at the white line is the 3 months annualized rate of core inflation for CPI, and the blue line is the 6 month. And this comes from our team over at eCan Go. So this is where you can find that chart. And what's important is the trajectory here. We're moving higher. Sticky, warmer, I don't know, you name it. And then you sort of layer in things like goods inflation that will no longer be necessarily a disinflationary tailwind. And what do you got? You got something that's going to stick around and potentially higher for longer for the Fed, Romaine. I still don't get how that makes sense for a huge bull market in the equity market.
Yeah, I mean, you make a good point here. And we talk about all the reaction that we've gotten out of that CPI report this morning. Investors, as you can see by the green on their screen, aren't necessarily raising the alarm yet.
I think the big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly.
This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%.
It is coming down. But it's going to take some time, and that's okay. But I don't think there's anything here to alarm the Fed or anybody else.
I do think things are moving in the right direction in terms of prices.
But it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
Inflation's going to come down slowly. And I think that's fast. I think that will be fast enough for the Fed to start cutting in June.
So far, I think they want to cut, and we expect to see that in the May or June timeframe.
All right, some of the great voices we've had on Bloomberg Television today reacting to that CPI report, and the voices just get better. Nathan Sheets joining us right now to kick us off to the close, Citi's global chief economist. And Nathan, it seemed we came into this year, there was a very clear narrative of disinflation, but now we've gotten two reports to start the year for January and February that seem to suggest that maybe that narrative needs to be rethought. What did you make of it?
Yeah, I think we're seeing why Jay Powell indicated in his January press conference that he wanted more confidence that inflation was coming down before he started to cut rates. And as you say, the January CPI report was just downright ugly. I'd say today's numbers are probably a notch better, especially in the super core non-shelter services sectors, but are still higher than what the Fed would like to see. And I think that, we're implicitly debating here whether this resilience we've seen in the CPI over the last couple of months, whether this is seasonal adjustment issues and the like and is going to dissipate, or whether it's signaling something a little bit more worrisome. And I think coming months are going to have to resolve that.
Yeah. Well, that's what I'm curious about here. I mean, it seemed that over the last couple of years, what was driving inflation, and for that matter, disinflation, seemed to be relatively apparent. Do you find it a little bit harder to read the tea leaves now as to what's really driving these moves up and down?
Clearly, the disinflation that has occurred was primarily driven by goods prices, and we made a lot of progress there. There's a little bit of a bounce back in this report, but still low inflation for goods. But in parallel, services inflation have been stubborn. And we have been worried for quite some time that the disinflation in services prices is really going to require some loosening of the labor market and further easing of wage growth. And I think bottom line, that disinflation in the services sectors is likely to be a slow slog and a challenge for the Fed. Now, I don't think that preempts or means we won't see rate cuts this year, but it does mean that the Fed's going to be cautious. It's going to wait a while, and then once it starts moving, it's going to move cautiously.
Which is why the equity market rally continues to be a bit of a head scratcher in that, because there is a different two-sided risk now to inflation, right? Which makes me wonder, how much can the Fed cut before they stoke inflation, considering that things look okay?
Yeah. The equity market, the best explanation I can see here is that these numbers we got this morning were challenging, but not as bad as many had feared. And then the underlying story, and I have this discussion with my colleagues who are equity strategists regularly, the underlying story is earnings growth has been very robust for U.S. corporates over the last several years. And that engine of support in the corporate sector remains pretty strong. And as long as you continue to have that robust earnings performance, I think we're going to continue to see a meaningful move forward in equity prices.
Well, Nathan, that's interesting because one of the reasons why Bank of America is more bullish on earnings is because of a reinvestment cycle from big tech companies. Do you guys see something similar? And I relate that back to CPI, because if you get a huge reinvestment cycle, isn't that just going to push up demand and then push up inflation, and then we're in a very different scenario?
I think you tell a story of a robust economy.
Okay.
The question is whether that robustness brings inflation that's uncomfortable for the Fed, or is broadly consistent with this cycle of gradually bringing inflation down. If you look at core PC, we're a little below 3, from the upper 2s to the lower 2s. And I think that there's still enough tightness in the economy that that's a likely outcome. But nevertheless, as you highlight, the economy is solid. The consumer has been strong. And if that's further reinforced by a strong investment cycle, maybe the Fed is going to have less scope to cut than many of us think at the moment.
Yeah, good point. Nathan, always great to talk to you. Nathan Sheets, Global Chief Economist over at Citi, helping us kick you off to the close here on this Tuesday afternoon. Coming up after the break, a big rally in stocks, but a big sell-off in bonds. A lackluster 10-year Treasury sale may be to blame. Mike Cudzill, Senior Bond Portfolio Manager at PIMCO, joining us in just a bit.
All right, plus you get a read on the real economy. More on how inflation is affecting the U.S. manufacturing sector. Nick Pinchuk, CEO of the toolmaker Snap-on Incorporated, going to get the read from the ground. Romain.
And shares of IBM right now at an 11-year high, rising on positive commentary from Bank of America. We're going to talk to the analysts behind that call. All that and more coming up in just a bit. This is The Close on Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
On the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Treasury is on offer today. You got a sell-off that started after those CPI numbers, and the weak U.S. Treasury auction for the 10-year really didn't help matters at all. The $39 billion sale drawing weak demand despite yields rising into that bidding deadline. Joining us now, Mike Cudzill, PIMCO Senior Bond Portfolio Manager. Hey, Mike, we got the 3-year yesterday, which was meh. We got the 10-year today. Nah, we have the 30-year tomorrow. What did we learn over the last 3 days here about the demand for treasuries?
Yeah, I think we're learning that we need a little bit more of a risk premium in the Treasury market in order to absorb this larger supply in auctions. I think, if you saw by the inflation data today, inflation's not coming down in a straight line. That's a little more term premium associated with fixed income markets, a little more unknown uncertainty as to where inflation lands, a little more unknown and uncertainty as to the Fed's reaction function and exactly their path. And so all that means, a little bit more a little bit more premia in fixed income and in bond markets, and that's what we're seeing today.
What's interesting, though, is that, say, yesterday, the action was really in the front end, right? And then today, it's pretty much all across the curve. Did what we learned today from the CPI really mean higher for longer, which really means higher 10-year down the road?
I think that's it's an unknown, and I think it's a possibility. I mean, I think the economy's been quite resilient to these levels of rates. It's been regurgitated for some time that these rates are restrictive. It's really hard to see these rates necessarily restrictive, whether it's in levels of growth or whether it's in levels of inflation. And so I think the jury's out on how high rates need to be for how long, and just where the Fed can cut to. So I think that's an open question. And I think it's one that markets are starting to process, and more data, more time will certainly help us answer that question.
Well, how are you positioning around that question, Mike? Obviously, you want to be as much out in front of it as you can possibly be here. There's already been a lot of activity, as you've seen, probably on the longer end of the curve, at least relative to the activity maybe that we didn't see a couple of years ago.
Yeah, I think first and foremost, we're positioned on the intermediate part of the fixed income market. I think that's where we find the most value. You can get yields there of 4.5% to 5% in U.S. Treasuries. You can get with some spread product, 5.5% to 6% returns. You don't really need to take a whole lot of duration risk. You don't really need to take a whole lot of excess credit risk in order to get some pretty decent returns, and returns that can rival those of equity markets. I just want to take a step back. If you look at what happened last year we got the economic data wrong. It was the most called for recession in U.S. history that never happened. We thought the Fed was going, the markets thought the Fed was going to cut. They hiked. And then finally, issuance was higher than expected. So you got all three legs of the stool wrong, and yet fixed income returned 5.5% last year. Mm-hmm. And I think it's a really good reminder that starting yields are really important for future returns. And so I think the yields on offer today really attractive, and again rival those of equity markets, and we're encouraging investors to look at fixed income and increase allocations to the asset class.
So when you look at that gap in basically what is deliverable on the yield side in equities versus what you get in the intermediate part of the fixed income space, Mike, do you anticipate at all that any actions the Fed takes this year, whether it's multiple rate cuts or even that rate hike that some people have started to talk about, would that change the dynamics at all for you and your positioning?
Yeah, I mean, it could change a little bit, but in terms of an asset allocation perspective, again, if we are in a situation where we take hikes out or take cuts out or even potentially put hikes in, I think that's a scenario where, if you think about fixed income markets right now, we can sell off 75 basis points, and you'll have a zero return in fixed income. I think if we move 75 basis points higher in yield, that will really weigh on risky assets. So even from an asset allocation standpoint, we find fixed income really attractive. And again, if we just sit here and rates don't really do a whole lot, you'll get that 4.75%, 5% return on Treasuries, and even more than that with some spread product in your portfolio. So really a lot to like about fixed income relative to risky assets.
Yeah, definitely a case to be made here that the real Goldilocks moment right now is playing out in fixed income. Mike, going to have to leave it there. Mike Kudzil over at PIMCO, and Alex, he was just talking about the possibility of maybe we get those 3 rate hikes that the market is priced in. The market's kind of found some sort of baseline right around that sort of 3.5 rate cuts for the year here. That hasn't budged much despite the data, and maybe that changes. What is it, next week we get the Fed meeting?
Yep, next week. So. But it's just also, is it really about when they start, or just how much they can actually do before? Is it going to be 3, 4, 5, 6? Is it going to have to be a little less before you get inflation really picking up?
Yeah, I do think this timing does matter, right? The start, right? Because then you get to this question of how do you squeeze, the election, but also how do you squeeze 3, 4 rate cuts if they're starting, say, in August or something, as opposed to, now.
Right, and and then that's where I think the election can also fit in too, with that at the same time. And also, it's interesting that you're still gonna. I wonder if this also means that the money in money market funds is just gonna stay there.
Yeah.
Because if you wind up having these nice coupons that may not be going away anytime soon, why are you going to move that money out? That money might not belong to anywhere but those money market funds.
Yeah, and that's kind of to Mike's point. It's like you can get a pretty decent yield for relatively low risk in a lot of areas of this market right now. We'll go back to the equity market, of course. That is the risky market, and it is a market that right now flirting once again with record highs, and IBM getting in on the party. Those shares now at their highest level in about 11 years. This after a Bank of America analyst said that he expects substantial growth from the company. It's our top call, and it's coming up next right here on The Close on Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we can start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start with the big one, Oracle. William Blair upgrading the database software maker to outperform. This on the strength of that earnings report and sustained growth acceleration led by AI and differentiated cloud offerings. The analyst adding that much of the AI benefits, well, to the company's revenue are still on the way. Investors trying to front run that, pushing the shares back up to a record high, 12% on the day. Next in line, Carvana. Jefferies upgrading that stock to hold from underperform, saying the used car dealer has actually made some operational changes that are improving unit economics. That should help drive Carvana up the road to positive cash flow. The price target almost tripled to $85 from $30, though. The shares on the soft side today down about 0.4%. And finally, let's take a look at IBM. The analysts over at Bank of America say they were reassured after a discussion with IBM CEO Arvind Krishna. Analyst Wamsi Mohan maintaining a buy rating on the shares with a price target of about $200. He says the turnaround at IBM continues with a defensive portfolio, attractive dividend yield, and underappreciated AI capabilities. Those shares getting some appreciation today, up about 3% on the day, and those are some of our top calls. We do want to stay with IBM and stay specifically with that call, the man behind it, Wamsi Mohan, joining us right now to talk a little bit more about it. And Wamsi, it's interesting too when you look at the share performance of IBM, when you look at its sort of legacy competitors, its direct competitors, the stock has certainly kept pace. What it has not kept pace with are all those other AI darlings out there. When, if at all, do you expect that to change?
Yeah, thanks for having me. It's a great point. Look, I would say that IBM has had a big turnaround in its performance. If you look over the last 2 decades, close to which we've followed the stock, revenue growth has been a challenge for the company. Since CEO Arvind Krishna took over, you've really seen a lot of portfolio optimization. And that portfolio optimization has been both M&A in terms of buying assets that are growthy like Red Hat, at the same time divesting things that were much lower growth like Kyndryl. And in balancing all of this, what the management team has orchestrated really is the ability to drive sustained growth on the top line. Mm-hmm. Now, that sustained growth is also generating very strong free cash flows. And those cash flows are being used to support both the dividend and incremental M&A that is then driving incremental growth as well for the company. So we're very early in the stages of monetization for some of the things that IBM is doing, including AI, where they've got several $100 million book of business currently.
Right.
But there's tremendous amount of runway on the AI, especially in terms of consulting. So we think there's a huge opportunity here.
Do you feel that Krishna and his team are articulating that AI vision well? Because as you know, while on paper the numbers look relatively decent, but as you know, what's captivated folks with an NVIDIA or an ARM or even a Supermicro is that narrative and that story, which those CEOs are certainly telling.
Yeah, absolutely. Look, I think the management team is doing a phenomenal job over here at IBM, right? It's not about over-promising. It's about the realization of capabilities in AI through both partnerships as well as a very broad and very capable consulting organization that can drive this growth. So part of the growth is coming from their own software assets, which is watsonx, and part of the growth is going to come from these partnerships in consulting, helping enterprises. This is their core strength. They have huge, deep benches of knowledge, domain knowledge that they bring to these enterprises and help them really make this journey to use generative AI to become more productive, right? One of the things that CEO Krishna noted in the call that I hosted with him yesterday was that there's about maybe potentially $4 trillion of productivity that can be realized through AI from now through 2030. That's a huge number, right? Like, so we're in the super early stages of monetization. I think the management team is doing a phenomenal job articulating what the opportunity is over here for the industry as well as for IBM, and how they've kind of partnered with a lot of different providers of AI technology, and using their consulting resources will be able to help enterprises reach some of those productivity goals.
Wamsi, it's interesting. I look at a chart of, say, Dell, IBM, and NVIDIA normalized over the last year, and like Dell's pretty much tracked NVIDIA. Like, it's like the old guys are sexy again. And I'm wondering, like, it feels like everyone kind of missed it. IBM, Dell, they're the interesting ones now.
It's in some ways a hardware renaissance, Alex, right? Like, when you look at the arms dealers of AI, what you're seeing is that the semiconductor companies clearly have taken the lead in monetization. But that semiconductors ultimately land in some kind of hardware. And so the server makers that you mentioned, for instance, Supermicro, Dell, these players have been sort of the second leg of driving that realization of AI revenues within their numbers. And those numbers are starting to inflect higher now. And then we're going to move to a third stage where, as enterprises beyond hyperscalers start to implement this, that's when you're going to need a lot of the consulting work, and IBM is going to excel over there. So we think this is kind of a multi-stage process, multi-year process, and there's a lot of runway for all these companies here.
All right, Wamsi, thanks a lot. Really appreciate it. Wamsi Mohan of Bank of America joining us there. Hardware renaissance remain.
Yeah.
Hardware renaissance.
I mean, I don't know. I think he's onto something. I mean, you know, I don't know if that's going to IBM's going to be the beneficiary of that, but certainly you hear there's some other analysts as well.
Well, yeah. I mean, all of Bank of America is saying that it's really going to be the tech guy spending that's going to fuel a lot of the reinvestment cycle, and everyone going to be contributing to that in the same way, particularly on the infrastructure, hardware, and cloud side.
Is that going to contribute to inflation as well?
I don't know. That wasn't said in the note. All right, let's ask Nick Pinchuk. He's the CEO of Snap-on. We'll talk to him next. This is Bloomberg.
Now, women on average have about a 30% lower, I guess, amount of money saved up for retirement compared to men.
Yes.
So what are you doing about that?
Yeah, so we launched a campaign called Retire Inequality. And we do know that women retire with 30% less. Women make 83 cents on the dollar. And so there's a couple of things that we're doing. One, it's having this conversation and making sure that we all are aware that there is a gap. By the way, women live longer than men, so longevity risk is a real factor. Secondly, it's about making sure that we are talking to women about what can you do differently. And so whether that's negotiating pay and what are some tools that are out there, making sure that you take the time to negotiate, because we know women do not negotiate as much as men, which puts you at a disadvantage to start. But then also along women are securing their own retirement, and that is part of their retirement plan. We're having much more conversation around guaranteed income as well. And so ensuring that we understand what are the nuances for women. If you think about COVID, 2 million women exited the workforce. They did not continue to contribute to their 401k or 403b plan. And so how do we make sure, as a matter of policy, as a matter of engagement, that women can have an opportunity to catch up, that women can understand that if you exited the workforce and now you're back, that that's 2 years of compounding that you were not able to take advantage of, and how do we continue to make sure that we're educating them and giving them the tools that they need to get back on track.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. So let's get to more of the parts that make me worried. Can we do that a little bit?
Sure thing.
So about the inflation thing, in the T-Live blog that we have, once the numbers came out, one interesting stat stood out to me, that the 2% annual rate of inflation would imply monthly price rises of just 0.17%.
Wow.
We're a good chunk of change away from there.
Yeah.
And I just wonder how hard it's going to be to get to that level.
I think it's going to be a lot harder given the last two reports we've got. But remember, this was the conversation. A lot of people said this, that last mile, so to speak, was going to be bumpy. Maybe that's the bumpiness we're seeing.
But in the meantime, the NFIB, which is one of my favorite indicators, was saying that it's a 9-month low, but about 39% of small business guys see business conditions getting worse, and earnings weakened, high prices, high rates, like that is having a heavier impact on the small guys.
It certainly is, but then the big guys are still churning, pumping out cash like it's no tomorrow. And you've had obviously a lot of street analysts on the street already upgrading not just price targets, but actual EPS targets for the S&P as well.
It's totally
tale of two cities.
That's why you get confused.
Yeah.
You can't blame a girl.
Yeah.
All right. Well, the numbers that are rising for inflation, it does raise the question about how many Fed cuts can we actually see in this cycle. So we wanted to go to somebody on the ground, manufacture stuff for consumers as well as industrials and companies. Nick Pinchuk is the CEO of the tool and equipment company Snap-on Incorporated. They make power tools. Nick, so great to see you. We have the inflation story and we have the demand side. Let's start with the inflation first. Where do you see prices that are still sticky, and what for you are prices coming down?
Okay, good to see you. By the way, I got to thank you for wearing Snap-on red. I feel really at home.
Anytime, Nick, anytime.
It's a good thing. Look, if you're talking about the company seems to be pretty solid. The difficult inflation, the turbulence associated with inflation and supply chain is deeply in the rearview mirror. There's no more spot buys. So companies all over, I think, big and small, are okay with inflation. You kind of said it before, though. There's a big difference between the larger companies and the smaller companies and the financial economy and the grassroots economy. If you look at the National Association of Manufacturers data, their optimism is flat, has been flat last quarter, but the big companies are rising. And that's because everybody's saying, hey, it's soft landing. The Fed's going to, sometimes cut rates 6 times next year. That's good for the big guys. The small guys are going down.
Yeah.
Getting less confident. And part of the reason is you can see this. I was just with the people at work, mechanics and our franchisees in places like in the last month, I've been in Nevada and the Midwest and the East and the South, and they all say the same thing. Boy, our businesses are great. Our salaries are going up. We don't like inflation, though. When I go in and I buy food, I don't like it that I'm paying more for milk. I was pretty shocked myself. I just had a burger and a large fries and a large chocolate steak this afternoon.
Yeah.
I couldn't believe how much it was. Now, I don't burger all the time. I'm practicing girth control. But these...
Nick, that's true. Yes, 100%. I mean, like, I did dinner out in New York is insanely expensive. Do you get the sense, though, that if all of a sudden we do get those, say, 6 cuts from the Fed, that demand's going to shoot right up, and that inflation will then peak right up?
No. Not well. Well, I think for big companies, it'll be good. People will invest. As you said, I think we're the arms dealers of critical solutions, so I think we'll do okay from big companies' point of view. And our big company business, selling critical industries to larger industries, are doing great, up double digits for 4 straight quarters. But if you go down to the grassroots level, for mechanics and other people who are in factories, they are troubled. And what drives their consumption has to do with, 1, the confidence they have and where they've been, and they've been through the pandemic, they're confident. 2, the work they're seeing, and their work is great. But 3, what they're seeing in the environment. They pay much more attention to the physical, sort of the general environment than I think companies. And what they've seen since October is a deterioration of that. Second war. More chaos in the border, a rising of the chaos in the border, the worry about the Red Sea, the election itself. Everybody's looking at the election, and 80% of Americans are saying, hey, if the 80% say, boy, this election it's possible that it's going to come out badly for me. They think who's ever elected, there's going to be a new sheriff in town. They're going to make changes. A lot of those changes are going to be unwelcome. They don't like it. So what happens is you have people in the grassroots who are cash rich. Yeah. Their salaries are going up. But their confidence poor. And so what happens in those situations is they pivot towards shorter payback items. Yeah. They aren't unintelligent. A lot of people characterize them as they're going to overextend themselves. That isn't what's happening. They're actually pulling back.
But Nick, I am curious sort of what turns this around. I mean, you've been doing this for a long time, so you've seen these various business cycles and political cycles for that matter as well here. What sort of brings that confidence back en masse?
Well, I think one is you have to clear up some of the difficulties, or they have to make themselves through it. It happened, Romaine, it happened in the beginning of the pandemic. The pandemic occurred, and this is what happened. Repair shops kept humming because transportation is critical. Everybody ate. You need trucks to eat. They need to deliver stuff. You need warehouse workers. So those factory workers, those guys kept working. 2/3 of America kept working all through the pandemic. But they pulled back some and focused on shorter payback items. In Snap-on terms, wrenches and power tools and so on, and didn't buy 350 billion bit diagnostic units that will pay back eventually. And so that's what they did. But then as the pandemic kept going and they realized they could survive it and that society was going to survive without turbulence, they started to open up. Yeah. This happened also in the great financial recession. This isn't our first rodeo around here.
Well, but I am curious, though, Nick. I don't want to run out of time here. But then when I look at your past earnings, and at least when it comes to like the independent types of shops, definitely in the auto space, you saw service hours were higher. You did see, if not a healthy business or not a growing business, certainly a healthy business, I should say, for some of those names.
Well, wait a minute, though. I did say cash rich.
Yeah, okay.
In other words, you see, you're equating the financials with their attitude. It's not that they were cash. The Journal had an article in the Great Financial Recession. Economies glum, repair shops hum, and so it was. They were cash rich, but they'd keep buying things, but they didn't want to get themselves out in trouble because they didn't know where the world was going to be in 8 months. It's kind of interesting because customer sentiment and customer confidence seem to be going in the opposite. In the summertime, when it was lowest, these people were the most robust. Yeah. Now it's going up a little bit, still 20% below pre-pandemic levels, but they're more troubled by this. And part of it is every day they get up and get that bad news for breakfast, and they think, gee, I'm not sure what's going to happen next time, so I'm not confident in my future. It's not actually the economy itself. It's the confidence in the economy.
That's a great point, Nick, and a great place to leave it. Always great to talk to you. Nick Binchuk, the CEO and chairman of a Snap-on, of course, out there in the great state of Wisconsin, there out in Kenosha, beautiful town. But he's a great voice, right? Because most of their customers are pretty much smaller, independent businesses, so you get a much better read, or a different read, I should say, on economic conditions.
It's like an on-the-ground kind of read. But this was also kind of my point, is that if then things do stay okay and you get Fed cuts, is that just pent-up demand, cash rich? So then do you do stuff with that cash? And does that wind up fueling growth and then fueling inflation?
Well, that's why I asked him about what brings a turnaround here. Because, I mean, he's seen these cycles before, and we've gone to this kind of dour pessimism. I mean, we went through that, I mean, you know, not to get too into politics, but we went through the same thing right when Trump got elected, right? Remember, there was all this dour, oh, it's going to be awful, and things turned out, at least in certain pockets, turned out to be pretty well, you know, if you're an investor. So maybe we get that again here.
Yeah, I don't know. I find it really interesting.
Yeah. By the way, I did not get the memo on the Snap-on Red there. Did you?
Only the cool kids get it.
Just messaged you on there.
The cool kid, yeah. We were just typing. That was pretty much that. Did you get the Southwest though? Maybe.
I don't know. I don't
uniform?
know if I want to be wearing.
Is there a uniform
wearing their colors there? I don't know. I think they just wear T-shirts and flip-flops. Maybe that's why the shares are down 15% here on the day. The biggest drop we've seen in Southwest Airlines in about 4 years. This after the airline announced that it's cutting capacity and halting hiring. We're going to talk about some details behind that announcement. That's our stock of the hour, and it's up next. This is The Close on Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
All right, it's time now for our stock of the hour, a closer look at Southwest. The shares right now having their worst day since 2009. The airline earlier announced plans to cut capacity, halt most of its hiring, and review its spending plans. Now, some of this may be tied to some of the issues going on with Boeing and, well, the lack of airline deliveries, but there are bigger issues out there as well. Abigail Doolittle joining us right now to talk a little bit more about what's really driving this down. And Abigail, I mean, at first blush, you would think, okay, some of the issues with Boeing and the fact they're not going to get the planes that they were supposed to get delivered would certainly have a material impact. But when you go through the numbers that they're laying out here, this seems like it goes a lot deeper than just airplane deliveries.
Yeah, much deeper. And it's interesting because the stock down so much since 2009, as you were saying, I was thinking this really doesn't match the idea that it has something to do with the Boeing not delivering as many planes as it was expected. So this has to do with them basically cutting revenue. They've cut their revenue guide for the current quarter. One look at it is the RASM, so it's revenue per seat mile flown. They're now looking at flat to up 2% versus the guide they gave just a month ago of up 2% to 4.5%. So the ranges are completely different. This really tells us that over the last month, fares have come down. They've had too many planes in the air. They're talking about it from the standpoint of lower than expected close-in leisure passenger volume. So that's basically within 21 days of the trip, they're not seeing as many people. The couple trips I've taken where I've done it days before apparently hasn't, well, I actually haven't flown Southwest, but I do like to travel that way. But apparently a lot of other people right now relative to Southwest are not. Now, relative to capacity for this quarter, it's going to increase 11%. The prior plan had been for up 10%. But if you think about that, more capacity is not good for them right now because it creates the same problem where there's going to be less revenue. So in a way, if we back into Boeing, if they do only get the 46 planes versus the 79 planes that they had gotten the year before, it could help them because they are going to have to cut capacity. So that's over the long term, it could be.
Well, except that the new planes that are going to come on are so much more fuel efficient that it actually saves them money in the long run because they won't have to pay for the fuel in the same way. Now, what's interesting is that there was a JP Morgan Secretary Airline Conference, right, today. Are other airliners, particularly either the discount or the big guys, echoing something similar to what Southwest is saying?
Not really. It's interesting. It seems that Southwest is its own airline relative to what it's talking about.
Alaska, it's its own airline.
It is definitely its own airline. I've not been on it in years. Why? Have you had an experience?
No, just back in the day, Southwest, Spirit,
Yeah, exactly. I flew a lot of it, not anymore. Well, right now at least. But Alaska Airlines, they're the surprise winner, an upbeat outlook. Their loss, the guidance for the loss was less than half of what was expected. So that's really a better guide there. American Airlines, their bottom line for the second quarter, talking about what you're saying about fuel, increased considerably. So the look for EPS was a little bit light there. And then Delta just holding.
All right, Abigail, thanks a lot. Really appreciate it. Bloomberg's Abigail Doolittle joining us there. See, my problem remains is I want to pay back to the plane airfare for front of the seats.
Yeah.
How can I do that?
I have no idea. You're asking the wrong guy.
Because that's what I want.
I've never been able to figure out the airplane game. I just pay whatever they tell me to pay, and I just sulk about it later.
So, right, no fair.
Yeah.
But I don't want to do that.
Yeah.
I want to pay cheap fares for fancy service.
Okay, I don't think that exists.
Yeah, but I'm working on it.
Here in the United States of America.
No, that's my thing. All right, coming up, we're going to continue to count you down to the closing bells. You got Rich Weiss. He's American Century CIO of Multi-Asset Strategies on this really positive market day despite warmer CPI. This is Bloomberg.
Market on close imbalance 2.9 billion to the sell side.
stocks would mean own, given their super concentration in the index already. But we prefer the relatively attractive valuations in two areas that have been beaten up over the last year, 2 years, 10 years. We're talking small cap stocks, which are going to have their day in the sun again as this market continues to broaden out, and potentially REITs. Interest rates coming down eventually, REITs attractively valued, arguably with some decent yields now.
I'm curious about on the small cap side, though, because I mean, it seems like for a while we had started to see more outperformance, at least if you go by the Russell as a metric here. But that seems like it kind of flipped a little bit too. There's a lot of folks that look at those names and they're still not seeing whether it's the growth or really just, I guess, the sense of safety. And I'm wondering what would change that. Do you need better economic conditions, or is this just simply go out there and try to find some sort of, do your bottom-up research and find just an individual stock?
Hey, first and foremost, it's a relative valuation play. So whether stocks as a whole are going up or down, we think you're safer on both sides of that with small cap relative to large cap. But to your good point, any kind of slowdown in the economy is certainly going to hurt all stocks equally. But a lowering of interest rates takes a lot of the stress off of some of those smaller companies. Again, we think they're safer in any downturn.
All right, Rich, always great to talk to you. Rich Weiss over at American Century, helping us count down to those closing bells. We're just about 3 minutes away from those bells, Alex. And, it's interesting. Everyone keeps talking about small caps and the promise, and he mentioned REITs as well, this idea that the worst case scenarios that have been priced in for cyclical names and for real estate names, maybe that's behind us, but that still doesn't mean he's bullish on the broader market.
Right, but also the idea that if there is catch-up potential, it's not going to come from the Mag 7 or from tech. It will come from things like small caps and REITs. But again, like how and when and what does that wind up? Do you need cuts for that to wind up materializing is my question.
There was a great, the folks over at Bloomberg Intelligence did a great report on this, and Michael Casper, I think it was at the end of last week. He talked about the lack of themes, right? You think about what's been driving sort of the S&P or the large cap space in this market. It's been those big themes, AI or GLP-1s, and basically they're saying, look, when you look at small caps, you don't really have that coherent theme.
Yeah, exactly. Yeah. And it's funny you mentioned that in terms of themes, because I like to come into the day with like, what are my questions today? Like, what are the broad themes that I'm looking at that I have questions on? I don't know what mine are anymore. Like, it's sort of like, now what? Like, everything seems to be a nothing burger and equities keep going higher. So now, ...
Well, they're certainly going higher here on this day, 5,177 and change on the S&P 500, a record high as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele. We're counting you down to the closing bell, here to help take us beyond the bell. It's a global simulcast. We're joined right now, as you are every day at this time, by Scarlett Fu in our television studio, Carol Masser and Tim Senevic in our radio booth. Welcome to our audiences across all of our Bloomberg platforms on what looks like it's going to be another record-setting day for the S&P 500.
All I really want to know is, can I have a side of fries with the nothing burger?
Oh, gosh.
Yes, maybe cheese fries.
Hey, listen, you know what? Yeah, we do have maybe a record close, but small caps really not partaking in this run-up in stocks. It's definitely some of the bigger cap names that we're seeing in this trade.
And also not seeing a record as we speak now on Bitcoin, though the fact of the matter is it has been record day after day, still above $71,000 per Bitcoin, up a cool 70% so far this year, Scarlett.
Okay, so small caps not participating, big caps not participating, but you do see the credit market not really missing a step because corporate bond issuance is pretty rock steady today, even after the inflation report showed slightly hotter print than expected for the month of February.
But obviously, big tech outperforming, and I love tying this into the Bank of America note that we got earlier today about earnings, is that the big guys like a Microsoft and a Google and a Meta and Amazon, they're going to be spending a lot of money on CapEx as a reinvestment cycle. Now, that is a fundamental thesis to why some of these names will be going higher. There are a lot of beneficiaries of that kind of money, Romaine.
Yeah, but the question, though, is how widespread is that going to be, right? I mean, that's been the story for a while for those large cap names, and I guess that's great if we can continue to sort of have the market being driven by those names, but where's the broadening out in that spending?
Maybe there isn't. with the small caps.
Seeing Bank of France's Villeroy says that we're winning the inflation battle, and the ECB is in broad agreement to cut rates in spring.
This Tuesday afternoon, a Dow Jones Industrial Average.
The Bank of France trims 2024 GDP forecast to 0.8% versus 0.9% seen previously, and forecasts 2025 growth of 1.5%, up from 1.3% previously, and 1.7% in 2026, up from 1.6% previously. And the French Central Bank sees 2024 HICP inflation of 2.5%, 1.7% in 2025 and 2026.
I know, but we've seen.
And they see first quarter quarterly growth of 0.2% versus 0.1 to 0.2% previously, and 0.1% in Q4.
Looking at the different sectors within the S&P 500, and the biggest groups saw the biggest gains. You have infotech, communication services, and consumer discretionary all up by at least 1%, with tech as a group up by 2.5%. The smallest parts of the market, utilities, real estate investment trusts, and energy, each losing ground. That's why the pie is so green.
All right, speaking of green, let's get to some of the individual namers. Oracle, number one gainer in the S&P 500, I believe closing at a record. I have to double check that, but it's up about 12% here at the close. Thanks, Romain. So hitting a record in the close here today. Cloud revenue growth, right? We were breaking their earnings down after the close yesterday. Company did report third quarter results that beat expectations on key metrics, said demand for the company's Gen 2 AI infrastructure substantially exceeding supply. Company also saying Oracle to have exciting joint announcements with NVIDIA soon. Mizuho raising its price target to 160 from 140, and that stock closing at just below 130 a share. All right, so speaking of NVIDIA, the climb is back. It's up 7% here at the close, a gainer after a two-day rout that wiped about $172 billion off the world's most valuable chip makers' market cap. Latest retreat had come after, we know, an unbelievable rally in this name that propelled it into overbought territory. It's up about 80% so far this year. Again, the number one gainer in the S&P 500 for the second year in a row early on here in 2024 by a mile. And again, among the top gainers in both the S&P and the NASDAQ 100.
And it was interesting to see all those other AI chip names rally today, like Supermicro and SoundHound and some of those names as well.
Again, right?
Yeah.
Right. The momentum continuing again today in the trade. Hey, one more for you, Novo Nordisk. The ADRs that trade here in the U.S. up 3% at the close. They're pretty much finishing at its best levels of the session. Novo Holdings, the shareholder that controls Novo Nordisk, saw its income and investment returns surge tenfold last year as the Danish drug maker's sales of obesity medicine soared. I mean, we know the story. We've been talking about it. It was one of the big stories last year. It is again this year. But again, Novo Nordisk, the ADR is up about 3% here, Tim.
All right, let's get to some of the decliners on this Tuesday afternoon. I do want to start with Boeing. Shares finishing the day down by more than 4%. Now trading at October lows, not seen since October, I should say. Down almost 30% so far this year. A lot of headlines affecting the company coming out today. The FAA audit of the production of Boeing 737 MAX found dozens of failures in the manufacturing process. This, according to a big report in the New York Times. Meantime, we learned earlier today that deliveries from Boeing trailed Airbus as the 737 MAX crisis continued to slow factories. And then all happening as the crisis of the company is starting to spread to the airlines that buy its jets, such as Southwest, which I'm going to get to in just a moment. Speaking of Southwest, shares falling the most.
That was quick.
Yeah, I know. I'm not doing a deep tease here. I'm just going right to Southwest. Down close to 15% today. This is the most since March of 2020. At one point in the day, shares were down the most since 2009. The company did come out and say that it plans to reduce capacity by at least 1 percentage point this year. It did cite Boeing's continued challenges and a fluid delivery schedule. Southwest does rely exclusively on Boeing for its fleet of 737 MAX aircraft. And then on holding, finishing the day down today, let's see, about 8.8%. It did fall as much as 18% earlier in the day. It issued first quarter and full year net sales forecasts that fell short of Wall Street expectations. It's a Swiss company. They make shoes. You see them everywhere. Fourth quarter net sales also missed the average analyst estimate. Analysts did say, though, that despite the results, the company continues to demonstrate positive momentum. Alex, do you have a pair of these shoes? I don't have them yet.
I was literally just being like, on holding, what do they look like?
I have them.
Yeah, Carol's got them.
You do?
Yeah.
Are they flat?
They're
super light.
No,
these
they're super light, and they have you almost feel like you're walking on like bubbles.
Walking on bubbles.
That's their whole thing, on cloud.
Sunshine.
On cloud.
Cool.
Walking on sunshine.
All right, I'm taking a look at yields guides because there was stuff that happened. So after that CPI, you saw the sell-off, you saw yields move higher pretty much across the curve. Then you also had that auction for the 10-year that was kind of meh. We get $30 billion worth of 30-year tomorrow. And then just crossing, you have a central bank governor over in Europe saying that the ECB is in broad agreement to cut rates in the spring, which just leads to the whole, hey guys, June, maybe we see some kind of central bank cutting cycle in the market, but then you get the hotter CPI and then you get conflicted.
Yeah, and look, I mean, this is all going to change, potentially change in a big way in about a week's time when we do get the Fed meeting and whatever communication they want to give. But everybody's been trying to sort of, I guess, read these economic tea leaves out of these economic reports here. But maybe they should just be, I guess, looking at, the real world.
I got some
Carol Massar.
I got some tea leaves.
I was told you were out in the Hamptons this weekend shopping for a home.
I was not. I was.
Nice.
No. But there are many that are out there this weekend, and apparently home sellers are ready to buy a bunch of properties, and they're also ready to sell some properties. So they've been doing open houses out on the east end of Long Island.
How much is that one that we're showing right now?
I don't know what that is, but
I'm
listen,
guessing
it might be a little outside my price range.
3 homes with asking prices of $20 million or more reached the market in February. That's up from just one last year. So if that's not for you, there's might be maybe a $6 or $7 million.
Time to put some of that cash to work, Romaine.
Yeah,
That cash on the sideline, Scarlett?
Not safe.
Well, speaking of real economic indicators, there's another one that we can look at too, which is music festivals, because at least 10 of them have been canceled in the U.S. this year because prices have been going up. A lot of the price rise is being driven by the bands themselves, which are asking for higher prices because, of course, they lost income during the pandemic, so they're trying to make up for all of that. But everything's more expensive.
I think it's because nobody actually likes music festivals. This is my thesis.
When was the last time anyone on this television was at a music festival?
The bands don't even want to go to music festivals.
Okay, I have never.
You're not
been
a
to music
Coachella
You know what I don't like?
gal?
I said this earlier. There's nowhere to sit.
There's no bathrooms.
You're surrounded by people you don't know. Is there a worse way to spend a weekend?
And it rains all the time.
No, it's terrible.
Or you're getting sunburned.
Or maybe all the people are just getting older like us, and
I
then
think
we're like,
that's the
I don't know,
Romaine,
this stinks.
you've been to a music festival recently.
I have, and I'll say this. I think it's time for consolidation, as they say. Honestly, it was just too many of them. Tim talks about all the negative things. Tim, there's a lot of good things about the festival.
Go on.
But the point is, you think about how many of these things come down the pike, and how many it's like the same kind of artists or a lot of overlap in the artists, and it's like, I don't know, there's only so much to go around. Like, I don't need to see Ty Dolla $ign 5 different times in one summer.
I also think that there's this idea of, if you want to spend serious money on a concert, you're going to spend that money to go to someone you really want to see, and not all of the other acts as well. So, like, not the headliners that, you have to put up with all the other bands to wait to see that.
The good thing about getting older, though, is like all my favorite acts, they understand the struggle, Tim. They're going to be seats. It's going to be, it's going to start early and, end before 10 p.m.
Exactly.
Starts at 3 p.m. in the afternoon on Saturday.
That music festival.
One of the most recent concerts I went to about a year ago, we did sell the floor tickets for seats later, as we got closer to the date. I was a little optimistic when I bought those floor seats.
Yeah.
We want to see. We want to see.
I want to see. My legs get tired.
Absolutely.
Yeah. No GA for me.
And we want a bathroom. All right, that's a wrap. Cross-platform coverage, guys. Beyond the Bell, radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
The Pentagon scraps a plan to spend $2.5 billion on Intel defense grants.
It was a big day coming out with that big CPI report this morning here in the U.S. A lot of implications for the big Fed meeting next week. Diane Swank, chief economist at KPMG, joining us in just a second. This is The Close on Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays only on Bloomberg. Context changes everything.
Welcome back to The Close. I'm Scarlett Fu with Romaine Bostick. The S&P 500 returned to its record-setting ways, closing up by more than 1% as a slightly hotter than expected CPI report fails to derail the Goldilocks narrative and therefore the market's rally. You did see yields moving higher by 5 basis points for the 10-year yield on that CPI print. Also, a not great 10-year auction ahead of the 30-year auction tomorrow. There was also competition from corporate bond issuance as well. The Magnificent Seven had a magnificent day, with the exception of Tesla. 6 out of the 7 members finishing higher on the day, and a rare decline here for Bitcoin. The first decline in about 7 days here, with Bitcoin losing ground to $71,000. All right, let's move on to the individual movers here, because Southwest was the biggest decliner in the S&P 500. The airline will cut capacity this year, also halts most hiring and reviews spending in response to reduced aircraft deliveries from Boeing, which also finished lower. On Holdings, the Swiss sneaker company, down about 9% in U.S. trading after its first quarter and full year sales forecast missed analyst estimates, mainly because of FX. And Archer Daniels Midland, we've been keeping track of this one for a while, up almost 4%, mainly because of relief that its annual report did not have the worst case scenario. Yes, it did have to restate inter-segment sales for the last 3 years, but it didn't have an overall effect on earnings, the bottom line, when it came down to it. And 3M, one of the big performers of the day, the best performer in the Dow Industrials, in fact, up almost 5% on a switch at the very top. A new CEO is coming in. William Brown is coming in. He's a well-respected operator CEO, and Michael Roman goes out. Of course, his tenure was marked by lots of legal liability issues as well as a slumping stock price. Romaine?
All right, let's go back to that inflation point from this morning, 3.2% on the headline, drifting, of course, away the opposite direction where the Fed wants it to go, back down to that 2% target. But as we do here at Bloomberg, we always try to look for the stories under the hood, and one is out there in Phoenix, getting closer to that Fed's 2% target, a 2.2% inflation rate down from 13% just a little while ago. Alex Tansey joining us right now to, I guess, tell us, Alex, what actually drove that, and is what's happening in Phoenix, is that something we can see repeated in the rest of the country?
So Phoenix was the lowest of the 14 cities that the BLS reported today. It's coming down on housing prices. So rents are falling, and housing prices are down about 40,000 from the peak about 18, 20 months ago.
And of course, the context here that we need to keep in mind for a city like Phoenix was it was one of the pandemic boom towns, right? It definitely got a boost in 2020, 2021. And as a result, we're kind of seeing things, I guess, normalize. Is this mirrored in other parts of the country and other regions of the country?
It is. Prices are coming down everywhere, pretty much. They're still a bit high in Miami, close to 6%. But in New York City, it's around 3%. In LA, it's less than 3%. So some big metropolitan areas are seeing prices still come down. That's not correct. Actually, prices aren't coming down. The rate of increase is falling. So prices are still increasing.
Yeah, and we should point out, too, I mean, we have seen some other bright spots out there, Alex, including in the Minneapolis area and some other pockets of the country that we are seeing that disinflation trend continue. Alex Tansey tracks all this data for us here at Bloomberg. For more insight
So following the close of the US cash equities markets, just going to give you guys a quick market wrap of the session today. So stocks rose to a new high as the latest inflation data did little to change bets that the Federal Reserve will cut interest rates this year, even if officials maintain a more cautious stance for now. An equity decline that lasted only a few minutes gave way to a rebound that sent the S&P 500 up more than 1%. Despite the fact that the Consumer Price Index continued to show signs of stickiness, the overall report only slightly exceeded economist expectations. While this is not ideal for a central bank attempting to get close to its 2% target, the CPI did not surprise traders fearing another post-inflation rout. The S&P 500 closed around 5,175. Today, tech led gains, with Oracle rising 12% on the back of increased cloud computing bookings on its earnings report last night. Nvidia gained more than 7%, and Boeing increased its 2024 losses by nearly 30%. The Treasuries remained lower following a $39 billion sale of 10-year notes and an increasing supply of new corporate bonds. So consider the SIBO one-day volatility index, a measure of cost in the S&P 500 options with maturities of no more than 24 hours, to get a sense of how traders were prepared for Tuesday's CPI report. The gauge closed Monday at its highest level since October, indicating heightened anxiety. So a note from Citigroup analysts, they note that the options market was more concerned on Monday with a potential large S&P 500 move following the CPI than the Fed's rate decision next week. So that was based on the at-the-money straddle strategy, which involves buying an equal number of calls and puts with the same strike price and expiration.
It's not a very exciting thing to do, but they debate actually technology and how do they best do different methods.
That gathering must get fun after a while, after a couple of rounds.
Well, you got to, yes. that is the whole point. But no, it is, I think, the important thing is that they came out and tried to be transparent. But, when we look under the hood under these numbers on the CPI, what's a little bit concerning is this sort of underlying acceleration that we've seen in core services inflation. And that's taking out the shelter costs. And that the Fed is worried about that because that is more sensitive to wage pressures. Now, this could be another head fake. This could be a seasonality problem. Everything post-pandemic, I say it's sort of like, the Wizard of Oz and not in Kansas anymore. Yeah. Only, the pandemic was a twister that transported us there, but we don't get to go back. We don't get to click our heels and go back home again. And I think that's important because it's different rules exist. And there does look, we're not the only country that's seen some floor form underinflation in the service sector.
You can't use the pre-2020 playbook anymore. It's not relevant. What we did see in the last couple of years, of course, is investors trying to front-run the eventual rate cuts on the back of loosening financial conditions. That eventually, according to your note, led to the economy's re-acceleration, and the Fed has kind of acknowledged that as well. How mindful do you think Jay Powell is and every other Fed official is in its messaging? Is that why we get the repetitive messaging on, everything's data dependent and totality of the data, and, we're very comfortable, we're willing to be patient? I mean, because they want to fend off that potential front running.
Exactly, because what we did see is every time that financial conditions eased, there's dry tinder in places like the housing market. We've got 12,000 people turning 35 every single day in this economy because millennials are aging into their peak home buying years. And the demand, every time the mortgage rate goes below 7%, we see the demand flare up again. And we want to see prices cool in shelter costs. Those kinds of things that they see out there, they're worried about when financial conditions ease so much that they reignite sort of those embers of inflation, or in this case, they're worried about what's a persistent inflation, particularly in things like medical costs. That's where we're starting to see it. You're also seeing it in insurance costs. There's a lot of damages out there that we've seen due to climate change as well. So all those things combined, they don't have a lot of control over everything, but the bottom line is they don't want to declare victory and pop the champagne corks until they know for sure that inflation is no longer an issue that's distorting all our decisions.
Well, speaking of distortions, we go from housing to commercial real estate, because the weakness that you see there, you see this being a big theme in 2024, hitting hard. The losses, you say, will be dispersed, but not a systemic threat. So how will it show up in the data? How will it show up in the economy?
Well, what we expect to see is there's going to be more losses due to office space, and that is coming. Now, we don't know. It's very dispersed on who actually holds all those leases. Yes, there's some in the banking industry, but there's also some outside of the banking industry, and there's some cases where I know a bankrupt building in Chicago where they don't even know who holds the paper, whether it's a foreign country that holds the paper or whatever. And I think that's what's important, is that we're seeing, it very dispersed. So it's not like the subprime crisis that had ripple effects through the economy. But it means that, of course, areas that we're building, places where
At 4:30 p.m. Eastern Time, we get our weekly US API data. Crude oil stock change forecast a build of 0.4 million on the prior build of 0.423 million. Gasoline stock change prior draw minus 2.8 million. Distillate stock change prior a draw of 1.8 million. And Cushing stock change prior a build of 0.5 million. Bear in mind, we do get this data from public sources.
But does that maybe does that just kind of maybe return us to the baseline of maybe what's in line with what would be normal? It's interesting. There's been a lot of anecdotal evidence, a lot of anecdotal stories of employers saying that it's easier to hire people, it's easier to negotiate with them than, say, a couple years ago when they basically had to take anybody with a pulse.
Well, and that is the reopening was really extraordinary. The hiring frenzy was extraordinary. The churn was extraordinary. Quit rates have come way off. With that, also, as quit rates have fallen, so have medical costs gone up, because people are actually using the benefits that they have because they're in their jobs longer. Again, pushing up inflation there. But we are seeing some easing in the labor market. We've also seen a huge increase in legal immigration to catch up from the pandemic, and illegal immigration that is feeding into the numbers, that is softening the labor market a little bit in terms of the wage pressures, but there still are wage gains. That's the good news. What I worry about is where the wage gains are, because the wage gains that got so leveled up for those workers that were almost invisible, that became essential, the frontline workers that all of a sudden became essential and got their wages leveled up and had their moment in the sun, got burned by inflation. And they're still in that position of being burned by inflation today, and that's why it's so important for the Federal Reserve to get this job done the right way.
And it's why we keep hearing Jay Powell say something to that effect. Diane, really appreciate your joining us today. Diane Swunk of KPMG in New York with us. It's a rare event when it happens. Thank you so much.
Thank you.
And of course, Romaine, when it comes to those the labor market, the softness, you're definitely still seeing a lot of for-hire signs out there, but I keep hearing, I was in San Francisco last month, it's really difficult for laid-off software workers to find jobs.
Yeah, and that gets back to the anecdotal evidence. We saw some of that in the Beige Book. There was that great report that came out last week by the New York Fed, and it gets to this idea here that the labor market might be moderating, but it's not necessarily like collapsing or going, circling the drain, if you will.
Right, it's not cratering, but it's certainly not the boom days post-pandemic where you could negotiate your way up to a double-digit % increase for salaries. All right, coming up, we've got the top three. We focus in on the top three movers and shakers at the center of the day's big stories. We'll tell you who they are next. This is The Close.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock. Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans...
At 4:30 p.m. Eastern Time, we get our weekly US API data. Crude oil stock change forecast a build of 0.4 million on the prior build of 0.423 million. Gasoline stock change prior a draw of minus 2.8 million. Distillate stock change prior a draw of minus 1.8 million. And Cushing stock change prior a build of 0.5 million. Bear in mind, we do get this data from public sources.
Coming from Coinbase, that's the breaking news crossing the Bloomberg terminal right now. Coinbase shares, which of course have rallied more than tripled, coming off of those October lows, now saying that it's going to cash in a little bit on that. $1 billion of convertible senior notes due in 2030 going to be offered up here, taking advantage of that big increase in price. Scarlett, the share's down about 4% here in after-hours trading.
Yeah, the stock recently trading at a 2-year high. So to your point, that big advance. All right, let's shift gears now and take a look at our top 3, because we take a deep dive into the people at the center of the day's top stories every day around this time. And first up, speaking of crypto, is Binance founder Changpeng Zhao, better known as CZ. Now, as part of the conditions of his bail, CZ needs to surrender his Canadian passport and notify the court of travel in the U.S., according to the Wall Street Journal. As you know, Romain, last year he pleaded guilty to anti-money laundering and sanctions charges.
Yeah, for some reason I forgot. I thought all his legal troubles, he had kind of dealt with all that, but I kind of forgot there's still a lot of loose ends out there here. Keeping an eye on CZ. I'm keeping an eye on someone here back in the U.S., Chamath Palihapitiya, in the news right now. His venture capital firm, Social Capital, we have learned, fired 2 of its partners, citing an undisclosed, quote, situation. This is according to a letter sent to investors that was reviewed by Bloomberg. We did reach out to Social Capital for comment. They declined to comment on it, but based on the contents of that letter that our reporter saw, they said they basically became aware of a situation last Tuesday, and they are probing internally. Jay Zaveri and Ravi Tanuku out, terminated.
It'll be interesting to see what happens there. We know that he pulled the plug, Palihapitiya, on plans to raise $1 billion for an early-stage investment fund just in late January. Our last person here is William Brown. He was named the new CEO of 3M, which went outside the company for its new leader. 3M, of course, struggling with low profit margins, sluggish revenue growth, and ongoing lawsuits, including a couple of class action suits.
Yeah, this will be interesting. I always feel for CEOs who have to come in and basically play cleanup person, because that's basically what this turnaround. Yeah. Maybe he has a chop. I don't know enough about him to say, but maybe he's got the chops for it. But never an envious position. You finally rise to the top, and all of a sudden it's like, here, fix this. Speaking of fixing this, when we return, Scarlett, we're going to take a look back at the fall of Signature Bank, and of course that trifecta, a regional lender collapses that affected $500 billion in depositor assets. We leave you with a question before we go to break. What were the losses during the Great Depression? This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're
Shortly expecting the results of the US API data, I'll lead with the crude oil stock change.
In general, stronger and sustainable.
All
all these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg.
All right, normally we take a look decades back in history, but today it's fitting just to go back to what happened 1 year ago today, March 12th, 2023. It was a Sunday evening when New York State regulators stunned investors by announcing they had shuttered Signature Bank. Now, that announcement came just days after the demise of Silvergate Capital and SVB Financial, 3 U.S. banking failures in barely a week, and all 3 would rank among the 4 largest banking failures in modern U.S. history. And that's the backdrop for my question of the day. $500 billion in assets were affected from just those 3 banks in just 1 week. To put that into perspective, during the decade-long Great Depression, at least 9,000 banks failed, taking with them a combined $7 billion in depositor assets, or when you adjust for inflation, roughly about $130 billion today. What was even more dramatic about Signature shuttering and subsequent liquidation was that torrent of deposit outflows. Remember, on the previous Friday, March 10th, 2023, that torrent had actually stabilized by Sunday. That made the decision to close the bank that day a shock to the company's managers, who had really only found out about it just moments before the public announcement. Former Congressman Barney Frank, who is a Signature board member, was incredulous.
We began to get these deposit outflows on Friday, began dealing with them. I believe by Sunday we had resolved that, finding more capital, and the deposit outflows stopped.
Now, to be fair, much like Silicon Valley Bank, Signature's clients were made up almost entirely of businesses and had a deposit base almost entirely uninsured. While most of the depositors in 2023 were made whole, the episode did rattle the nerves of investors. That steady trickle of dollars out of banks and into money market funds, that started in 2022 as the Fed raised rates, but it turned into a flash flood in 2023 with those bank collapses. Growth in money market fund assets, which had flatlined in the 2010s at around $2.6 trillion, had begun to swell in the early months of the 2022 pandemic, and in 2023 soared by more than $1 trillion for the most for any year on record. Now, conversely, deposits at U.S. banks dropped from about $17.7 trillion at the start of the year to
Seeing API crude oil coming in at a draw of 5.521 million, a draw of 5.521 million, that's lower than the expected build of 0.4 million.
Now today, bank deposits, they still not returned to those pre-crisis levels, and money market funds still sit on a record
Cushing, a draw of 0.998 million, a draw of 0.998 million. Gasoline, a draw of 3.75 million, a draw of 3.75 million. And distillates, a draw of 1.162 million, a draw of 1.162 million.
Now, because Starbucks is going to be holding its annual shareholders meeting tomorrow. So I want to bring in to discuss the challenges facing the coffee chain, Nick Setien. He is Managing Director, Equity Research at Wedbush Securities. Nick has a neutral rating on Starbucks with a price target of $95 a share. Nick, one of the perennial issues that Starbucks had been facing for a number of years was labor strife, but the deal that they made with Workers United largely resolves that, or at least puts it on the sidelines while they negotiate a framework. What are you expecting to hear from the management at the annual general meeting?
Thanks for having me. I mean, I think we're going to hear just that the issue has been largely resolved. I mean, there's some details that need to be hammered out. The most important thing is you can't go, if you're the manager, if you're the management team of Starbucks, you can't go and negotiate, with each unionized stores by itself. I mean, just imagine the logistics around that. So, there has to be some kind of framework where all the unionized stores are on the same page via one negotiation. I mean, I think that's kind of the biggest issue here. And then going forward, I think the fact that these guys have caused so much disruption in terms of sales impact, et cetera. Hopefully that's essentially behind us now.
It gets to the question, though, too, Nick. I mean, Starbucks took a very specific tack in addressing these labor issues that they thought were going to be a threat to them. The unions, at least on a small scale, certainly got something out of this here. Are we going to look at a future Starbucks that is going to be, I guess, have to be cooperative on a national basis with unionized labor?
I think they've done a really good job in addressing some of the issues that actually led to those stores that did unionize to unionize, right? I mean, essentially, this was mostly just a byproduct of overworked employees during COVID when there weren't enough employees to go around. It wasn't about pay. It wasn't about benefits. I mean, their pay, their benefits package, education package, et cetera, is the leading pay package in the category, in the industry. So, it really was around just, that timing around COVID and overworked workers. So I think a lot of those issues have been addressed. I'd be surprised if many more stores beyond the 300 plus that are unionized now, out of, thousands of stores in the United States unionized. So I do think this issue has been addressed and sidelined.
All right, Nick, really appreciate your sharing your thoughts on this. Nick Setyan is Managing Director of Equity Research at Wedbush Securities, helping us to look ahead to the Starbucks annual shareholders meeting tomorrow. But we do want to stay with labor issues because this month, the Dartmouth men's basketball team voted to unionize, making them the first group of organized student athletes in the nation. So joining us now for a roundtable is Chris Peck, president of SEIU Local 560, which has organized both undergrads and graduate students at Dartmouth. We also have with us Jason Stahl, founder and executive director of the College Football Players Association, which seeks to represent former and current college football players. Chris, let me start with you here. The Dartmouth men's basketball team voted 13-2 to be represented by the SEIU. What specifically does the team want? Are they seeking hourly wages? Are they seeking a share of the broadcasting revenue? Can you tell us?
Healthcare is probably one of the number one things they're looking at in my conversations with them. Obviously, it's a player-led group, and they're working, they're studying. We had Cade, who is one of our leaders of the team, had an injury, had to have an MRI. Parents have to cover it. If I get hurt working here on campus, I'm covered by workers' comp.
Got it. Of course, workers' comp is a sensitive issue because in the past, the NCAA came up with the term student athletes to avoid having to pay workers' comp for athletes who got injured. Jason, let me bring you into this because there is a precedent from 10 years ago when Northwestern football players wanted to organize, but the NLRB ended up siding with Northwestern rather than the players. No union vote took place as a result. What's the single biggest difference between then and now?
I mean, I think the single biggest difference between then and now is that there's been a sea change in college athletics. There's been a sea change among athletes. I think COVID, referencing the last story you all just did, and Starbucks workers, I think COVID really had a huge effect on the organizing efforts of college athletes nationwide because they were effectively being told, college football players who were seeking to represent, that they were the essential workers of college athletics, that their labor was necessary for athletic departments to sustain themselves. And I think that really was the first empowerment for college athletes, where college athletes said, boy, we're the only students who are being asked to come back to campus to work. Why is that? Well, of course, because without our labor, without us being on the field, this whole thing doesn't work. And then you follow that with athletes being able to monetize their name, image, and likeness for the first time in 2021 after the NCAA had fought that for decades, really, you could make the argument. And I think so athletes have had this real sense of sort of empowerment. We really want to kind of capture that collective empowerment that they felt during the COVID summer of 2020 and reharness that, as I think you saw with the Dartmouth players here, to show that a true change is possible through collective action that only that NIL was a start, but NIL is still sort of more individualized effort.
Right.
We really think the next frontier is collective bargaining.
But with regards to that collective action here, how collective is it going to be, Jason? Is this just going to be about college football, basketball, basically the premier sports out there? Is this also going to be all-inclusive of those secondary sports that I think some people are worried about now, given the recent push?
So, I mean, I think it's whatever the athletes decide. I mean, I think like what's great about what happened at Dartmouth, and I really commend Chris and the athletes there who stood up and, are seeking to affect change at that one institution. It's really up to the athletes here. I think this is there's sort of this paternalism that I think the NCAA has done a good job of sort of inculcating in the population for a long time. These are kids, these are student athletes, et cetera, et cetera.
Yeah.
They can do what they want. They're Americans like anybody else. They can stand up and collectively bargain and participate in collective action in the same way you and I can.
Well, okay. Well, I mean, up until a couple of years ago, they couldn't, though. I mean, and Chris, I mean, you know this.
They always can, though. They're Americans. They can stand up, and they can stand up for their own labor rights just in the same way you and I can. They're Americans.
Well, my alma mater.
They're adults.
I want to go to Chris for a second because my alma mater stood up to this, Northwestern, and they got slapped down by the NLRB. When I was in school many decades ago, this issue was bubbling then, decades ago here, and it was pretty much made clear by the powers that be they weren't going to get that. So when we talk, Chris, about the power that these athletes feel that they have right now and the ability to leverage it, do you see that broadening and persisting?
Absolutely. I see it sweeping across the country eventually. I mean, these guys, they recognized it. We've had conversations. They definitely, this will, sorry. I'm not used to being interviewed.
That's okay. That's okay. Chris, let me just follow with you because you've noted that the union has received help from outside sources, given how historical and precedent-setting this case is for athletes around the country. Can you share with us the extent of the support and even interest that you've gotten from athletes and other teams after the Dartmouth vote?
Absolutely. Our guys are getting contacted by multiple teams here at Dartmouth, across the Ivies, across the country. There is a lot of interest, and of course, there should be. I know these guys, they work harder than a lot of employees on campus, between classes, school work, watching film.
Yeah, and they're part-time jobs as well, which many of them have because Dartmouth doesn't give athletic scholarships. Jason, let me come back to you for a moment here because when we talk about Dartmouth, the men's basketball team is not Duke, it's not Michigan, right? It's not successful on the court or financially in the same way. Dartmouth doesn't offer those athletic scholarships. So what's stopping them from shutting down the basketball team? How valuable is this team to a school like Dartmouth?
Well, it'd be an unfair labor action if they shut down the team, number one. Number two, I think it's just nonsensical to me in the sense that you have an undergraduate student manager of Dartmouth basketball who makes an hourly wage. Why shouldn't the players be able to make an hourly wage? It seems it's that simple, but I think because we've been under decades of NCAA propaganda, which suggests that these are people who are sort of less than. They are student athletes, they are kids, they are something other than young adults who deserve to make a wage if they're engaging in labor. And businesses have to pay their laborers regardless of whether the business makes a profit. I mean, you all know that. And so I think that the idea that they're going to use an excuse that they don't make a profit, which I have seen, being contested in many quarters that they gain a profit. But I think that's not an excuse to not pay an hourly wage, which seems like such a simple request that I think a university with an $8 billion endowment should not be making that argument.
All right. I want to thank both of you for joining us today. Chris Peck of the Services Employee International Union, Local 560, who helped organize the basketball team at Dartmouth, and of course Jason Stahl of the College Football Players Association. Romain, I'm so glad you brought up the Northwestern action.
Yeah, me
that
too.
didn't result in
Because if you
anything.
didn't, I was going to, no matter what.
No, definitely. And it's something we've talked about as well.
Yeah.
What was the mood like on campus when that was happening?
Well, with that latest action, I mean, I was far removed there, you know.
Among alumni then. Was there support for that?
It was a ton of support, and I think everybody really saw it. Remember, people thought they were going to win. I mean, they were like, oh, this is, because it all made sense on paper, right? And then RB's decision came down that really just kind of smacked it down, and everybody thought that was it. And then, of course, when name, image, likeness came up and that went to the Supreme Court, I really think that opened the floodgates. I know the pandemic might have helped with that, but that Supreme Court really just opened up the floodgates.
Yeah, the NCAA has been forced to pivot and pivot again, and so we'll see if this results in a big pivot. And this is a real issue.
You know, I mean, I get sensitive about it too, because I had a lot of friends who played when I was in college, and some of them really struggled. I mean, they didn't come. Some of these people didn't come from means. They weren't allowed. Not only were they not getting paid, but you know, they weren't allowed to have work study jobs. They weren't allowed to sell any of their images. So any money they got was basically just through the good graces of the program, or maybe if they had parents who can fork them over. Those days got to end. So that's not American.
They were students, and of course they had full-time jobs, in quote marks, as athletes on the football field.
Yeah, you put me out there, you make money off me, I'm going to get a cut of it. That's American.
Let's take a look at how markets closed on the day. It was a record day for the S&P 500. Not so for the NASDAQ. A slightly hotter than CPI report didn't do much to discourage the advance. I like what Mohamed El-Erian had told Bloomberg last week, which is the vibes right now is good news is good news, bad news is good news. And you see that there with the Magnificent Seven and the S&P 10-year yield moving up by 5 basis points. And Bitcoin, it's down, but it's still at $71,000. This is the close on Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see,
Leon County, Tallahassee, Florida Blueprint Agency sells $127 in sales tax bonds rated R, stable outlook. U.S. Department of Defense achieves milestone C and full rate production for F-35 program. New Zealand food price inflation index down 0.6% month-on-month in February, according to Stats NZ. AIR predicts 104.43 BCFD US dry natural gas production for 2025 in March STEO report, down from February's forecast of 106.46 BCFD. AIR projects 2025 natural gas consumption in US to be 89.21 BCFD as per March STEO report, lower than the February forecast of 89.55 BCFD. US State Department, loan proposal for Ukraine not appropriate as it revives economy. AIR forecasts 10,000 BPD increase in 2024 world oil demand growth, now predicts 1.43 million BPD year-on-year rise. Ken Buck, Republican US representative, to resign from Congress at the end of next week, according to a statement on X. White House aide Sullivan warns Ukraine aid may only last 2 weeks. Citi, YouGov, UK inflation expectations for the next year fell to 3.6% in Feb.
you need to calories, and I didn't eat that much for breakfast, so we've stopped because we're going to go on a bit of a hike today. What's your name, sir?
Patrick.
Patrick.
So nice to meet you.
Nice to meet you. This is amazing. Can I have one more coffee?
Of course.
And by the way, Patrick, how long have you been here?
Only for 1 month.
And where were you before?
I was, I've been spending 20 years in Madagascar.
Oh, wow. You travel the world then?
I traveled the world to finally, and that's a surprise, meet you in the mountains. And that is a big surprise for me. I'm can I say huge fan? Anyway. Another one for you.
That would be amazing. Here we go. That's us.
I'm so happy.
All right.
Thank you very much.
Thank you so much. And wonderful coffee.
Feeling freshly rejuvenated and caffeinated, I'm ready for the Nondradrons hydropower plant.
Oh, we're actually driving into the mountain. I mean, can you believe this? Can you believe this? Oh. Now suddenly we're in James Bond territory. Bonjour.
Hey,
Hi.
good morning, Nicolas.
You're Robert?
Yes, pleased to meet you.
Nice to meet you.
Welcome in Châtelat.
Thank you.
We're going to have a nice day.
Yeah.
And I'm going to be your host today and your
Fantastic.
guide also.
Very cool.
And here we are now. And then we'll take the tunnel, the red line.
Oh my
we'll
God.
go under the lake. And then we'll come to this cavern. But that's the heart of the power plant. And we will also go to the top lake.
Can you just explain to me the idea?
Yeah, I mean, the basic idea is to store energy by pumping water. We have 2 lakes which were already existing. So we said, okay, it's perfect because we have the right height difference between the 2 lakes. Nondradrons, you have to remember, is really a grid management tool. So when you have too much electricity on the grid, then we take this energy, we store it, we re-inject that to the grid when it's needed.
But also because the problem is always, when we talk about renewables, what do you do with solar power when the sun doesn't shine? What do you do with wind when it's not? And you kind of solve the issue here.
Yeah, I mean, this is the solution.
That should just about be enough. In Denmark, we had a prime minister once called Poul Nyrup Rasmussen. And he got famous because he wanted to promote bicycle helmets. He also had a very large head, like me. So he was out there and he became ridiculed by that, like I am now. But better safe than sorry.
The top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
We've been traveling all over the world looking for solutions to a lot of big problems. And then sometimes a sense of, oh, we can't, it's impossible, it's too much. But then you come to something like this and you realize humans can do pretty amazing stuff. To build a tunnel in 5 kilometers through a mountain. That's a complicated achievement.
Yeah. I mean, when you think about the principle of non-advance, it's quite simple.
Sure.
I mean, using water, storing, and so on. That's quite easy to visualize and so on. But then the execution of it was really a challenge.
Holy, that is big.
That's a real caveat. That's the heart of the power plant.
Wow.
You have the top of the machine, the 6 machines. And the turbines are transforming water power into mechanical power. This turbine will make turn the generator. And the generator will transform the mechanical power into electrical power. And here we are at level 0. We have 4 levels down.
4 levels down.
Yeah, so we are going to go down into the power plant. We're going to look at the valves. We're going to look at the heart of the machines.
I like that there's just a couple of paintings put up on the wall.
Yeah, I mean, it's just a few pictures.
Very modernistic.
In here, we are always using the same water. We pump it and then we turbine it. So basically, we have a certain quantity of water which belongs to us, and we're not waiting to outside water inflows for this power plant.
So will you, theoretically or in reality, this is
forever. So here we are below the generator here. You see this pipe? That's one pipe feeding one generator. And here, when we open the valve, this will come up.
Oh, wow.
And then the water will be able to flow through this valve. So water will then continue into that direction, and the turbine is 2 meters below.
It did make some noise.
Yeah, I mean, the upper lake is 25 million cubic meters of water, and if we turbine full power, in 20 hours, we can empty the lake. Yeah. Obviously, when we pump, then we can also fill it in 20 hours. This machine can generate up to 150 megawatts.
And how much do we use? How much does the city use?
I mean, like Lausanne is using the full power of such a plant, as an example.
Wow. Hello?
Hello. Want to stop the machine?
Yeah.
Arrêt means stop in French.
Arrêt.
Okay. Now the green. And the green one.
This one?
Yeah. So now you can see we entered in the stopping sequence here. Each step.
Oh, it's happening. Yeah. Oh, I gotta see that. Oh yeah. Look at that. This is like sometimes, you know, when we hear about the pyramids and all these things, people go, how did they do it? When you stand here, I'm like, how did they do it?
Everybody's here.
Men's department, please.
Yeah.
Ladies.
Men's shoes? This is nice.
So here we are almost inside the dam.
That's it. That's a bit of a hike. Here we are. This is straight. There's a wall of snow. Holy shit, man.
Maybe you want to lift your coffee here?
And maybe I should leave my coffee here. I'm gonna jump down there, right? Oh, this is amazing. Yeah, just use your ass. Good job. And I'm glad, Amane, you brought the right shoes for this job.
I'm good.
This is the dam.
That's the dam. That's what we call the upper lake, upper reservoir.
Over here? Oh.
Of that big battery, right?
Oh my God, it's beautiful. They use the water to create electricity and let it go down through here, through the dam, and then it's pumped back up. So it's like a circular thing. It's a loop, and you have storage forever. It's incredible. You have so many renewable energies, but of course the big problem is energy storage. But the idea is simple and it works, right? We also know that there is not going to be one solution. We need a whole combination
You need a
of
portfolio
wind, solar, water, and probably also technologies we haven't even invented yet. But we have to get away from fossil fuels.
That's for sure. And non-trans is one of the break to go into that direction of having, I would say, less fossils and more renewables.
What does it give you to work with something like this? Are you proud?
Yeah, I'd say. I mean, personally?
Yeah, personally.
You know, for me, it's a dream job. It's since 5 years, I'm now part of non-trans. And to be honest, that's the best job I ever had into my professional life, because I'm doing something with people who are passionate about doing something good in order to allow, I would say, more renewables.
Yeah. And so in 8 years, maybe our grandchildren will still take care of that power plant. So it's something that has been built for the ages and that will stay much longer.
It's not for you, not for me. I mean, it's for the future.
One of the main reasons for doing this show is to highlight how incredible we humans are at coming up with new ideas on both small and massive scales. We know the challenges we face are monumental, but we will persevere. Well, to me, the people we met in Kenya, Vermont, here in Switzerland, they're all proof that failure simply isn't an option. We will and we can solve this, even if it is the most difficult and complex challenge we've ever faced. And we will look toward a better, cleaner, brighter future together.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested, they want to be an early adopter of the stock, they're interested in the story.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome to Daybreak Australia. I'm Heidi Stradwartz in Sydney, where markets have just come online.
I'm Annabelle Drewlers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Wall Street shrugs off another hotter than expected US inflation reading. The data doing little to alter bets that the Fed will cut rates this year.
Japan set to unveil the results of wage negotiations. A strong showing could give the BOJ the green light to hike interest rates.
And Australia's wine industry cautiously optimistic amid reports that China has proposed lifting tariffs on the country's wine. Kicking off with some breaking data this morning, we've just had South Korea releasing its jobless figures for the month of February. That reading has actually come in a lot lower than what economists had been expecting here. So the reading falling to 2.6%. The estimate had been for 3%. So we're below the post-pandemic average here of 3.3%. That's sort of seen as the natural rate perhaps of unemployment, at least by our Bloomberg economics team. But importantly, that reading of 2.6%, as I said, below the average of economists, and even the range had been at 2.7 to 3.1%. So you're actually undershooting all projections coming into this. Broadly, this tells us that conditions in Korea's labour market, they remain tight. It is a signal to us of resilience in this sector. Certainly something, Heidi, that's going to keep the Bank of Korea giving it a little bit of leeway, I guess, to take its time before cutting any sort of rates.
Yeah, and as usual, we're sort of back to really focusing on these data points and how they feed through to central banks across the region, right? And Belle, to that point, take a look at how we're getting into the start of trading here in Sydney. It is looking like a pretty mixed picture there. Some gains are expected across the region, so we are seeing Sydney stocks really come online in a pretty muted fashion. We did see pretty much sideways trading in the previous session. A lot of those declines coming from the big iron ore players, BHP, Rio Tinto, Fortescue. We'll be eyeing to see if there's much of a recovery in this session, as we did see iron ore kind of steadying after plunging almost 7% on these weak Chinese demand and swelling stockpile concerns there as well. The ASX is pretty much unchanged at the moment, and one of the sectors that we're watching, one of the stocks we were watching as well, mentioned Treasury wine on account of China's proposal to end those 220% tariffs on Australian wine companies, so proposing to lift those punitive tariffs on the sector. We'll be watching for reaction out of that, certainly. The Aussie dollar holding pretty steady, 66.07 is where we're at. We saw the US dollar really firming after, as Belle mentioned at the top, US core CPI exceeding forecasts, hotter than expected, putting into question the path of where the Fed goes from here. That February number was faster than expected. So the Bloomberg dollar index overnight about 0.2%, and we did see the dollar kind of posting gains against pretty much all of its G10 counterparts. We are also, of course, watching for the Bank of Japan, because this will be a bit of a test, Bell, in terms of what we see in yen trading today. But of course, waiting on those wage negotiations, that is a final piece of the rate puzzle as we get those outcomes from the wage talks.
Yeah, certainly, and we're hearing actually that within the Bank of Japan, policymakers are really split on the direction they want to take, whether we're going to see any sort of move in March or at the upcoming meeting in April as well. But certainly a lot of focus on those negotiations, as you say. Taking a look here at what we've got for US futures here, fairly steady so far, but yesterday we actually saw stocks climbing to a fresh record. You mentioned, of course, the CPI reading, and that was really the main focus for investors here. Swaps now starting to price in a nearly 70% chance that the Fed is going to start easing in June, pretty much because these numbers weren't any sort of big shock to traders either. Treasuries, they moved a little bit lower in the session. Oil as well, that was dipping actually ahead of that or after that inflation report. Also OPEC saying that the latest supply cuts have stalled. It's really about whether countries can meet or whether they're actually exceeding their production quotas, and Iraq is one of those that's gone beyond its quota for a second straight month. So that's the state of play there for the US markets, as I said, futures just coming online here, but it was that focus on the US inflation reading topping forecasts for a second month in February. The advance, as I said, really seemed to reinforce the Fed's cautious approach to cutting rates. Let's bring in our US economy senior editor, Chris Anstey. And Chris, the numbers, do they sort of breathe any sort of new life into this narrative that inflation is sticky in the US?
Oh, for sure. You look at the core CPI at 0.4% in February. That's the monthly gain. That's a second straight month of 0.4. 0.4 is just totally inconsistent with the Fed's 2% inflation target. And in fact, that back-to-back 0.4% core gain in CPI, that was the hottest 2 months that we've seen since the spring of last year. So this is not the direction the Fed wants to see things going. If you look at also the super core services measure, this is something that the Federal Reserve has been focused on for some time now. Super core services also strips out housing costs as well as food and energy and goods. That came in at almost 0.5%, which again, totally inconsistent with 2% inflation. That said, there are those who argue that as we see the labor market start to soften up a little bit, and you remember the numbers last Friday we got, average hourly earnings came in only at 0.1% on a monthly gain. So there are those saying that we will see a turn. It's just not here in these numbers yet.
We've only got really one more piece of data to go before the meeting. Does this potentially change, not the outcome, but the signalling and some of the language that we might hear from the Fed?
As you say, there's no change in the decision expected. Everybody expects no change in rates next Wednesday. I think the focus is going to be on the new dot plot forecasts. So March is when Fed policymakers are due to update their projections for economic metrics and, of course, the benchmark interest rate. So last time around, back in December, they had penciled in 3 rate cuts for this year. The question is, will that come down at all? It would only take a couple of policymakers shifting their view for the median dot to lose one of those 3 rate cuts. So that's going to be the key focus next Wednesday.
US Economy Senior Editor Chris Anstey there. Let's bring in Sylvia Jablonski, who's a CEO and CIO at Defiance ETFs, joining us now. And Sylvia, I guess if anything, this is really another data point that tells us that this path to disinflation is not necessarily going to be a straight one. But if you take a look at some of the core components that have been such a concern in January, like shelter, like rents, were there some reassuring parts of this for the Fed?
Hi, and good evening. Thank you for having me here with you tonight. Well, I think overall that this number was a little bit hotter than the market expected, but it wasn't, overly hot. So while I agree with, what a lot of what was said there, if we're thinking about 2%, you get, 2 months of 0.4 in a row. That's not exactly reassuring. If you think about inflation coming down, this is still a story of inflation coming down, right? You still sort of, it's not perfectly linear, but it's kind of coming down to a level that the Fed is more comfortable with and getting closer to in line with, the Fed expectations. And so I don't think the market reacted because I don't think a whole lot will change. We all sort of expect there not to be any kind of, rate cut at this moment. Perhaps it happens in June. And, because that hasn't changed, I think that it really won't change the market in the short term.
In the meantime, what we have seen is, things get perhaps a little bit trickier when it comes to this equity rally, right? On Friday, in particular, with that jobs number, there seemed to be more and more of a hurdle in terms of some of the fast money, at least, being liquidated from these major popular themes like NVIDIA and AI and tech. Do you think that kind of theme is likely to continue?
I think it'll continue, but I don't think that it's necessarily bad news. So if you look at the last couple of days prior to today, I do think when you have these stocks that are, quickly reaching all-time highs and you have hedge funds and large institutions that have, their algos running and at a certain level, you get these these hits on the price, and you kind of unwind some positions, take profits there. So I think that's going to continue happening just because the growth has been parabolic. But I think that over time, the price will continue to steady out and continue to rise because this AI trend, this supercomputing, quantum computing trend is just in its infancy. And, you just are starting to see it now applied to different sectors, different companies, different parts of the market. And that's just going to play out over time. And I think that the price increases at that point will kind of steady out and rise a little bit slower. But in the short term, sure, you're going to see some momentum trading around some of these names.
So Sylvia, do you think for the AI trade, do you think the names like NVIDIA, like AMD, are they still the best way to play this, do you think?
Yeah, I think that it's really hard to argue that NVIDIA and AMD are not the two leaders in semiconductors. If you think about, kind of the largest expected growth around the AI trend, it comes in the form of data centers. And we're talking about a potential future number of, in the trillions, right, of total addressable market. And those two companies are the leaders. So when they pull back, I think investors who have FOMO, even if they just pull back from, 900 to 880, I think there's a psychological impact there, and you start seeing investors coming back in. They are buying on the dips, and I do think that they're reasonable trades to continue to hold. Longer term, though, I think you can actually expand this trade out. So there are ETFs out there that represent the quantum computing theme. There are ETFs out there that represent cloud computing, cybersecurity. And I think that these areas of the market will give you access to companies that are small, mid, large cap, and kind of give you the broader theme exposure. And so you'll see investors dabbling in those areas.
I want to get your views on some other stock picks as well, because I know Eli Lilly is one that you also preference. We actually had an interview with the CEO, Dave Ricks, earlier today, and he was essentially looking at the obesity market, how they're looking to capitalize on that. So they're looking to create an oral tablet in addition to an injectable device, and he also wants to get into market a little bit quicker. So just take a listen to what he had to say.
It's not a protein, it's chemistry, and it's not in that injectable device, which is so difficult to make. It's a pressed tablet. The world is awash in those capacities. And so should the drug be successful, I think we'll be able to tap into quite a bit more supply, which will be good for the US, but even better for places like Brazil or Mexico or China.
There are a number of different weight loss drugs that are on the market now in development, but what is it about Eli Lilly in particular that stands out to you?
So what I like, it's interesting because I heard that interview, and the amount of interest in these drugs is just, kind of mind-boggling. But what interests me about Eli Lilly is sort of that, they're one of the two leaders in the forefront of weight loss drugs, and they're working on R&D and innovation there. But also, Eli Lilly is starting to really have a lot of growth in, diabetes medicine, obesity drugs. They didn't get clearance on their Alzheimer's trial, but they're doing a lot of research in that area. They have cancer drugs. I just think that they have a wide menu of products that are pretty far along in the R&D process and can actually have, some potential wins for them in their portfolio of drugs. So I don't think it's all about weight loss, although, that's clearly an area that's propelling the stock price forward now. I think that they're well positioned overall in kind of drugs and pharmaceuticals at this stage.
Sylvia, we're getting closer to November, and politics is, increasingly dominating the narrative, right? We're now getting reporting from a number of major U.S. networks that President Biden has clinched the Democratic nomination. MSNBC and CNN reporting that with the win of the Georgia Democratic primary, that Biden is a presumptive Democratic nominee. We're also seeing reporting that Donald Trump has won the Republican primary in Georgia as well. So with this being set up as a repeat of the last race, how much volatility do you think markets are setting up for, and potentially even upside, given how we saw that rally play out in the last Trump presidency?
Yeah, I think, usually markets have a good year during a presidential election year, right? Sort of regardless. Typically when the existing president is rerunning for office. But, so there's kind of that statistic. But I think in this case, the market kind of knows what you get with either one. So there isn't that element of surprise. We'll have to sort of see how it all pans out. I don't think that there's going to be a massive move in the market either way at this stage. but some areas of the market might be stressed. So, for example, if Trump gets elected, perhaps there's some strain around the idea of tariffs and how that affects EM trading and trading with China and things like this. If Biden gets elected, perhaps it's better for things like electric cars and it's kind of the same old thing. But I don't think that the market is going to be kind of super surprised in this election.
Sylvia, always great to have you with us. Sylvia Jablonski, CEO and CIO at Defiance ETFs. Take a look at one of the sectors we'll be tracking very closely, and that is wine and winery-related stocks here in Australia. Treasury Wine Estates, Australian Vintage, we're seeing a little bit of upside there. In fact, Treasury Wine there had been up by about 3%. We are trading at highs of about 10-month highs for Treasury Wine. Of course, this is a stock that has been battered since we saw this trade dispute and the punitive tariffs be announced, almost 3 years ago, and still down about 30% since that time. Australian Vintage also seeing a little bit of upside there. But Australian vintners and lawmakers saying that China proposed lifting punitive tariffs on the nation's wine exports. So it's a pretty strong signal that this close to 3-year trade dispute is potentially nearing an end. Both Beijing and Canberra have been seeking to strengthen and improve ties, and Treasury Wine Estates reference that plan and the proposal from China in that exchange filing on Tuesday. We are expecting, though, that decision to come in the next few weeks.
Yeah, and Heidi, perhaps something as well that raises some questions about the effectiveness of China's effort, but we'll have more on that ahead. Still, though, coming up, the results of Japan's spring wage negotiations are due ahead of the BOJ's monetary policy decision next week. We'll have that and more. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
I think that maybe BOJ will move next week to increase the interest rate with a 70% probability. So I think that the financial market expect a 50%, but I think that the probability could be higher than the consensus. Because as you mentioned, that the BOJ can get very important information to decide monetary policy on Friday this week. That was the result of that spring wage round. That could be a catalyst. That could justify that BOJ to move.
That was the former BOJ Policy Board member and Nomura Research Institute executive economist Takahide Kuichi there. And any possible BOJ hike is going to likely depend on the outcome of wage talks in Japan. A wide range of unions will be reporting on this year's pay deals this week, with Wednesday amongst the heaviest day for announcements. Our Asia Economy and Government senior editor Brian Fowler joins us from Tokyo. And what are we hearing so far? Because we have had various sort of companies or reports of companies of wage hikes that are coming through. So we're expecting to get a healthy pay bump here?
Yeah, Annabelle, at this point, it's all looking pretty good. As Kiyuchi-san said just now, the culmination comes on Friday when Rengo announces its final tally. But Rengo is a huge umbrella group with lots of unions, and we're going to see today a whole series of those unions announcing their results. So that'll be kind of a leading indicator for what we expect the final outcome to be. With the anecdotal evidence, it comes everywhere. Economists that we surveyed over the last week said they expect 4.1% gains on average. That would beat last year's raise. And companies here and there are reporting results. SoftBank came out the other night and said it was going to go 5.5% on average for its employees. So everything is pointing to wage gains that would surpass those that we achieved a year ago. And of course, a year ago, that was already the biggest in decades. So it's looking pretty good on the wage front.
And 3.8% is kind of the magic number that we're hearing being bandied about as being enough. Is there the assumption that the results will be solid enough to end that negative rate?
Yeah, so Heidi, that's the key point there, is that threshold. So I think if we get anything above 4%, it's kind of a strong go signal to the BOJ to move ahead on rates, ending the negative rate. If it's below 4%, around the 3.8% range, that might be a little bit disappointing after all the talk and all the sort of speculation that we've had in recent weeks. So yeah, that's the big number. And also remember that even that 3.8%, that was the initial tally a year ago, that actually came down a few months later as the results of smaller companies, which come a little bit late. Those were factored in. Smaller companies have less capacity to raise wages. So really, these first results will mostly be the big companies, and we'll have to see what happens later with the smaller company input.
Our Asia Economy and Government Senior Editor Brian Fowler there in Tokyo. Much more to come here on Daybreak Australia. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep winning World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
take a look at some of the buoyant trading that we're seeing in wine-related stocks here in Australia. Treasury Wine Estates, of course, a maker of the Penfolds brand, seeing upside of just over 2%. We're off the session highs, but still trading at about a 10-month high. And we're still, since the start of these punitive trade tariffs from China were imposed almost 3 years ago, we're still down about 28% from that point, despite the recent recovery. Australian vintage also up by 3.25%. As we are hearing that this could be coming to an end soon, Australian wine companies and lawmakers saying that China's proposing to lift these tariffs, and it signals that this trade dispute between Canberra and Beijing could be nearing its end. Let's bring our Australia government reporter Ben Westcott, who joins us in Canberra. And Ben, we're hearing that Treasury Wines is sort of making moves to try and potentially divert its stock back into what has been such a lucrative market. How did this come about after almost 3 years?
Yeah, so I mean, this was all began about 5 months ago when the Chinese government announced it was going to be undertaking a 5-month review into the wine tariffs, in a very similar process to the one they had for the barley tariffs, which then eventually led to the lifting of the trade restrictions on barley. So we've been expecting an announcement around March for quite some time, and the government was very hopeful of an announcement around now. This interim measure isn't a lifting, and the Ministry of Commerce hasn't confirmed it themselves, but Australia is welcoming this news of an interim announcement. Essentially what happens now is that people in China will have the ability to give comment on the potential decision to lift the sanctions, and if that comment comes in, is considered positive enough, then the sanctions will be lifted hopefully within the next few weeks.
It does seem, Ben, that Australia has sort of managed to ride out these trade tensions with pretty much no public concessions to Canberra, rather to Beijing. So does that sort of raise questions about the effectiveness of China's approach here?
Yes, look, I mean, the fact of the matter is that, apart from the damage that's been done to the wine industry and some lesser damage to the barley industry, Australia has more or less remained unscathed despite billions of dollars, tens of billions of dollars of sanctions put on Australian exports to China at the height of the poor relations during the COVID-19 pandemic. Now, on the surface, that will definitely lead other countries to be more willing to sit out any other trade disputes that they personally have with China when if these sort of things should happen in the future. But the important thing to remember here is that at the end of the day, the biggest trade between Australia and China that China couldn't touch was iron ore. And China needed that desperately for its own post-pandemic revival, and Australia was more than happy to sell it. We're China's most reliable supplier of that. And given the fact that neither side could really cut this trade in iron ore, these sanctions were always going to be less effective than they could have been.
Australia government reporter Ben Westcott there in Canberra. Take a look at how broader Australian assets are trading in just about the first half an hour or so of trade. We're seeing a little bit of modest upside there, about 0.25% after a pretty much sideways session in the previous session. We are also seeing a little bit of firming for the Aussie dollar, 66.08, after those moves in the Bloomberg Dollar Index following that somewhat hotter than expected CPI report. This is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
It's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly.
This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%.
It is coming down. But it's going to take some time, and that's okay.
I do think things are moving in the right direction in terms of prices.
But it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
So far, I think they want to cut, and we expect to see that in the May or June timeframe.
Some Bloomberg TV guests reacting to that latest US CPI data. And our next guest says a path to lower inflation remains bumpy. Fed officials will likely put this inflation report in the not-so-good column at next week's FOMC meeting. Let's discuss this with Lydia Besour, who's a senior economist at EY. Lydia, always great to have you with us, and especially to pass through the components of this CPI print. And I wanted to take a look at the so-called supercore reading, right? Because this is the element where I think perhaps Fed officials would be most concerned. Taking a look at this chart where it really is not coming down fast enough. In fact, if you take a look at the average monthly gain for supercore services inflation, 0.2% over the 3 years before the pandemic. So at the moment, we're more than double that in February, almost still 0.5%. Is this something that the Fed will be concerned about? And is it enough for them to potentially change the communication at next week's meeting?
Yeah, so I think this was an interesting item in the report this morning. We saw some cool down in supercore inflation after that hot print in January of 0.8% month-over-month, but it remains elevated, and it does suggest that there is some lingering stickiness in inflation. I think what was the key takeaway from this morning's report is that we're still not there yet when it comes to the Fed gaining that confidence they're looking for to start that easing cycle. And I do want to highlight as well that just looking at some of the underlying components of the report, we talked about supercore. There was some moderation, still too high for comfort, but also some moderation in shelter cost, which remains a key source of inflation as well when looking at core services inflation. So we need to see services inflation and that supercore inflation come down further to start to see that easing cycle play out.
Yeah, it's interesting you talk about shelter costs, because that was obviously the biggest shock, I think, for a lot of people in the January reading. And if you take a look at this chart, it is reassuring that shelter rent have come down, suggesting that maybe it was sort of some of the sampling tactics, if you will, that had an impact there. And we're starting to see kind of that start to come down as a component. Would that be reassuring, or does this kind of all add up to a picture that we are going to see potentially more volatility in this disinflationary path, even if we are still on that path?
I think the cool down in shelter cost and in owner equivalent rent in particular, which was the key source of shelter inflation in January, was encouraging. I think we need to see more disinflation in housing. If you look at shelter inflation, we're currently running at around slightly below 6%. We're down from an 8% peak, but you likely want to see shelter inflation converging towards 4% to get headline and core inflation in the 2.5% range. So we still have some more ground to cover, but I do think that there is more disinflation in the pipeline and more housing disinflation. And we know that, looking at some of the private sector rent inflation measures. So I do think that this is going to be part of the story of more disinflation happening later this year.
How would that disinflation happen in housing in particular? Because it's not easy to bring new supply onto the market, for instance. What are you seeing in particular?
Well, in terms of the housing inflation in the CPI, looking at CPI rent in particular, some of that disinflation has already happened and is gradually filtering into that core CPI shelter measure. And so what we're likely to see in the coming months is a continued disinflation impulse that continue to filter into the CPI inflation measure just by the way the CPI measure is calculated. So some of that disinflation in shelter is actually already baked in, and we should continue to see that downward momentum in inflation. And more generally, I would highlight that not only that housing disinflation should play a role in bringing inflation lower, but if you take a broader look at the overall inflation picture, we are today in an environment where pricing power has come down significantly, where companies have less room to pass on, these higher costs onto the consumers. We are also looking at an environment where consumer demand is cooling and where the labor market is rebalancing and where wage growth should continue to moderate. And all of these factors should, put inflation and keep inflation on that downward trend. Now, what the latest few months of data have showed is that this is a bumpy path and that we've seen slower progress over the past few months. So the Fed will want to see more good inflation data before starting that easing process.
One of the most read stories so far this morning is the Citadel founder, Ken Griffin, and we can get more on this call in just a moment, but he's saying that the Fed does need to move slowly in reducing rates. You've got markets that are pricing in around 3 cuts this year. I think you're calling or seeing around 100 basis points of cuts. Is that the right pace of reduction, do you think?
I think the Fed is going to be well positioned in the middle of the year to start cutting interest rates. Fed Chair Powell last week mentioned that we're not too far from that confidence, and we are expecting to see that disinflation trend resuming in the coming months, and that should lead to the Fed, starting to gradually ease monetary policy. It is not going to be a fast process. The Fed is going to proceed very carefully, but we do expect to see, 100 basis point of rate cut this year as inflation continue to come down, and as the Fed really want to balance that risk of keeping interest rates too high for too long and risking some damage to the economy and potentially a deeper economic slowdown or a recession.
The jobs numbers on Friday was also quite perplexing for the market, right? We saw that pretty immediate reaction. I do wonder, how are you seeing this being conveyed through the strength of the US consumer? Are there any concerns at this point?
Yeah, the labor market has showed continued resilience. I think the February report came as sending some reassuring signal. Payrolls remain, quite solid, but at the same time, we saw these signs of softening beneath the headline print, which suggests that we get more rebalancing and further easing in wage growth. We saw some downward revision to the prior month's payroll numbers. We saw the unemployment rate also starting to move higher to 3.9%. And we saw also some easing in wage growth. So overall, we have a labor market that is gradually rebalancing. There is no retrenchment. Companies are still hiring. And that should continue to put a floor under income growth for consumers. And so we should continue to see that positive momentum in real disposable income for the consumer. So looking at the overall consumer picture, we are expecting to see continued positive momentum in consumer spending. Looking at the numbers in the first quarter, we have consumer spending on track to grow above 2%, and overall economic activity, economic growth on track to grow above trend as well. So I think that the dynamics in the economy remain quite encouraging.
All right, Lydia Bassour there, senior economist at EY. And let's get to morning calls now ahead of the Asia trading day, because that inflation print, certainly a number that wasn't really a shock to traders on Wall Street. We actually saw stocks climbing to a fresh record. But despite that, Morgan Stanley's Mike Wilson sees no reason to upgrade his outlook on U.S. equities. He's sticking with his year-end forecast of 4,500 for the benchmark S&P 500 index. That is roughly 8% short of the average year-end call of Wall Street strategists that are tracked by Bloomberg there. Wilson says broader earnings growth, that is what is missing for him.
Exuberance is pretty high. Now, that doesn't have to end in tears, okay? Leverage isn't always bad. But, we have a situation where people are reaching for risk because, there's FOMO. We're probably a little bit more cautious than some of our peers. I think a lot of folks, all they've done is raise their price targets based on higher multiples, and we're not willing to do that.
And as we just discussed earlier with the guest, the Citadel founder Ken Griffin says the Fed should move slowly in lowering interest rates. Griffin says pausing and changing back to higher rates quickly would be the most devastating course of action. He thinks rate cuts will be slower than expected. Last week, we heard the Fed Chair Jay Powell saying that policymakers are nearing the confidence that's needed to start lowering rates, Heidi.
A few interesting calls out there, and it kind of shows just how precarious perhaps expectations are as to how central banks are going to proceed from here, and a lot of focus when it comes to what we're expecting from the Bank of Japan as well. But here in the first 40 minutes or so of trading in Australia, we're seeing the ASX 200 pairing some of those earlier higher gains, about 0.2% higher. We are seeing a little bit of outperformance in some of these really thematic names. Treasury wine and Australian vintage, some of the winery related names are doing particularly well today, over 2% and 3% higher respectively, as we see these expectations build that the almost 3-year-long punitive tariffs on Australian wines from China may be eased in the coming weeks. So some optimism in that sector. We are seeing broad downside though when it comes to trading in Kiwi stocks there. Singapore Nikkei futures setting up for a pretty firm open in Japan though, as these expectations continue to rise on what we see from the Bank of Japan. The sort of accumulation I should say of data from these wage negotiations will really be key in terms of whether negative rates will be ended sooner rather than later. Also watching the yen as well. Is this major yen rally finally underway, or do we see a bit of a bull trap with the Bank of Japan, as well as more signalling from the Fed in their meeting next week? More ahead here on Daybreak Australia. This is Bloomberg.
You never hear people saying, I want my little boy to grow up to be an insurance person. Did your parents tell you to be in the insurance world?
I really liked the insurance sector at the time. We are basically promoting and ensuring social cohesion. And at the time, I wanted to make a difference and wanted to go in there.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is South Korea's top financial regulator says the nation is determined to boost the value of its listed companies. This comes as the country looks to create a financial system that encourages firms to rely on equities to raise capital. For more, let's bring in our Asia Stocks reporter Yu-Kyung Lee from Seoul. And Yu-Kyung, this was a really great interview that you had with the Financial Services Commission Vice Chair Kim Soo-young. That was, I believe, the first time ever that he sat down for an interview, at least with Bloomberg. So a lot of lines came from it, but just tell us what were the key messages from that interview.
Sure. So this was his first ever interview since he became the vice chairman at the South Korea's financial regulator, Financial Services Commission in 2022. And he told us about why South Korean government is so committed in ending the stock market discount called Korea discount. Because South Korean government sees ending the stock market discount and boosting the valuation of the listed company as a way to solve a lot of economic problems that Asia's fourth largest economy is facing, such as aging population and slowing growth. There is a huge economic rationale behind the government's big push to end the Korea discount. So he told us that through this, if this program becomes successful, the citizen will be able to create their wealth through equities, which would help the aging society, aging population, and the companies will be able to raise the capital from stock market more efficiently, which would also help the slowing economy. Now, South Korea is one of the fastest aging society, and its growth is really slowing. So you can understand this. There's a great economic rationale behind this. He also gave us some first look into some of the incentives that the South Korean government is going to unveil in order to push local listed companies to enhance their value, and that will include easing tax on dividend income, which will be seen as a big incentive to the companies.
There was the blanket ban on short selling that was announced in November. Did we get any kind of indication as to how that's going and when it might potentially be lifted?
Sure. So Mr. Kim spent a lot of time telling us about his rationale behind the short selling ban and also what the government is going to review before considering ending the short selling ban. So one of the things that the government will look at is they want to improve this current short selling monitoring system, short selling activities monitoring system, so that they want to make sure that we have some kind of system in place so that we can see each company can see that they have enough outstanding balance of borrowed shares before they short any stock. So we can understand that the South Korean government is going to implement such system within each individual companies before they do the short selling, so that they want to reduce potential illegal short selling trades that could happen. So these are kind of the system that the South Korean government wants to see completed before they determine lifting the short selling at the end of June. Another thing that he also mentioned was that he said they will also look at financial conditions, market condition at the time. And although he said the likelihood of the market instability is very low, market condition is also another thing that the authority will look at before they determine to end the restriction on short selling in South Korea.
Well, Asia Stocks reporter Yu Kyung Lee there with some of those insights from the FSC Vice Chair. Well, from Korea to Japan, the Bank of Japan's lack of exchange-traded fund buying is spurring speculation that the central bank will stop purchasing ETFs to try and make the nation's stock market healthier. Our senior Asia stock reporter Hideyuki Sano is with us. And Hide, so why did the BOJ refrain from buying stock ETFs?
Hi there. So the BOJ's action, or lack of action rather, on Monday basically fed into speculation that the BOJ is thinking of policy change next week. Now, we have been talking about the likelihood of the BOJ's ending its negative interest rates, so that's one thing. And another thing is the BOJ's action on ETFs suggests that the Bank of Japan may finally end its ETF purchase program, which was introduced almost more than 10 years ago. And it's still not clear in the market exactly what the BOJ is going to do on ETFs. Some people say the BOJ can just stop ETF buying without officially saying so, because that's what they have been doing after all. The BOJ has reduced the amount of ETF purchase in recent years without saying anything. Officially, they say they can buy up to 12 trillion yen a year. So that's possible. Some other people think the BOJ will officially say the program is over. We still need to look at what the BOJ is going to do, but the markets are clearly looking at the BOJ's next steps.
And if the BOJ were to sort of whole-scale scrap this program, what would be the implications then for the stock market?
Yeah, so I mean, yesterday the Nikkei underperformed the regional markets, and clearly that was because of the shock from the BOJ. But looking at the longer-term implications, I think most market players think it's a good thing because if you think financial markets are more efficient at allocating resources than the government, then obviously it's a good thing for the government to leave markets to decide what the best is for the economy. And the Bank of Japan, as a result of its massive buying over the past 10 years or so, is now holding more than 7% of Japanese stocks. And that's really a huge amount. And especially the BOJ has bought Nikkei-linked ETFs, which means that it has more than 7% stake in Nikkei heavyweight companies such as Fast Retailing, Advantest, or Tokyo Electron. And many people think this is exactly why those shares have very high valuations, and that has driven up liquidity of those shares. So the absence of the BOJ is probably a good thing for many investors.
Yeah, a lot of criticism that it's damaged the ability to efficiently allocate capital, right? Will the BOJ ever sell?
Exactly. Yeah, that's a very interesting question. But I can say at the moment that virtually no one expects the BOJ to sell any of its holdings anytime soon. I mean, once the BOJ says it's considering selling, then that will cause a huge shock to the market. So that is not something that any policymakers in Japan is contemplating. That said, if the BOJ does end its stock purchase program, I think the debate will gather momentum about what to do with the BOJ's massive holding of stocks. But at the moment, no one has any clear answer to that question, and it's most likely that the BOJ will just stick to what it has without selling. And at the moment, they can afford to do that because they have huge unrealized gains on their stocks.
All right, something to track pretty closely. That was our senior Asia stock reporter there, Hideyuki Sano from Tokyo. And remember, Bloomberg users can interact with the charts shown using GTV Go. Browse recent charts featured on Bloomberg TV to catch up on key analysis and save charts for future reference. More ahead. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Taking a look at the latest stories on the corporate front, and Simon Cooper, who was a frontrunner to replace Standard Chartered CEO Bill Winters, is leaving the bank as part of a broader management reshuffle. Simon Cooper has led the lender's corporate, commercial and institutional banking division for 8 years. According to a statement, he's exiting to pursue other interests. Our sources have said the bank plans to strip out a series of regional reporting lines in the division, which could lead to several executives losing their jobs. China Vanke is said to be in talks with banks on a debt swap that would help the developer stave off its first ever bond default. Sources say Vanke's major creditor banks are considering a plan to swap bond holdings worth tens of billions of yuan in principal into secured debt. The firm's cash crunch has become a major focus for investors, trying to gauge how much help Beijing and its banks will provide. Shares of Coinbase slipping in after hours after the crypto exchange unveiled plans to offer $1 billion in convertible senior notes to repay existing debt. The firm says notes maturing in 2030 will be sold through a private offering to institutional investors. The notes can be converted into cash, Coinbase shares, or a combination of both.
Well, take a look at how we're seeing the FX side of things really pass through the mixed US CPI report, leaning towards a little bit hotter than expected across some of those components, and therefore potentially downsizing expectations from the Fed ahead of next week's meeting. Certainly expectations when it comes to communication are not much of an impact in terms of actual expectations that they'll make a policy change. But we are seeing the Bloomberg Dollar Index pretty flat at the moment. We did see the dollar firming somewhat after the core CPI exceeded forecast. The question now really is for what happens with the yen. We've had this big rally, or signs of a big yen rally underway, but could this potentially be another bull trap? And the answers will be found, one assumes, in that Bank of Japan meeting kicking off on March 19th, and we are getting the wage numbers ahead of that. This is Bloomberg.
I think I was around so many powerful people my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down
is creating animal spirits again.
Bloomberg. Context changes everything.
This is Bloomberg.
This is Daybreak Asia. We're counting down to Asia's major market opens. And Heidi, lots of different focus points in the session. US inflation, of course, but there's also what's happening in Japan and really that big watch on wage negotiations and any sort of pay bumps. What sort of reporting are we going to get later today?
Yeah, too close to call. You know, some of this data could take a while to kind of really be brought together, but we're looking for a number around 3.84% in terms of those wage gains. And, you know, Belle, I don't want to say it, but if that disappoints, we could see a pretty massive reaction in these markets.
Absolutely, yeah. We've really just seen so much agitation now for the BOJ to shift its policy settings as soon as next week. And that's really the dynamic that's been playing into markets as well, because we've seen that yen strength coming through. It's been high for 4 straight weeks against the greenback here. Today, fairly steady, but you're still trading around that 147 mark. Really something that has been weighing on equities over the course of this week. We saw it hitting Japan stocks broadly, but tech really feeling the brunt of it. Today, so far in the session, we're actually moving a little bit high. So is a reflection of that other theme we're tracking today as well. US inflation print, a little bit hotter than expected, but not too hot to really shock markets as well. And so we actually saw stocks on Wall Street climbing to fresh records here. So that is a positivity coming into the session. But as we said, a lot of unions in Japan are going to be reporting on wage or pay deals this week. And Wednesday is going to be the heaviest day, or amongst the heaviest day for announcements before we get that final tally, or that first tally being reached and reported on Friday. So that's the state of play for Japan there. Let's shift it to Korea now. Take a look at what's going on in the session so far. Of course, a market that's heavily correlated with the dynamics of Wall Street. So unsurprisingly, you are seeing stocks here that are moving to the upside. Tech names really the ones to be watching here, because we did see the likes of Nvidia, for instance, Oracle as well, though that was also an earnings story, but both of those moving high in the prior session. The Korean won, you're seeing just a little bit of weakness coming through, but fairly steady so far, because we are, of course, in Asia really bracing for that impact from a stronger US dollar. So that's something else that we're tracking so far, Heidi.
Yeah, the currency effect will be quite interesting to watch, even as we kind of see a pretty mixed picture. In fact, the Aussie dollar holding up quite well. But of course, that's also a China proxy. We're also getting some positive news flow for these Australian markets when it comes to the bilateral relationship. We are hearing potentially ahead of that visit from Foreign Minister Wang Yi that's expected in the next couple of weeks or so, that we may get an easing to these punitive trade tariffs on Australian wine of 218%. They've been in place for almost 3 years. We're seeing a pretty outsized reaction when it comes to the likes of Treasury wine, Australian vintage, and similar names there. The broader markets are trading quite well at the moment. We're getting support from financials, consumer discretionary stocks. Pretty modest rise there of about just under 0.2%. The Aussie dollar, as I say, holding steady at 66.08. We're also watching oil markets at this point as well. We're seeing some gains. New York crude just under $78 a barrel. Industry reports pointing to declining US stockpiles. So we are seeing that advance for crude for the first time after 4 days of losses, and that is offsetting the wavering situation when it comes to OPEC cuts as well. We did see the industry-funded American Petroleum Institute reporting that inventories fell to 5.5 million barrels last week. Switching out the boards and taking a quick look at treasuries, because so much of the focus, Belle, obviously has been on how we decipher the various elements of that pretty mixed US CPI report. Some good news in terms of rental shelter costs coming down, but that supercore, the so-called supercore gauge still being much, much hotter than what the Fed would like to see. We have seen treasuries extending those declines. Pretty weak demand too when it comes to that 10-year auction as well. That result trailing that sell-off that was sparked by the inflation data initially. Swaps, I should say, Bill, I should remind everyone, still pricing in a nearly 70% chance of a cut by the Fed by the time we get to June.
Yeah, but it does seem, at least, Heidi, there's still a little bit of life in the sticky inflation narrative. But let's discuss now, bring in our guest, Daniel Lamb. He's Head of Equity Strategy at Standard Chartered Wealth Management. And Dan, what were your key takeaways from the US inflation print? And importantly as well, when it comes to the bond space, how should you be positioning yourself at this point in time?
Well, actually, it continues a theme that we've been seeing since the non-farm payroll, okay? So that too was a little bit mixed, right? And the picture is not so clear in terms of, how much or when the Fed is going to cut anymore, right? Because they need to watch this inflation number, okay? There's still some stickiness in that front. So basically, you are seeing a broadening out, at least, for example, in the equity space, a broadening out of the rally, okay? We've seen that during the earnings season where, many analysts are cutting Magnificent 7 to 6 to 5 to 4, et cetera, right? So areas in the growth side being concentrated into even smaller sectors, segments, right? And equity is still rallying. So what that means is that the rally is being broadening out to other stocks, to other sectors. Okay, so we're seeing some selective healthcare stocks doing very well because some investors would like to have some defensive exposure, right? And also some of the sectors. So what that means, going back to the bonds market, is that the one-way train of the yields coming off and bonds rallying, the treasuries rallying, is becoming a murkier picture, right, because of that. So probably the US 10-year yield is likely to have some upside from here. So I would believe that the Treasury's weakness is not finished yet. It could well go to 4.5%, the US 10-year yield.
Of course, a lot of investors have been really wrong-footed by bond trades over the course of this year. What would you say to people that are perhaps getting a bit attracted to the security of cash, for instance?
Well, the cash, always in times like this is an easy way out, right? Because you're saying that here there's a very good deposit rate, and you're away from the volatility in the bond market, right? If you put into cash deposit, but cash deposit is not really a long-term solution. Like you can lock it in for 6 months, for example, but then after that, what? You have reinvestment risk. So, in the medium to longer term, it's still better to lock in these quite good current levels for the treasuries. But you may like to do it in stages, right? Time it better and add gradually.
You mentioned the Magnificent 7 that's really been whittled down to, perhaps around 4 names now. But would you still be adding to any sort of positions or recommending people add to positions in the likes of NVIDIA or Meta, for instance?
Well, basically, those 7 stocks are a long-term growth story. So for the next 3 to 5 years, if you take that horizon, you should be adding on dips, right? Because they are really the stocks for the future. Having said that, and for the short term, for like 1 to 3 month horizon, adding to them right now could be a little bit too high. You have to be very selective, right, amongst the 7 names. So we have been recommending clients to be adding to areas such as healthcare, okay, because the earnings have always been stable, and there are actually some quite outstanding fundamental stories as well within that space.
Are there any constructive themes out of China for you right now?
Oh, right now China is not looking so bad, judging from the latest price action, the reactions, right? So of course they had the quite a big pullback on the day, of the MPC, but then after that, it seems that investors have been coming in with very good volume. Hang Seng Index is now back above the 17,000 mark. So things are looking okay. I would say that for selective consumption names, China is looking quite interesting on that space. Plus, also the banks have been doing quite well. Of course, they always have the dividend angle. But in times like this, in the early stage of the rebound, they have been doing pretty good. So I would say that some of the consumption names, the banks, and also the SOEs in general.
There's a big question mark over Japan at the moment, both in terms of where the yen rally goes and where the equity rally goes, right? How endangered and I guess how correlated is that relationship depending on how the Bank of Japan proceeds from here?
Well, we've been saying that the Bank of Japan is very likely to be tightening policies. So that has always been a key risk for Japan equities. But we do see this risk as an opportunity for investors to be adding to the positions because the improvement in the corporate governance and also the valuation is still attractive. Those are key factors for a medium to long-term rally. So yes, there will be hiccups, and it seems that these couple of months would be a little bit rough for Japanese equities, but at the same time, they can give you opportunities. In sector-wise, you would probably need to be doing some rotation. So we've always believed that the financial sectors, insurers, and the banks, in a tightening BOJ environment, they can do pretty well. Okay, so investors should really be looking at those.
Daniel Lam, that was the head of equity strategy at Standard Chartered Wealth Management there this morning. Coming up, the result of Japan's spring wage negotiations are due before the BOJ's monetary policy decision next week. We'll have the details ahead. This is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
It's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly.
This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%.
It is coming down. But it's going to take some time, and that's okay.
I do think things are moving in the right direction in terms of prices.
But it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
So far, I think they want to cut, and we expect to see that in the May or June timeframe.
Bloomberg TV guests are reacting to the latest US CPI data. Well, the US dollar in focus after the release of that CPI print, and strategists seeing that dollar strength coupled with higher Treasury yields will be hard for Asian bonds and currencies to shrug off. Let's bring in our MLive strategist, Mark Cranfield, for more. So, Mark, I suppose How much conviction is there in the direction of the dollar coming off that inflation print?
I don't think it's made a huge difference to what foreign exchange traders were thinking, really. They know that the two major events coming up in the next week, obviously, are the Bank of Japan meeting followed by the Federal Reserve. So that was always going to be the big picture on the agenda. Where the CPI may come into the picture is that it could make a marginal difference as to what Fed people are thinking in terms of their dot plots, but they'd probably already made up their minds anyway, whether there's going to be changes to those plots. So traders will certainly be interested in how the plots are projected when the Federal Reserve announced that next week. But in the immediate picture, probably the Bank of Japan meeting weighs even more heavily on what foreign exchange traders are thinking. Because if we do get surprises from the Bank of Japan, the extent of which they're willing to make policy changes will have a very big impact on dollar yen, and where dollar yen goes, it will move the rest of the foreign exchange market. We've seen already in the past couple of weeks that when dollar yen starts to pick up downside momentum, it moves everything with it. The euro, the pound, the Australian dollar, even the Chinese yuan are all in its tailwind there. So really, now is the question of, we've been told this Bank of Japan meeting is too close to call, and what traders are trying to gauge now is, are we going to get a big whammy? Is it going to be the end of negative rates, the end of yield curve control, the end of ETF buying? Is it all going to be done in one measure, or are they going to try and stagger the thing? So they're going to test out the waters, maybe by dropping yield curve control at the next meeting, and then dropping negative rates at the meeting after that. So really, that's what traders are trying to weigh up. And certainly, where dollar yen goes, the rest of the market will follow.
And Mark, as you've been writing about on the blog this morning, the Bank of Japan, yeah, maybe too close to call at this point, but as you say, negative real yields are not.
A long way. I mean, if you look at Japanese 10-year yields, where we haven't even reached 1% for 10-year Japanese yields, and the way the Bank of Japan has been defending the market, making sure that moves are very gradual, it's going to be a very long time before 10-year yields get anywhere close to the inflation. If you look at headline inflation, it's around 2% in Japan. Even forecasts within Bloomberg surveys are not looking for anything like 2% yields. They're looking for only 1% yields next year, let alone this year. So the upward movement in yields, even in the long term of the Japanese market, is probably going to be pretty slow. And if you look at core inflation, of course, it's even higher. It's still above 3% in Japan. So we're going to have negative real yields for a very long time. That obviously has a slightly downward impact on the Japanese yen. So whatever happens in terms of dollar yen movements, either triggered by the Fed or by the Bank of Japan, everything will be moderated when people take into account that real yields are going to stay negative for quite a long time in Japan.
That was our MLive strategist, Mark Cranfield, there. And of course, the direction of what the BOJ does next week really hinges on the outcome of wage talks. Now, we've got a wide range of unions that are going to be reporting on wage deals over the course of this week. Wednesday, today, amongst the heaviest day for announcements as well. So let's get more with our Asia economy and government senior editor, Brian Fowler, joining us this morning from Tokyo. So, Brian, the signals so far are looking pretty good for salary rises in Japan.
Yeah, that's exactly right. We expect wage increases this year to outpace those achieved a year ago, and we're getting signals every day. So the annual wage talks culminate on Friday when Rengo releases a final tally. But Rengo is a huge collection of unions, and a bunch of those unions are going to be releasing their tallies today, those results. So that's kind of a leading indicator for what the ultimate number will be. Also today, we've got Toyota coming out with its deal. That's just one company, but it's obviously a very huge bellwether company for the rest of Japan. So that's going to be a big piece of news coming in just a couple of hours.
What's the danger of an undershoot here, particularly as we know it's sort of, it's not necessarily one clean set of data, right? It takes a little while to be able to bring it all together.
Yeah, an undershoot would be a huge shock. I mean, everybody is pushing for big wage increases, including Prime Minister Kishida. A lot of his support rating has come to a new low over the last week. And part of that is households getting really frustrated with the steady decline in real wages as wages don't keep up with inflation. So that would be huge if it did undershoot. But I think the chances are that that won't happen. Everything points to bigger increases. There's so much pressure, both from in terms of society demands, but also the labor market has a chronic shortage of workers, and that's forcing companies to lift wages in order to attract the people they need to keep their businesses running.
Are we seeing a virtuous growth cycle in terms of confidence in that reinflation effect? Is that feeding through to confidence in households and what they're spending, given we've seen domestic assets trend lower?
That's an excellent question. And the fact is, no, we really haven't. So consumer spending in the last quarter, we had revised data a couple days ago. Those figures were actually revised down for consumer spending. Household spending has fallen in 11 straight months from earlier levels. So far, consumers are really reluctant to spend. However, if we get wage hikes that are of the magnitude that we expect, somewhere around 4%, maybe higher than 4%, that would outpace inflation. So maybe for the first time in a long time, consumers would feel like they've got a little bit more wiggle room to spend money, and that could push us that last little inch towards achieving that virtuous cycle that the BOJ's been looking for so long.
Our Asia Economy and Government Senior Editor Brian Fowler there ahead of what is a crucial few days for Japan. You can get a roundup of that story and the others you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can get that at Daybreak on your terminals. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings so you just get the news on the industries and assets that you care about. This is Bloomberg.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Taking a look at energy markets are faring this morning. You've got Brent, crude, WTI, both of those just moving a little bit higher so far. We did actually see oil prices dip following that US inflation print. There was also stories or a report coming out from OPEC around countries not meeting their production quotas. Iraq is one of those that's exceeded for a second straight month. So something that did play into the dynamic. But let's focus now more on energy and oil markets, bringing our energy and commodities editor Andrew James in Singapore. And Andrew, Actually, we're focusing a lot on two of the most consumed fuels, that's gasoline and diesel. They've actually been seeing price gains that have outpaced what we've seen for crude oil.
That's right, Annabelle. In the US, we've seen gasoline futures up by about 20% this year. That's ahead of about a 7% rise in global benchmark oil prices, and diesel in Europe is up about 10%. There's a number of factors behind this. We've had some we've had outages at refineries, both planned and unplanned. We've also had drone attacks on Russian refineries. This is coming on top of all the transport disruptions we have from the Houthi attacks in the Red Sea, which is adding transport costs, and that in turn is on top of the disruptions to the market caused by the Western sanctions on Russia. So all those factors are sort of, funneling into fuel prices more than oil at the moment. And another interesting factor is high-octane blending components, which are added to gasoline. Now, there's a shortage of these in the US, and that's mainly down to the sanctions on Russia, because that's sort of restrict the flow of heavier crudes, which are used to make that. So, yeah, all those factors are funneling into this big surge that we're seeing, particularly in the US for gasoline prices.
We're also seeing, of course, headed into the start of the peak US driving season, there are political implications too, right? Is there anything that President Biden can really do before November?
Yeah, well, if you look at prices at the pump in the States at the moment, they're now about 60% higher than they were at the beginning of November 2020. So that's potentially a big headwind for Biden in terms of, how well people are feeling about the economy, feeling about their own sort of economic health as they make up their mind who to vote for. We also have US fuel stockpiles running pretty low, and the US strategic reserves are also pretty low. And as you mentioned, we've got the peak summer driving period coming up. So all that adds up to a fairly grim outlook for Biden in terms of oil prices, and there may not be that much he can do to get gasoline prices down.
What are we seeing out of Russia at this point? Because we did hear from Vladimir Putin supporting those OPEC plus oil cuts, but also warning of the risks.
Yeah, well, Russia's in a bit of a unique position with the cuts, and it has the ability to sort of flick between production and exports. So it can actually adhere to the production cuts, but keep exporting more. Obviously, we've got another OPEC plus meeting coming up. I think it's a couple of months away, and there's probably going to be more pressure from Russia and others in the group who want to pump more. The Saudis, of course, seem keen to keep the cuts going so they can try and buoy the prices, but some of the OPEC members want to pump more, and we've just heard, as you mentioned earlier, about Iraq exceeding its quota. So that will be, definitely an interesting meeting to watch.
Energy and Commodities Editor Andrew James there. Take a look at how futures in Europe are tracking at the moment. And this, of course, we continue to pass through not just, of course, the implications of that inflation print, quite mixed as it were from the US, but also looking ahead to these wage negotiations in Japan and how that feeds into the Bank of Japan. We are expecting to see a little bit more upside when it comes to European futures. They're up by about 0.2% there. We did see the Stock 600 really extending gains and hitting a new record after that overshoot in US inflation. Really didn't have much of an impact when it comes to European confidence and risk appetite in the markets in that previous session. That benchmark about 1% higher in London, the biggest jump since January, in a pretty broad-based play across sectors. But watching currencies as well, given the move in the dollar.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
China Ivanka is said to be in talks with banks on a debt swap that would help the developer stave off its first ever bond default. For more, let's bring in our bond and loan reporter, Loretta Chen. And Loretta, does this signal that Ivanka is in really quite deep liquidity trouble at this point in time?
Yeah, that's true. It's the first time we ever hear Vanke actually trying to get some debt reprieve on its public bonds, and that will have more impact than the private debt talks that we have reported over the last few months. So it does seem like the liquidity crunch at the company is reaching a new level at this point.
How important is Ivanka? You know, it is a household name, right, to the broader real estate sector.
Yeah, I think Vanke really has a systemic importance to China's real estate sector. Over the past 3 years, it's a company that really manages debt really well. Its sales has dropped much less than many of its peers. And most importantly, people are really counting on that Shenzhen metro backing, the government backing, to come out. So I think this will be a moment that tests that kind of government support that Vanke has. And most importantly, if Vanke ever misses a payment, it will trigger a lot of the cross defaults on its massive onshore liabilities, which is over 1.3 trillion. So that's a massive amount. And also, I think people's confidence will really wane if there's any problem at the company. You know, if this is a bellwether of the property sector, if it fails, then people would ask who else would ever survive this crisis.
A debt swap, though, does sort of perhaps push the can down the road to an extent. So how much breathing space would this give the company, and would that really be enough to give it time to turn things around as well?
Yeah, those step talks are happening on multiple fronts. So there's the public bond discussion that are still ongoing, and we don't know if the banks are actually going to agree to extend or help swap all of these bonds. And on the other hand, Vanke is in talks with banks for potential credit lines. So we know that actually in the offshore market here, some Chinese banks are still having reservation in terms of how much they were willing to provide the company with. And I think the Shenzhen government is also very much close involved in these talks about bank credit lines, and we hope that a few months ago they actually came out to say they will continue to support the company. So we're looking for that similar signal to come out again at this time for the company.
Loretta Chen there, our bond and loan reporter in Hong Kong. Well, a bull market begins in a number of sectors in China, indicating that investors are seeing an upside to current valuations amid government efforts to bolster the economy and markets. Let's bring our Asia Equities senior reporter, Abhishek Vishnoy. Abhishek, it's interesting because that first part about efforts to bolster the economy, well, arguably we didn't get very much of that in terms of the strategy from the recent National People's Congress. Is this more of a valuation story?
Well, actually, NPC disappointed only at the margin. China has not been pursuing a big bang fiscal stimulus sort of move for a while now. So, it was sort of foolhardy to expect one from NPC as well. Having said that, markets have started moving higher. This is possibly the biggest up move in CSI 300 that we have seen since the reopening gains, which started last year in October. Now, in this context, if you look under the hood, there are like sectors from old as well as new economy, from solar as well as materials, which have gone into this so-called technical bull market. This price action is actually backed by Beijing's resolve to stem the rout, their steady stream of stimulus measures and tweaks here and there. And, apart from that, if you look, liquidity moves the market in medium term, and liquidity has turned positive. Southbound has been positive for a while now. Northbound saw a turnaround in February. The flows have been positive this month. And if you look for the long-term picture, earnings and economy, they seem to be giving budding signs of, recovery or stabilization. So all in all, put together, this essentially means that the debate would now move from just a tactical rebound to possibly a durable bottom or a sustainable uptrend in Chinese stocks.
Abhishek, we just showed this terminal earlier, and we can bring it back now just to take a look at some of those sectors that have been rallying in particular. So materials, for instance, is standing out. Renewables as well. There's some of the more smaller cap tech companies. Are these the sort of names or areas that you want to be getting into at this point in time?
Well, these are definitely rallying, and these all, most of them actually check in to this new thought that is developing across investment circles about China, that what is this new China going to be? What does Xi Jinping's vision at current valuations mean? The 7 trillion had been lost. Valuations are below 9x for MSCI China Index. So what does this new China mean? New China means the high quality development that he has been referring to, which includes tech, which includes things that will make consumers and citizens' lives easier. New China would also mean high savings growth rate channelizing into equity markets, so something like brokers. There is also this thought that consumption down trading is happening. So anybody making those kind of products where where there is a low price meal, something like Yum China, or anybody who has the power to make the price or have the inelastic demand, say for that matter, like something like cigarettes, this would be the new China that is getting formed now. So to me, I think it's legible to expect that there would be more sectors joining this fray, more stocks which will be seeing more than 20% gain from here. It won't be like how China used to be, but definitely China is looking for more space in portfolios.
What does a rebound in China mean for global equity allocations?
Well, China is looking to command some of its lost heft. So that essentially means that, this rotation that was happening out, from China to, let's say, something like Japan, India, there will be a little bit of moderation in that trend, right? Japan is still very cheap, so there would be only a moderation. Second thing is that obviously, like we established, durable bottom or sustainable uptrend in China itself. And third is that, MSCI EM and MSCI All Country World Index, they haven't really done how, let's say, just US Index or just India Index have done. But with China's participation, we might be looking at a sustainable sort of trend, at least till, let's say, September, October, before, people start positioning for US elections, where they are possibly making newer highs. So, an extension of bull market, to sum it up.
Our Asia Equities senior reporter Abhishek Vishnoy there. Take a look at how equities are trading at the moment in terms of the markets that are already online, and huge implications over the next couple of days when it comes to wage data. We're expecting out of Japan anything around sort of 3.8%, high 3s, 4% is, according to market expectations, enough to get the big Bank of Japan over the line when it comes to scrapping negative rates. So a lot weighing on these numbers. The Nikkei 225 holding up pretty well, about 0.7% there, trading higher is also the Kospi, up by about 0.7%. We are seeing muted gains here in Sydney. We were really coming off those session highs, but outperformance certainly when it comes to some of those consumer discretionary names and financials, in addition to, I should mention, the winery related names as well, on these expectations that China is proposing that it end that almost 220% punitive tariff on Australian wines after almost 3 years. We are seeing a little bit of downside. The underperformer across the region is really New Zealand, with Kiwi equities off by about 0.25%. And we see a little bit of a move when it comes to currencies as well, a bit of strength there in the US dollar. But at this point, the big question mark as to where we go next for the yen rally going into that Bank of Japan decision. We do have much more to come here on Daybreak Asia. This is Bloomberg.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
The World Cargo Symposium is underway here in Hong Kong and is one of the largest annual air cargo events. Let's discuss the demand for air cargo with our next guest, who runs aircraft lessor Atlas Air Worldwide, which has a fleet of over 110 cargo and passenger aircraft. Joining us now in the studio is CEO Michael Steen. And Michael, it's just been such a crazy few years really for this sector or this industry. You had COVID, you had that pullback post-COVID as well. Where are we now in the cycle, I guess?
Good morning, Annabelle. First of all, thank you for having me. It's a really good question. We've had some really interesting years behind us with COVID, with record demand for air freight. And air freight really showed its role during COVID as well in basically supporting the global economy and also saving lives with all the shipments, PPE shipments that was going on. Air freight represents about 1% of global volumes and about 35% of the global value. And where we are now after a very turbulent 2023, when demand dropped significantly, is that the market has bounced back and we're basically 20% year over year better off this year and 4% better than 2019. So demand has come back, but there are still some challenges out there from a macroeconomic perspective.
Well, talk us through what are the challenges and how's that impacting you?
Well, inflation, of course, around the world is having significant impact on demand for air freight. We are seeing that in several markets. But there is both a cyclical and structural change going on in the marketplace as well. And on the cyclical side, we see that any upturn in air freight demand lasts for about 3 years, so it follows the global economy, and then it follows a downturn, which lasts about 12 to 18 months, and we're coming out of that cycle now. There's been one shining light during that period of time as well, and that's the structural change in demand with e-commerce. Now we're seeing a shift from B2B demand to B2C. And that is growing very rapidly. And the other structural change that we're seeing is that we are actually losing capacity in the air freight market as well. So as demand is continuing to grow with an average about 4% year over year over the next several years, we're going to see the supply not keeping up with that demand.
And when you talk about the sort of that consumer segment that's growing as well, it really does make me think of some of the big powerhouse manufacturing companies that are located in China. What sort of read-through are you getting on China's economic health and also that air freighter activity as a result?
Well, we see now, first of all, when it comes to industrial production, that is still not at the level that we're expecting. We're seeing PMI index, for example, at 49, so still not in a growth mode. It has to pick up a bit more, but we expect that will change throughout the year and that we will see growth again coming out of China. But when it comes to e-commerce, it's growing rapidly. E-commerce today represents about 18% of all global retail sales and is growing at a rate of about 8 to 9% a year. But it's significant demand that's coming out of various markets. And of course, China is a very important market there. China in itself represents about 30% of global air freight. So that shows you the importance that China has on the global economy in general.
Kind of leads me into my next question in terms of the overlay of geopolitical tensions, right? It feels like we talk about that every year, but in particular going into a politics and election-heavy year. How does that play out for your business and some of the sensitivities that you deal with?
Well, Heidi, thanks for the question. We obviously operate to 70 countries around the world, more than 220 destinations. So there's always going to be some form of geopolitical disruption, of course, that's affecting the industry and economy. We as a company, we're of course looking at capitalizing that where we can, and obviously be resilient where we can as well. We have as a company diversified our business very, very much over the years, not only geographically, but also service-wise. So I think that we are very, very well positioned to deal with those geopolitical challenges as they're happening. Now, the impact that it's going to have on the economy, I think we have to wait and see. We have seen disruption, of course, in previous years as well, but I think that we are very well positioned as a company, and air freight as an industry is again essential to the global economy and is needed.
We've seen sea shippers confronting myriad challenges at the moment, be it geopolitical with the Houthi attacks, be it supply chain ructions, be it the drought in the Panama Canal. Has that had any kind of benefit for air freight and your business at all?
It has had some for us as a company and also for the air freight business in general. First of all, the situation that we're seeing now around the Suez Canal has a significant impact on overall resources. First of all, you can count on up to 30% more capacity needed as far as ships are concerned, 30% more containers, 30% more resources. And that has, of course, a profound impact on the ability to serve market. And as I mentioned earlier, air freight only represents about 1 to 1.5% of the total volume, and ocean freight is much larger. And as we are seeing inventories being depleted over time, that will mean that there's going to be a higher demand for air freight.
When it comes to high demand for air freight, of course, you'd be a key player in that, and it does necessitate, I guess, some sort of expansion, perhaps for the planes as well. Given the recent weakness that we know that we had in the industry last year, are you using that as an opportunity to buy any second-hand cargo jets in the market?
So we've been quite active when it comes to buying aircraft as well. So over the past 4 years, we have taken delivery of 8 new wide-body freighters. We got the very last 4 747-8s to be delivered. We were happy to take those on, and we have taken on 6 777s as well. And we have bought up to 10 747-400s off lease. So if you look at the total global freighter fleet today, the wide-body aircraft that flies the long intercontinental distances, there is about 650 freighters in the world. We have more than 10% of that capacity ourselves, and we're obviously aiming to grow that fleet as we go forward as well. Now, out of those 650 global freighters, about 125 or so are now coming up to retirement age. And that goes back to my previous question that there is going to be a pressure on supply going forward. So I think that we are really well positioned as a company.
Mm-hmm. And when it comes to other opportunities, are you looking at anything, for instance, growing through M&A?
We have over the years looked at 2 different areas of growth. One is organic growth, and that's expanding our fleet to the 113 aircraft that we have at the moment in our fleet, and then 40 more in our dry leasing portfolio. We have acquired a company over the years as well in Southern Air, and we're currently looking at opportunities to expand our global footprint, expand our services as well, and with a very strong backing of our investors in Apollo Global Management and J. Fleeman Company and Hill City Partners. We think that we're very well positioned to capitalize on opportunities that comes up.
Would one of the strategies be potentially to take more control over JVs?
We're looking at JVs as well as other forms of collaboration models. We have a couple of JVs in place, both with DHL Express in Polar Air Cargo, which has been in place since 2008 and very successful both for Atlas Air and for DHL Express in expanding their capability, service capability. We have a joint venture on our dry leasing side together with Bain Capital Credit, where we're acquiring aircraft and leasing those out to various companies around the world. So I think that there are several opportunities and ways for us to expand.
All right, Michael, that was Michael Steen, their CEO at Atlas Air Worldwide. And some other corporate stories that we're tracking this morning. We're keeping an eye on Boeing supplies in Asia after the U.S. National Transportation Safety Board says it will hold a hearing in August on its investigation into Boeing's door plug blowout. The plane maker is not just facing possible legal issues, but a crisis in confidence as airlines turn away from buying its jets. Major American carriers have flagged their lacking aircraft they planned on receiving this year because Boeing slowed output. Cathay Pacific is set to post its first annual net income since 2019 when it reports earnings later Wednesday. That's as a pickup in travel demand and elevated ticket prices help the bottom line. Air passenger traffic has risen steadily since China fully reopened its borders a year ago. Still, demand hasn't kept pace with the airline's increase in flight capacity. Intel shares are falling in extended trading after Bloomberg reported that the Pentagon has pulled out of a plan to spend as much as $2.5 billion on a chip grant for the company. Sources say the move forces the Commerce Department to make up for the shortfall. It also threatens to limit the total amount that Intel has been expecting to get in federal funding. And you can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about. Plus, become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Latest corporate stories that we're following, and Simon Cooper, a front-runner to replace Standard Chartered CEO Bill Winters, is leaving the bank as part of a broader management reshuffle. Simon Cooper has led the lender's corporate, commercial and institutional banking division for 8 years. According to a statement, he's exiting to pursue other interests. Our sources have said the bank plans to strip out a series of regional reporting lines in the division, which could lead to several executives losing their jobs. Shares of Coinbase slipping in after hours after the crypto exchange unveiled plans to offer $1 billion in convertible senior notes to repay existing debt. The firm says notes maturing in 2030 will be sold through a private offering to institutional investors. The notes can be converted into cash, Coinbase shares, or a combination of both.
The Eli Lilly CEO Dave Rick says the company's working on expanding the supply of its weight loss drug as the global obesity rate increases. He spoke with Bloomberg's Carolyn Hyde at the Economic Club of New York about their plans.
We've really only launched in 3 markets right now in a full form. We're working on expanding supply. In 2022, when we launched Mounjaro in the U.S., between Lilly and Novo combined, we probably made enough of this class of medicines for about 12 million people on the planet.
Just 12.
And 2 weeks ago, the WHO said there's 1 billion people with obesity. So we're a little short of the goal. we set about building new facilities. Novo has as well. They're buying companies, and we're partnering with other companies to expand. But interesting thing is, these are proteins, so they're a very specific kind of medicine that's complicated. And then we put it in an injectable system, which has to be, we can't purify, we can't assure that it's pure at the end of the process. We have to make sure the whole process is. So it's ultra clean room conditions, basically, to make it. And then we put it in a little injection device. That kind of system, probably in the whole world, 80% of the capacity is already controlled by Lilly and Novo. So there are not built sites to go buy or rent to make more. We have to make them ourselves. So we're doing that. We currently have 6 manufacturing facilities under production or being stood up. We had 14 before, so that's like a 50% increase. We'll probably have a few more by the end of the year announced. I mean, we're going as hard as we can. But capital is not the constraint. Time is the constraint. Those buildings take 3 or 4 years from announcement to come online. So right now in the US, there's frustration because there's shortages of these, but we haven't even introduced them in most of Europe or the world. So more to do. One project we're working on could change that, which is an oral solid. So it's not a protein, it's chemistry, and it's not in that injectable device, which is so difficult to make. It's a pressed tablet. There's the world is awash in those capacities. And so should the drug be successful, I think we'll be able to tap into quite a bit more supply, which will be good for the US, but even better for places like Brazil or Mexico or China.
Eli Lilly CEO Dave Ricks there speaking to Bloomberg's Caroline Hyde in New York. Take a look at how we're setting up when it comes to futures trading at the moment. US futures are looking like this as markets have digested really that mixed CPI report. A little bit softer when it comes to trading for S&P futures there. Taiwan seeing a little bit more upside of 0.3%, watching potentially for a bit of pressure when it comes to China stocks, despite, of course, this rally sending a number of benchmarks past 20% from the lows. It is an encouraging signal that this badly battered market may be headed for a more sustainable uptrend after what has been a series of false dawns over the past year, despite still not a great deal of detail in terms of what that broader economic support looks like from policymakers. But there has been signs of more constructive positioning both across old and new economy sectors. That is just about it for Daybreak Asia. Our markets coverage continues.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
I think I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rain World Cup. This is a 3
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Half an hour away from the open of trade in Hong Kong, Shenzhen, and Shanghai. You're watching the China Show. I'm Yvonne Mann. Our top stories this morning. Asian stocks follow gains on Wall Street as traders stick to rate cut bets despite that hotter than expected U.S. CPI print. Chinese stocks in focus as well, and growing signs the market may have bottomed. A Bloomberg scoop, China Wonka is said to be in talks with banks on a possible debt swap to stave off a first ever default. Plus, the BOJ is about to see whether pay hikes are strong enough to warrant exiting negative rates, with results of wage talks coming due. We are tracking multiple things this hour here, whether we continue to see this bull run in Chinese equities, in particular with HS Tech reaching into that territory yesterday. And obviously Asia is doing quite well. We're shrugging off that US CPI print, even though it was hotter than expected. And we continue to see this divergence between stocks as well as bonds here this morning. You take a look at what we're seeing in Japan. Key focus here today is going to be wage talks, wage talks, wage talks. You're going to see a slew of unions and companies that are going to start talking about how these talks came through. Toyota just coming through here, for according to what we're hearing so far, to meet the union's demands for wage hikes in full. That's according to Mainichi there. So certainly that's one to watch very closely, given just how big of a name Toyota is. And really, can the wage talks be better than last year? And is it enough to confirm maybe a rate hike from the BOJ next week? Hard to say, but we'll see. The market certainly has been speculating that all week now. You take a look at how the rest of the market is doing. We continue to watch what goes on when it comes to Treasury yields. So we're stabilizing, but they did pick up when it comes to yields post-U.S. CPI. Golden Dragon had 4% pop, guys. So very much focusing on the tech plays in China here this morning. And really, any signs of this being a sustainable trend, or is this just a false dawn when it comes to China equities? You watch what goes on when it comes to futures and the setup here today. Obviously, we talk about HS Tech. We'll talk a little bit more about the other benchmarks that are seeing this sort of bull market territory as well. A50 futures are slightly lower this morning. We are seeing CGBs, that rally, taking a bit of a breather as well, just given the surge in stocks that we're seeing yesterday. It was the tech space. You have names like Xiaomi in double-digit gains, materials, renewables, as we'll see, very fun. Property stocks also seeing massive gains as well. 718.63. It's a stronger renminbi here this morning as well, despite the dollar actually seeing one of the biggest gains this month of March, I should say. Take a look when it comes to this agenda, right? So we talk about bull market watches, Wonka, as well as Country Garden. There's been some talks there about Can Wonka actually avoid this default? CGB drop, as we talked about, so earnings on tap here with Cathay, Samsonite as well. We're still waiting for that credit data out of China, and there is this looming U.S. vote when it comes to TikTok and whether it's going to be more of a divestment or a total ban. We're certainly going to talk a bit more about the geopolitical implications of that as well. All right, so we talked about HS Tech, right? That's certainly the one benchmark to watch here, of course, as we got to that 20% gain. So technical bull market that we're seeing across that HS Tech here. It's interesting, right? So we're starting to see momentum, really the strongest in July. If you take a look at how these RSIs are looking at the technicals and everything, and they're joining not just the tech space, but you take a look at the Chinex, for example, in Shenzhen. That's already been in a bull market for some time now. And materials, you also look at renewables. These are certainly some of the sectors that are actually doing quite well as well. So what is next? Is there more to this? Let's bring in Nathan Thoof, the CIO and Senior Portfolio Manager at Manulife Investment Management in town from Boston. Nathan, it's great to have you back here in the region. Does this rebound in China stocks feel different to you?
I'm not sure. I think it's a little early to say it feels different, but I do have more optimism about the opportunities in China than what the base case or the sentiment would suggest. I think there's still a lot of folks out there that are very negative and very skeptical every time there's a rally in Chinese equities that, oh, this is just another head fake. But I do think ultimately during the course of this year, while we'll probably still see some zigzags and some efforts to pull things back, I do think ultimately we see an upward trend and a more positive view on Chinese equities than we've seen particularly over the last several years. And so we generally are in the camp that the pessimism is so bad that you're now finally starting to see more interest and some traffic and some dollars starting to move back into these areas.
MPC was underwhelming. What's going to be the next narrative to watch then?
Well, right now, everyone, because MPC was basically at best in line and nothing was surprising, now everyone's looking for what's next. What's the next catalyst? And our view is it's going to be focused on the economic developments and then the follow-through on policy. And so we do anticipate we'll see continuation of some stimulus. It will never be a bazooka or a big bang approach to it, but I think the additional accumulation of stimulus, whether it's monetary, fiscal, or a combination of other policies, in aggregate over the course of this year, and I do say over the course of this year, because some of this stimulus might not happen until the latter half of the year, particularly on the monetary side where we do anticipate some downward trend towards interest rates still.
And is China then going to be more an equity story, you think, or is it going to be also still that fixed income, that CGB rally that continues to be a bit relentless? We're seeing a bit of a pause lately, though.
And the biggest bang for the buck is going to be equity. I mean, obviously the beta is in equity, and so if we do see a resurgence in the economy in China and more broadly in the region, the equity is where you're going to see the most volatility, but also the potential for the most upside. So when we're looking at it from an asset allocation perspective, we are looking for where we can get the best capital usage of our dollars, and generally speaking, in the case of this example, it's going to be in the equities.
And is it that mostly the tech? I mean, it seems like the tech sector is leading the charge right now, but we talked about materials, renewables, just given the policy narrative we've seen coming out of MPC as well. What's going to lead the way in this review?
I don't think it needs to be exclusively tech, but I do think it needs to rhyme with where the policy efforts are. And tech in some of the more new age areas for the economy are where they are. So renewables, you mentioned that earlier as having some good days. Yeah. It's tech more broadly. It's parts of the material sector. It's areas where there's a bit of focus to try to have that as the form of growth within the region. And also I would just point out, particularly on the tech side, a lot of the names haven't participated in the tech boom that we've seen globally over the last years. And so there are some relative value opportunities in the Chinese tech market versus what you might find in the United States or in other areas of the world.
Okay, Nathan, hold on a thought. I want to talk a bit more about some of the headwinds that we're seeing in China as well. I mean, China Wonka certainly is the key focus here this week, said to be in talks, according to our reporting, with banks on a debt swap that would help the developer stave off its first ever bond default. Let's get to our bond and loan reporter, Loretta Chen. She's here with us. Does this move suggest Wonka is, in fact, in deep liquidity trouble?
Yeah, it's the first time we ever hear those discussions restrictions involving Vanke's public bonds. So there's definitely an attempt at least to contain any potential impact on the market within the private market. So they're swapping these public bonds into secured bank debt. So the banks are stepping up efforts, on the other hand, also to try to give some kind of a breathing space for Vanke, because they're the holder of these debt. So if Vanke ever fails to pay any of these onshore bonds, then all of its bonds will become immediately due, and that's going to be catastrophic for the company's liquidity.
We talk about the state ties. How far do those state ties go with this developer, and how important is Wonka to the overall sector in general?
Yeah, to step back a little bit, Vanke is a good example of how China used to reform its state-owned sector. So Vanke has a big share. Its biggest shareholder is the Shenzhen Metro, but Shenzhen Metro is not directly involved in the day-to-day operations of the company. And at this time, when Vanke is really facing some liquidity trouble, we have seen in a couple of months when the Shenzhen government actually came out to say that they have support of the company, and that indeed boosted market confidence. But on the other hand, we do need to see concrete efforts. For instance, the banks, are they actually giving credit lines to the company? Right now, we're hearing a lot of rumors around potential onshore loans, and in fact, offshore, Vanke is also organizing such syndicated loans, but it seems like the discussions has come to a halt when banks are pressing for more collaterals.
There's been some talk about some of these Chinese provinces expanding these options for fixing some of the debt strains that we're seeing among these LGFVs. Can you tell us a little bit more about that too?
Yeah, so in the LGFV sector, it's still a very high priority for the government to really just reduce the total outstanding debt that these companies have. So, for instance, last month we have seen in one of the provinces, Guizhou, they were trying to help SOEs to issue public bonds in order to pay back LGFV debt. So there's a lot of efforts being done by state-owned companies actually to give money directly to the local governments in order to help their debt. So I think there are a lot of creative ways that the central government is probably coming up to help deal with that liability issue.
All right, Loretta, thank you. Loretta Chen there joining us from the China credit team as well in the latest when it comes to Wonka. And of course, Nathan Thuft is still here with Manulife Investment. I mean, people talk about this rebound, if it's going to be a V-shape, it's going to be L-shaped, or what? I'm just wondering, does the property market still the big sticking point here, whether we do see how big this upside surprise is going to be when it comes to equities?
I mean, the overall commercial dynamic from the residential as well as the more business side of the housing market is a challenge, and it's going to be an overhang for the foreseeable future. So I don't see how you're going to dismiss that as it's in the past, because it's going to linger for some time. But I do think a lot of the broader downward pressure is arguably priced into the market. And so I think there is opportunities, as was alluded, there's going to be a lot of efforts, whether it's more on a localized basis or on a broader Chinese economy basis, to try to pull this back up through creative ways from a policy perspective. And so I do have a level of optimism that you're going to be able to solve them as the dominoes kind of continue to go. But ultimately, it will still be an overhang. And this is one of the reasons why sentiment remains so poor in the region, is because there's some of these big themes that just don't seem to be going away very quickly.
I put you on the spot then. I mean, what, in terms of the equity markets that you cover as a CIO, I mean, what's going to outperform? Is it going to be the Nikkei, the S&P, or CSI 300 that you think could deliver the best returns maybe for the next 12 to 18 months?
One of our biggest thesis for this year is a broadening of participation in the global equities in particular. And so we've been in a very, very narrowly led environment when it comes to equity performance on a global basis. It's basically been U.S. large cap growth stocks. I do think there's already evidence, particularly in the first couple months, that we're seeing a broadening of participation, whether that's smaller cap names in the United States, whether that's parts of the EM world. We're obviously seeing some real legs in the Chinese equity trade, which we're also on board with and think there's some more room there. And I do think the surprise wild card may very well be the emerging market world, and China might be part of that. But if it isn't China, I think there's other stories in the EM world, like Brazil, that actually has some real real potential upside as well. So our broader thesis is we don't have to only rely on one narrow area of the market to continue to drive performance, but there will be broader breadth and participation as the year goes on.
All right, Nathan, we'll have more from Nathan here. Nathan Thuf from Manulife Investment Management. He'll be staying with us throughout the next few minutes or so. We're checking really closely Japanese assets, Toyota shares as well. So you're seeing a bit of a pop in the stock right now. According to Mainichi, this is local media, that Toyota is going to meet the union's demands for wage hikes in full. So we're waiting to see a little bit more clarity on that. We're expected to hear maybe from some of the Toyota execs maybe in the next hour or so. Maybe get some finalized numbers or something here to really kind of put some meat on the bones there. And you are continuing to see strength. Like, take a look at that dollar yen, 147.33. And we're seeing another day of losses when it comes to stocks, but certainly not as bad as what we saw the last few sessions there. And GGBs, I should say, 77 basis points for your 10-year here this morning. But the yen is certainly moving. Still ahead, we're talking about TikTok. The CEO, Shou Chew, pushing back against a bill that would force the app's Chinese parent to sell it or face a ban in the U.S. We have the details later on this hour. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. This is The China Show. Good morning.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
It's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly.
This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%.
It is coming down. But it's going to take some time, and that's okay.
I do think things are moving in the right direction in terms of prices.
But it really doesn't give the Fed ammunition or confidence to cut rates at the next meeting.
So far, I think they want to cut, and we expect to see that in the May or June timeframe.
Some of our BTV guests reacting to the latest U.S. CPI print, which of course did once again show hotter than expected. But the market seems to be kind of ignoring here right now, especially when it comes to equities. Let's bring back Nathan Thuf, CIO and Senior Portfolio Manager at Manulife Investment Management. It seems like this data continues to surprise to the upside in some ways. I mean, what are we expecting for the Fed this month? Is the dot plot really going to have to be reduced in some ways? Could we go from really 3 cuts to 2?
So obviously the data from a CPI perspective was a little bit more hawkish, but I stress the word little bit more hawkish. I think the general trend for inflation is still down when you look back over the last 6 months and what will happen in the next 6 months. But there's no doubt the Fed will take a very cautious approach. And I don't think we have to get back to our target level on inflation of 2%. And I'm not in the camp that you're going to see any real efforts from a policy perspective, from a change perspective in March or May. We're base case June as the earliest. And the risk is it gets pushed out further into the future. So we're of the view that we will probably see some movement in the dot plot. And it won't take a lot of movement to make the average get to 2 hikes instead of 3 hikes.
Okay. And what does that mean in terms of it seems like you're have a lot of conviction when it comes to equities. Can we expect this divergence between stocks and bonds to continue for some time then?
I think we can. And part of the thesis is that the equity environment isn't only driven by interest rates. Yes, it's part of the story, but the earnings profile and the earnings dynamic and the fact that we're going to see some recovery in some of the global economies, because we're not all synchronized. There are recessions in the world. There are areas of the world that are actually going to start to recover, and there's areas in the world that will start to deteriorate a bit. And when you look at the equity environment, we think that when we start to think about the latter part of this year, you're going to see a broader trend of that broadening of growth, and it's not necessarily going to be a disaster, even if the Fed takes a much more slower pace to ultimately reduce rates. But we are in the camp that we likely will see 2 or 3 quarter-point cuts when it comes to the Fed at some point in time this year.
Yeah, you mentioned about this equity market that could broaden out in terms of the gains beyond just the tech sector. So you're not really kind of ignoring the tech space, but what else could catch up, you think, in that?
Yeah, so I wouldn't be underweight tech, but I do think it's a source of funding for some of these other trades, particularly with the gains that many people have. But the areas that we're focused on are things like the healthcare sector. The healthcare sector, as an example, one, it's a higher quality sector overall. 2, you have a decent, consistent growth profile. But it's been the sector, particularly over the last 18 months, that has had the most disappointing earnings profile. Revisions have been negative. They've been disappointing overall. But this year, I think the year-over-year dynamics, you're going to actually have the healthcare sector deliver some of the better earnings growth from a year-over-year perspective. And I think that's underappreciated by the market. I would also point out the healthcare sector is generally trading cheaper than the broad market in the United States, as an example. So I think healthcare offers a more quality way to play the markets on the upside, partly because it's been a big disappointment in performance, but I think the earnings profile dynamics are going to be rolling off from a negative perspective to be a more positive story.
And what's your position around fixed income right now? Do you think bond yields have basically peaked at this point?
We do think for most of the world, bond yields have peaked. We also think the dollar generally has peaked overall as well. And so in that narrative, I think on a risk-adjusted basis, a lot of fixed income offers a decent opportunity. But from a pure absolute return perspective, we lean more towards equity as an outperformer. But I don't think you have to be as worried about fixed income continuing to show up on your statements as a loss, because I think you're going to be able to collect that higher coupon, and even if yields don't move down materially, you're going to have net positive returns in the fixed income world.
You mentioned about Brazil in the EM space. What's sort of the story in Brazil right now?
Yeah, Brazil is one of those stories that, doesn't always capture everyone's attention. I mean, obviously, it's an important part of the EM index, and I think there's some real structural changes happening there. We're seeing record export growth in Brazil. We're seeing a realignment of global trade supply chains, and that's benefiting Brazil. We're seeing better policies around the administration in Brazil. They're cutting rates from a central bank's perspective. They have high carry, and so there's a lot of positive dynamics in Brazil. It's not the basket case that it once was when you had, excessive inflation and uncertainty around growth, and you had uncertainty around some of the oil companies. You had uncertainty around the administration and policy dynamics. It's a much cleaner story now than it has been, and because of that, we need to start resetting the valuation dynamics to appreciate that higher quality nature.
Okay. Nathan, stick around. We'll have more Nathan Tuff there from Manulife Investment Management. He's staying around with us. I mean, take a look when it comes to, of course, the pre-market, and obviously what we've been seeing, whether we can see this rally continue. We're watching very closely when it comes to the Hang Seng. The pre-market is slightly down, but HSCEI, that's the one to watch. The next potential benchmark to enter into that bull market, 718.69 for dollar China. Plenty more ahead. This is Bloomberg.
times in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Some of the big corporate stories we're following for you today. Simon Cooper, a frontrunner to replace Standard Chartered CEO Bill Winters, is leaving the bank as part of a broader management reshuffle. Simon Cooper has led the lender's corporate, commercial, and institutional banking division for 8 years. According to a statement, he's exiting to pursue other interests. Our sources have said the bank plans to strip out a series of regional reporting lines in the division, which could lead to several executives losing their jobs. Keeping an eye out on Boeing suppliers in Asia today after the U.S. National Transportation Safety Board says it will hold a hearing in August on its investigation into Boeing's door plug blowout. The playmaker is not just facing possible legal issues, but a crisis in confidence as airlines turn away from buying its jets. Major American carriers have flagged that they are lacking aircraft they plan on receiving this year because Boeing slowed output. Shares of Coinbase slipped in after hours after the crypto exchange unveiled plans to offer $1 billion in convertible senior notes to repay existing debt. The firm says notes maturing in 2030 will be sold through a private offering to institutional investors. The notes can be converted into cash, Coinbase shares, or a combination of both. All right, we're taking a look at what happens here when it comes to this equity market in China. And, you know, if you take a look at how southbound flows have performed, it's looking a little bit more interesting and bullish, you could say, right? So mainland investors basically have bought stocks net for 19 straight days now. It's the longest streak we've seen since April of 2023. So everything from green shoots from the eco data, what Beijing has done in terms of rescue efforts in this improving sentiment, that certainly is helping them, mainland buyers there than this market. So continue to watch this space. The pre-market is looking like this year. It looks like we started off with a bit of downside here today, but yes, it was a 3% pop or so on the HSI yesterday. So certainly it might be or due for some sort of a pause here. HS Tech, though, still seeing some gains, about a fifth of 1%. And dollar China, 718.90 there this morning. In terms of analyst actions to tell you about, we've been focusing on the battery space with CATL with the latest there, reinstated buy at Orient Securities with a price target about 209 renminbi or so. The pharma space on a Farm 8 shares rated new buy at Daiwa. Also, Scholar Education rated a new overweight at Guotai Junan Securities. Take a look at some stocks to watch. It's tech. Given what we saw, bull market in HS Tech here. So what really led that charge? It was the likes of Xiaomi, Billy that had double-digit gains yesterday. Looks like we're pulling back just a little bit, but still a lot of optimism around that NEV for Xiaomi as well. But most of the tech space, a bit of a pause here this morning. We're watching very closely China Wonka. The open is next. This is Bloomberg.
you formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah. So when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome back. You're watching the China Show. We're counting down the open of markets, and the key question is, do things seem a bit different this time around? We've seen a few weeks now, close to about a month, where Chinese equities have gained. We're seeing a little bit of a back foot here when it comes to Hong Kong, but certainly that pop yesterday did send the HS Tech into a bull market. And Belle, we're continuing to watch what goes on with those 8 shares as well today.
Yeah, that's right. It really seems like sentiment is perhaps just starting to shift now in favor of Chinese equities finally, because we've seen a number of different sectors, areas that are now moving into bull market territory. So some of those we're tracking, you've got renewables, you've got materials, you've got tech, as you mentioned as well yesterday in the session, growth stocks. All of these are sort of coming back into favor here. It is that story of what is the future direction that China's economy is going to be taking. But this is the outlook here you've got for markets today so far. Fairly flat, I would say, really, at the open here. Not too much of a direction, perhaps a little bit to the downside. Yes, tilted so far here, but you are seeing still some strength that's coming through in certain sectors. Tech we can get to in just a moment, still continuing to climb here after it did finally reached that bull market territory in the session yesterday. So this is really the state of play. Of course, part of the story that investors are going to be reacting to is just those dynamics in terms of outlooks for central banks, the Fed, following that US inflation print yesterday as well. But let's roll on and take a look at these sub-indexes in more detail here. Again, looking pretty mixed so far, but some of those that are standing out, it's more of the consumer discretionary sector. You've got tech, gaming. These are all gaining here so far, but others, financials, industrials, looking a little bit weaker in the session. Keeping an eye as well on what's happening with the Chinese yuan here. Again, you're fairly steady so far. We did see a little bit of weakness yesterday in the session, but that was more of a dollar story following the inflation print. Stocks to be focusing in on today. Tech is clearly one of them, given those gains that we've seen. As we said, yes, the MPC, it really did disappoint investors on a number of different fronts, but it does seem that following that big crackdown on the tech sector, Xi Jinping possibly looking to AI, looking to chips, these are the areas that can propel China's growth story. What could be the big risk in the session so far, if you change on, is what we see in the property sector today. So you've got the likes of Vanke, for instance, you've been discussing Avon, possibly this debt swap talks that are going on with banks. That was a Bloomberg exclusive. You've got a unit of Country Garden, for instance, that could have defaulted or missed one of its bond repayments. Citi, for its part, is saying that systemic risks, they are decreasing, but certainly that is something that could present a bit of a downside risk, as we say, to equities. Other names that we're tracking here, Li Ning, one of them possibly being taken private. You've also got some lines that are dropping around Costco shipping, the Biden administration as well. They're really tracking that sector quite closely. Biden administration, geopolitical risk as well, because they are looking to review a union petition there, but certainly taking a look at what's happening between that relationship. Beijing and Canberra very much in focus, not always something we track as closely as the US one, but still we do have Treasury 1. It's climbing a little bit so far. Some other wine-linked stocks, though, coming under a little bit of pressure so far in China. But we do understand, Yvonne, that China is proposing to end what have been some very, very hefty tariffs on the Aussie wine industry that have been in place for about 3 years now.
All right. Let's hope we'll get a glass of Penfolds coming out to celebrate. Yeah, we saw Treasury wines, though. That's rallying in Sydney here. But yeah, some of these Chinese wine stocks, though, are doing the opposite. We're back with Nathan Toth, CIO and Senior Portfolio Manager at Manulife Investment Management. Maybe we need a bit of a drink here just to talk through some of the conflicting narratives around this market, right? If I take a look at what iron ore is doing, yes, maybe that's the China story. Demand picture, they're looking a bit weak. But then I pair that with soaring U.S. tech stocks. You could do the same when it comes to gold near records, along with Bitcoin. How do you make sense of these sort of different narratives right now?
I do think there's a number of interwoven themes, and in some cases there's actually bipolar themes that are happening out there, right? We have the inflation theme, which I certainly think is benefiting things like gold and even part of the Bitcoin story, and certainly it's impacting interest rate dynamics, which then feeds into some of the other stories around there. But at the same time, I think there's an underestimation of what's happening with prospects for growth and the overall earnings dynamics, which is certainly powering the tech sector as an example. People point to the tech sector as, oh, it's a bubble, but I would argue in some cases valuations are actually coming down because their earnings growth has been so powerful that valuations actually haven't been keeping up. Now, that might be a very Pollyannish, optimistic view, and I think it is to some extent because we've seen large moves in those areas, but I don't think you should dismiss the potential that some of those high-flying areas can continue to persist, because I do strongly believe that the AI secular theme is a theme that stays in place for a very long period of time, and there's going to be quite a few beneficiaries from that.
What are those beneficiaries? Is it still going to be, data centers and the like, or can we broaden it out to the consumption of AI?
I think you can broaden it out to consumption of AI, but it's going to take some time to fully look at what the narrative completely is. But I think there's also the argument that you're going to see increasing productivity gains coming from the AI story. When you think about global GDP growth well into the future, one of the pillars that's going to keep growth higher is the fact that AI is going to, and tech in general, is going to create a lever for productivity rather than just relying on hiring another person to gain productivity.
Okay, we haven't talked even this hour about the Japan story, which has actually been benefiting from AI as well. But if we see some sort of rate hike this year, does it push, the end of this bull market in Japanese stocks?
I think Japan has more legs than people get credit for. Obviously there's been a lot of story around the weakening yen as being a favorable part of the Japan acceleration in the stock market. But I think it's much more than that. Obviously there has been much more better policy around corporate shareholder friendliness over the last half decade or so that plays into it. There's been a re-rating of valuations to be more in line with, but still cheaper than the rest of the world. And so I think there's a lot to the Japan story versus just the yen weakness. And even if the yen has generally weakened to the point where it can't weaken much more because they are going to start to normalize policy, I would still argue that normalizing policy in the scheme of Japan is moving basis points. It's still going to be one of the most accommodative central banks in the world, right? And so we aren't as reliant on the yen to power the rest of the upside in the Japanese equity story. So we have moved from being hedged the yen to having an unhedged exposure to our Japanese equity exposure.
Have you done anything in terms of what the repatriation flows could mean? If you're thinking that this is going to be quite a moderate sort of normalization, are we likely to see Japanese investors really sell some of these overseas assets and bring money back home?
I think on the margin you will, but I think the biggest narrative of story is you'll continue to see a recognition globally that I don't have to ignore the Japanese equity markets anymore. Global fund managers have been persistently underweight Japan for decades. And if they're going to want to participate in this, they're going to have to send flows into that market and get their weightings to at least neutral so it isn't dragging down their performance. So I think some of this is a story not just from a domestic perspective, but from an outside perspective, trying to recognize that Japan is not just a dead universe when it comes to equity performance. There's actually real opportunities there.
So if indeed they do something next week, or even April is the consensus, where will I likely see that hit? Is it going to be JGB? Should I look at dollar yen? Where would I likely see them?
I do think the yen has, basically weakened to the point where it probably doesn't weaken much more. So can the yen get back to a 140 level or 135 level versus the dollar? Absolutely, I think it can. I don't think that kills the narrative as to why you want to own Japanese equities. It might create some hiccups like we saw the last couple of days, but I don't think it necessarily completely derails the potential for Japanese equities to the upside.
Is there any sort of asset class we've forgotten yet, Nathan? As we wrap up this morning with you, we talked about stocks in quite a bit. What other asset class are you mostly watching out for this year?
I think on the more negative side of things, a lot of the things we talked about have been more where you like things. I do think there's more concerns around certain pockets of the equity market that we haven't talked about. European equities, I think, is going to have a tough time outperforming given some of the other narratives in the U.S., Japan, and potentially EM. I think the Canadian equity market is a weak link because they're in a more dire situation from an economics perspective. I do think parts of the EM space won't benefit as much because while India has been kind of the one area that's held up really well in the EM space, it's probably going to be a source of funding if people are moving back into Chinese equities or Brazilian equities as an example. So I don't think everything is going to be positive. I think there are pockets and you still have to pick and choose, which is the luxury of being an asset allocator and why I like my job.
Nathan, it's great to have you. Nathan Tuff there, CIO and Senior Portfolio Manager at Manulife Investment Management, joining us here in Hong Kong. We're taking a look when it comes to this tech rally and where we're seeing here right now. So we continue to watch what goes on when it comes to some of these wage talks in Japan as well. So Mitsubishi Heavy agreeing to raise wages by average 8.3%. So that's quite a punchy number here as well. We're still waiting for more lines of what comes out of Toyota. But in the meantime, here's what your HS Tech is looking like. We're still seeing a solid rally here, up about 1.3% or so. What's leading it looks to be the BYDs and the Li Autos. The EVs are catching a bit here this morning. Li Auto, in fact, is up some 5%. On the bottom of it, though, interestingly enough, is XPeng, though. So it's not a broad-based sort of rally when it comes to some of these EV makers, but certainly a lot of talk about that Xiaomi NEV. How's that change the competitive landscape around the EV space in China? Let's get to more about the geopolitics as well. Bloomberg has learned that TikTok intends to exhaust all legal options before it considers any kind of divestiture from Chinese parent company ByteDance. That is, if the latest U.S. legislation targeting the app becomes law. Joining us now from Washington is Jennifer Welch, Chief Geoeconomics Analyst at Bloomberg Economics. Jennifer, always great to have you. How likely do you think this law is going to really go through?
Well, thanks so much for having me. If you had asked me last week, I would have said it looks like a pretty clear path forward in Congress and then to the president's desk, where President Biden said he would sign it if it passes. But after yesterday, when former president in 2024 and likely Republican nominee Donald Trump came out and publicly opposed the bill, I think its prospects, even on the Hill, are far more uncertain. House Republican leaders say they still plan to expedite the bill and bring it to a vote tomorrow, Wednesday, in the United States. From there, it'll move to the Senate. But there are a lot of questions about whether Republicans are still going to support this. And among Democrats, there are reasons to be wary about the bill, particularly since TikTok is so popular among young people and in particular Democrat-leaning voters.
I'm just wondering then, what is TikTok likely going to do then? I mean, is it something that are they really interested in really selling? Will they really go through with that? And then who would actually be a likely buyer of TikTok at this point?
I think the first step for the company, and what we're seeing right now very actively in DC, is a very active and grassroots campaign to try and lobby Congress to even avoid the issue of this bill passing in the first place. And it sounds like what they're in particular going to be targeting is the Senate, given that the bill is likely to go to a House vote as early as tomorrow. After that, I think the company plans to, as Bloomberg has reported earlier today, try and fight the bill in the courts. And this is something that TikTok has experience with. They've fought federal bans as well as state bans before. In the past, courts have delayed or overturned those bans. And so I think the company sees reason to believe that it has the ability to fight this. If that fails, then I think it faces the question of divestment versus facing a ban on its operations in the United States. And I think the divestment could in particular be very difficult, not only because of the assets that ByteDance would lose, but actually in the past, Beijing has said that the algorithm used by TikTok is a sort of national security treasure, a proprietary element that it does not want want to see shared with foreign countries and foreign companies. So there's a whole web of geopolitical complexity here before you even get to the point of divestment versus facing the ban.
And you mentioned if this bill actually fails in Congress, and obviously, it's such a popular app among young users in the U.S. as well. If it does fail, does that, what other challenges do you think TikTok still faces in the U.S.?
That's a great question. I think given the number of attempts we've seen at both the federal level and the state level to go after TikTok, given what we're seeing as very persistent concerns among congressional lawmakers, but more broadly about the potential national security risk posed by TikTok, I think those concerns are likely to persist. Even if this particular bill fails, I think there will be future attempts to challenge the platform and the company's operations in the United States. And so this is likely to be an ongoing story and an ongoing source of political risk and uncertainty for TikTok and more broadly for China-affiliated companies in the United States.
Jennifer, always great to have you. Jennifer Welch there, Chief Geoeconomics Analyst at Bloomberg Economics. Some other major geopolitical stories that we're following for you today. President Biden says the U.S. will go over a group of unions' petition for a review of China's subsidies when it comes to shipbuilders. Now, in a post on social media platform X, he vowed to, quote, always stand against China's unfair practices and fight for U.S. workers and jobs. The Pentagon says China is currently in the lead in developing weapons that can travel 5 times the speed of sound. The National Air and Space Intelligence Center says China's lead over the U.S. and Russia is a result of 20 years of investment, testing, and deployments. Russia has used hypersonic weapons in Ukraine, but lags behind China in total inventory and support systems. The U.S. has yet to field a single hypersonic weapon. Plenty more ahead. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
All right. We have one eye on China, the other on Japan all week here, and really continue to see a bit downside when it comes to this equity market, just given the strength of the yen. That's really the key mover here in Tokyo. Just given some of these wage negotiations, we're getting a little bit more clarity and outcomes from these talks.
ECB's Wunsch cautions on ECB move due to high service and wage inflation. Wunsch of ECB, central bank can act before wage inflation falls to 3%. ECB's Wunsch suggests betting on interest rate cut in the near future.